Happy Friday. Welcome to the Access to Capital Symposium, co-sponsored by the FCC's Media Bureau and the Access to Capital Working Group of the Advisory Committee on Diversity and Digital Empowerment. You can rest assured that no matter what is going on in the world, that the FCC and the Diversity Committee are busy tackling the issues in their charge. We are excited to be part of this full day of informative panel discussions on innovative ways to access much needed capital to enter the broadcast industry or to stay competitive in today's challenging financial environment. The Access to Capital Working Group is led by Caroline Beasley, a widely recognized industry leader, CEO of Beasley Media Group. We want to thank Caroline for her stewardship of this working group and for all the hard work that went into planning today's symposium. Caroline's working group is comprised of an impressive list of who's who in media, including media advocacy and trade associations. These diversity committee members are dedicated to the issues of diversity inclusion in the broadcast industry, and they have worked extremely hard to present the most current, up-to-date information from the experts you will hear from today. Before we begin our symposium, we are very fortunate to have with us today Commissioner Jeffrey Starks, who will make some opening remarks. Commissioner Starks?
Yes, well, good morning, everyone, and thank you for being here bright and early. Thank you, of course, for inviting me to speak to you all, and many of the participants will be sharing, obviously, their knowledge and insight on a topic that is central, core, I would say, to one of the FCC's primary roles as stewards of the public airwaves, and that is promoting and advancing media diversity. I trust that everyone is obviously safe and in a good place today, and I hope you're able to have that productive and positive discourse. We are counting on you. And so I want to begin by acknowledging, obviously, and applauding the work of this Advisory Committee on Diversity and Digital Empowerment. The Commission relies, as I said, on several of these advisory committees to supplement our work, and the caliber, of course, of the members and the working group participants that agree to serve on these committees is a remarkable testament, truly, to the importance of our mission, and that is to serve the public interest by making communications available to all Americans on an equitable basis. And so these committee members bring their vast knowledge, resources to the table to solve real-time, real-world problems and to inform our deliberations. And so, like all advisory committees, you inform us, you advise us, enhance what we do, and improve the Commission's work in response to what we ask of you. And so thank you truly for your service. And this committee in particular is unique because rather than just advise the Commission, the ACDDE regularly holds symposiums and workshops that educate both the Commission and the public. And so you all should know the value of hearing from all sides and listening to all stakeholders and their voices. And that is what makes events like this one today, and obviously last month's Tech Supplier Diversity Opportunity Showcase, truly invaluable. And so I applaud, again, you for being the sage voices that are whispering here in the Commission's ear with perspectives that we might otherwise not get, and for being such a valuable information and resource for businesses and for the public. And so when I spoke before this committee in April of this year earlier, I noted your broad and deep agenda as defined by the Commission. So I'm pleased that today's symposium does focus on a critical issue that the Commission has not been able to, in my estimation, move the needle on in a meaningful way. The problem of access to capital was bad before the pandemic, which certainly has not done our economy, and in particular our small businesses, any favors. As one news article put it, quote, small businesses have been at the losing end of the U.S. economy for decades, but nothing has diminished their stature like the COVID-19 crisis, close quote. And so small businesses drive our economy in ways that are often surprising to everyone except those small business owners. And so that's your hairdresser, your lawn care company, your dentist, your favorite food truck. But truly don't stop there. Obviously think of that AM radio station operator that broadcasts in Korean to a small but loyal local audience, or the FM radio station operator in that small southern town that broadcasts religious programming perhaps during the day and blues at night, because her listening audience cannot get that programming anywhere else. And so these are small businesses as well. Many of them in small markets, as I said, where they operate on razor thin margins in order to be profitable. And so unfortunately, so many small businesses have had to shutter. And unfortunately, hopefully more won't happen before this crisis is over. And so predictably, small business owners are also frequently Black and brown, and they are faring the worst during the pandemic as well. One study obviously showed that African American businesses were hit particularly hard, experiencing a 41% drop in activity. Latinx business owners activity fell by 32%. Asian business owners dropped by 26%. Immigrant business owners as a group have experienced substantial losses in business activity of nearly 36%. And women-owned businesses have experienced nearly a 0.25% drop in business activity. And so we didn't need this study to know that these groups were at a higher risk of losing business due to COVID-19, because they were at a higher risk of losing business prior to COVID-19. And so, you know, the SBA's Paycheck Protection Program provided stimulus funding, obviously, ultimately to about 16% of the nation's 30 million small businesses. And so what does that really mean is that it's likely that funding didn't reach some of these small businesses that we're going to talk about. And I'm guessing that a lot of them still need help as well. And so the discussion that is going to take place here today and long after today about securing a path to media ownership and sustainability through access to capital is extremely well timed, sorely needed. And so I look forward to hearing your views on what the Commission should be doing to encourage the private sector to actively engage on addressing the access to capital and that shortfall. Obviously, Congressman Butterfield's bill holds some promise to restart the tax certificate program. I've actively supported that, advocated for it since joining the Commission. You know, but what else can we do on the regulatory front? Should we take another shot at an incubator program? What short-term and long-term solutions should we be looking at? And so, you know, I'll close with one proposal that I've personally worked on with the civil rights organizations and have championed and was instrumental in advancing, that will soon be released as an NPRM, is allowing FM booster stations to provide hyper-localized content, including alternative language news, weather, emergency alerts, and advertising periodically during the broadcast day. And so this proposal was brought forth by Geo Broadcast Solutions. And I believe it ultimately can help alleviate some of the access to capital problems for a small segment of current or would-be FM broadcasters. And so completing this rulemaking, I think, will provide a way for underrepresented station owners to better serve their communities, earn more advertising revenue, as well as open up opportunities for local small businesses looking to more cost-effectively advertise to a targeted audience. And so truly, thank you all for your engagement with the Commission on very serious issues. We've been working for a long time on some of them and clearly could use your help in figuring out how to best make meaningful progress in areas like accelerating entry by small, women-owned businesses, minority-owned businesses into industries where they have not traditionally gained a significant foothold. And so that does include traditional media, digital news, and programming. And so thank you for the opportunity to join you here today. I look forward to the discussion, the dialogue, and the results. And please, everyone, of course, stay healthy and safe. So back to you, Chief. Thank you.
Thank you very much, Commissioner Starks. Thank you for joining us today. Next, we will hear from the leadership of the ACDDE, our chair, the intrepid Anna Gomez.
Thank you, Michelle. And thank you so much, Commissioner Starks. We appreciate your support of the committee's mission and your understanding of the importance of media diversity to the FCC's mission, and for underscoring for us why ensuring diversity is important to meeting the public interest. I would like to welcome everyone to the symposium and to give my sincere thanks and appreciation to our chair, Carolyn Beasley, for her leadership of the Access to Capital Working Group, and to all of the working group members who really banded together to put together today's impressive agenda and speakers. We are extremely fortunate to have this array of experts, and I expect today will be a robust and impactful discussion. Finally, I would like to thank all the FCC folks who helped make this workshop happen, including Michelle Carey, Sarah Weitzel, Jamila Best-Johnson, Julie Saunier, Jamil Kadre, and I cannot thank them enough for their continuous support of this committee's work. Thank you. And I would like to turn this over to our wonderful Vice Chair, Heather Gates.
Thank you, Anna. Thank you, and good morning, everybody. I would actually like...
I can't thank them enough for their continuous support of this committee's work. Thank you. And I would like to turn this over to our wonderful Vice Chair, Heather Gates.
Good morning, Anna. Can you hear me? I can hear an echo.
Thank you, and good morning, everybody.
I can hear you, Heather. Someone needs to mute themselves. We are having an echo. Thank you.
Okay, again, thank you, Anna, and thank you, Commissioner Stark, for your support and for joining us today. I'd like to also thank my fellow committee members, particularly the Access to Capital Working Group and Commission staff and members of the public. I'm very excited to join you today for this important discussion during this challenging time. As we speak today, we are experiencing an alarming increase in COVID-19 cases and deaths. Just yesterday, Johns Hopkins University reported over 120,000 new cases and over 1,100 deaths, breaking previous records. We have seen racial injustice that has resulted in the just killing of Black and Brown lives. These challenges continue to disproportionately impact communities of color with the devastating loss of life, jobs, and economic opportunity. We have also seen the loss of minority-owned businesses, which is detrimental to all the gains that we've made in the last 10 to 15 years. Indeed, this pandemic has exposed what we have known all along, the inequalities in accessing capital and other funding opportunities for minority-owned businesses. This was apparent when small minority-owned businesses struggled to access the Payment Protection Program when it was first initiated. As the Advisory Committee on Diversity and Digital Empowerment, our mission is to empower disadvantaged communities and accelerate entry of small businesses, including those owned by women and minorities in media and programming industry. This is more important than ever. This work is more important than ever. So today, I would like to again express my appreciation for the Access to Capital Working Group for bringing together an impressive and diverse group of broadcasters, policymaker lenders, and other experts to examine issues of access to capital and to discuss how small and diverse women-owned media can attract increased advertising revenue, and to talk about the importance of tax certificate policies to increase diversity in media ownership. Small, diverse, and women-owned businesses, women-owned media is essential not only because it provides opportunity for growth and media ownership for people of color, it empowers communities to tell their own stories from firsthand experience with a level of clarity that cannot be fabricated or produced. And so before I conclude my comments, I'd like to share with you my family connection to broadcasting. My grandmother was born in 1924 in the British colony of Southern Rhodesia, which would later become Zimbabwe. After being raised in an orphanage, she grew up to be a revolutionary broadcaster for children's show. So during a time of colonization, segregation, injustice, pain and suffering, every day at 4:15, children would gather around radios to listen to her show. She brought joy, information, and educated children. She wrote her own stories because of a lack of access to these kind of stories and shared them with children across different African townships. Her mission was to inspire children to rise above their circumstances by getting educated and becoming the authors of their own stories. When I traveled and spent time with her, I was always amazed by how many people recognized her by her voice. I had the privilege of witnessing grown men and women cry as they related their personal stories about how she made them feel and how she inspired them to pursue goals that their parents didn't know about. I shared this story because I'd like to think that I have a deep understanding of how broadcasters impact lives. And so today I look forward to this discussion. I look forward to learning more and becoming part of helping this diverse media expand and grow. So again, thank you to everybody that's worked hard to put this together with Caroline Beasley's leadership. Thank you again, and over to you, Anna.
Thank you, Anna, and thank you, Heather. Heather, thank you for sharing that remarkable story. And before I turn it over to Caroline Beasley, I also wanted to echo Anna's thanks to Commission staff. In particular, I wanted to thank the 3 J's, as Anna calls them, Jamila Best Johnson, Julie Saunier, and Jamil Kadre. Thank you all for planning this wonderful event. So next, we will officially begin the symposium. I'm going to turn it over to the chair of the Access to Working Group of the ACDDE, and that is Caroline Beasley. Good morning, Caroline. Thank you.
Good morning, everyone, and thank you for being here today. I'd like to extend a very special thank you to Michelle Carey, Anna Gomez, Heather Gates, and the 3 J's for their leadership and help with the Access to Working Capital group. Thank you all for all that you have done to get us to this point today. And finally, thank you, Commissioner Starks, for your comments this morning. It's an honor to be here today to share with you the great work that the Access to Working Capital group has done. We have 3 subgroups within our committee. Each subgroup will be presenting today, and they've coordinated the panels and presentations represented by each group. What we originally set out to accomplish and where we are today has shifted, just as our lives and businesses have shifted since COVID. And today's symposium will highlight the impact COVID has had on each subgroup. I'm proud to share with you the following subgroups. Chairs, Lending Finance subgroup is chaired by Dewan McCoy. Our political subgroup is chaired by Nahuja Amma, and our broadcast subgroup is chaired by Skip Dealert. Each of these folks have worked tirelessly over the last several months to get to the point we are today, and also, of course, their participants within their subgroups. With that, we do have a very exciting agenda today, starting with our finance panel moderated by Dewan, who will be discussing the challenges of obtaining financing during these trying times. We'll then move to our political subgroups panels that start with a discussion on the importance of the tax certificate in increasing ownership diversity, followed by Kate O'Connor, and then we'll end with Henry Rivera moderating a panel on the impact of the tax certificate. Then we'll conclude our symposium with our broadcast subgroups panels, where we will offer an interesting panel moderated by our subgroup chair, Skip Dillard, that includes Nielsen discussing various opportunities to increase measurement for diverse owners. And then the meeting will conclude with an exciting panel moderated by Sherman Kazart, discussing access to advertising for diverse owners. So please sit back and enjoy our symposium today. And with that, we are starting today with the panel Obtaining Financing in Today's Changing Environment. And that is moderated by Dewan McCoy, our Lending Finance Subgroup Chair. Dewan, I'm going to hand it over to you.
Thank you so much, Caroline. Garret, Ty, and Daniel, wonderful. Kevin, can you pop up our slide, please? Thank you. Very nice. So this is a pleasure, and I'm so happy to be here, and I'm happy to chair the Finance Committee. Hopefully, after today's presentation, we will, for lack of a better word, give a little hope for folks that are interested in entering the broadcast space. We have put together a esteemed panel for you today, and our panel is a panel that is really a case study panel and not a supposition panel. We have folks that actually have lent money and are in the space loaning money and doing deals. So hopefully after today's presentation, you'll feel comfortable and feel confident that there are ways to access capital during normal and difficult times. Next slide, please. Our panel today is myself, Dwan McCoy, CEO of Circle City Broadcasting. For those of you that don't know me, I'm a 30-year broadcasting veteran. I've been in the ownership game since about 2007. I purchased my first group of stations during the 2008 recession, which we're going to talk about a little bit. I bought and sold 11 TV stations, Big Four affiliates, independent stations, low power stations throughout my ownership career. I participated in regional financing, small business financing, big investment financing, private equity lending. So my experience from a lending standpoint covers the gamut. In addition to me being on the panel is my CFO, Shea. Shea is a 14-year broadcasting veteran. He spent 8 years with Morgan Murphy Media as a controller, and he's been with me for about 6 years. Prior to that, he was in commercial lending for a small regional bank in the Wisconsin area. Our next guest is Garret Komjathy, who is the Senior Vice President of Lending for U.S. Bank. Garret has over 30 years of corporate banking experience, including 25 years in media communications, new deal origination, and structuring finance management. He's also been an administrative agent for companies like Beasley Media, which is Caroline's company, Bayou City Broadcasting, which is my former company. And he's lent money, for full disclosure, to me in a smaller deal and a larger deal, and to Caroline Beasley in a much larger deal. He also, in 2015, Garret was the recipient of the U.S. Bank Summit Award as recognition of being among the top corporate bankers in America. So welcome to our panel, Garret. And finally on our panel is Damon. Again, Damon is a 30-year lending expert. He's also a speaker at the National Association of Broadcaster Leadership Training Program. He's also with U.S. Bank, and he earned his MBA in financing and accounting from the University of Chicago Booth. Next slide, please. One thing I'll tell you about all of our panel is that we are active participants and either graduates or faculty members from the NAB Broadcast Leadership Training Program. I'm a graduate of the program in 2008, and Ty is a graduate, I think, in 2013, Ty, is that correct?
2014.
2014. Garret Komjathy and Damon are faculty members. For those of you that don't know about the Broadcast Leadership Training Program, it is the most recognized training program in America, headed by Diane Sutter, that teaches people how to buy and purchase television stations. So everything that you teach, everything that we talk about today is usually taught in the NAB Leadership Training Program. Michelle Duke heads that program up for the NAB. The open enrollment for the 22 class starts in February. Again, the open enrollment for the NAB Broadcast Leadership Training Program opens up in February of 2021, okay? So with that being said, we're going to talk about a lot of detailed stuff today, and we're not going to go into detail on everything. Our objective today is just, again, to give you hope and talk about ways that are factual ways to finance broadcast transactions in today's environment, which is a difficult environment, and in normal circumstances. Throughout our presentation, we have staffers on staff ready to accept and pass along your questions. You can send your questions to livequestions@fcc.gov. Again, if you're just listening today and not watching, the email address is livequestions, one word, @fcc.gov. Okay, let's go ahead and get started. Next slide, please. So what we're going to talk about today is a case study which actually happened, and I'm the case study that we're going to talk about. So it'll be an anecdotal story that hopefully you can pick up a few nuggets and learn a few things from. We'll talk about my case study. We're going to talk about the financial crisis of 2008 and how it compares to today's COVID crisis. We're going to talk about seller financing. We're going to talk about regional community bank lending, specifically West Texas First Financial Bank that financed me. And we're going to talk about the all-important SBA-backed loan, okay? So when I purchased my first group of television stations, I was still a participant in the NAB program. And the stations that I found were in West Texas. There were 2 Fox affiliates and some low power stations. I had arranged my financing at the end of 2007, okay? Right before it was known that we were approaching a financial crisis. When I got ready to close my stations, everybody stopped lending money. Sort of like today's environment. Today's environment, there are very few lenders loaning money for broadcast stations because of COVID, which again is very similar to the financial crisis of 2008. So what I did, I ended up doing seller financing. Can you go to the next slide, please? Seller financing happened to be an option. And I didn't know it until I actually was a little miffed that the financing that I had lined up prior to the financial crisis dried up. And so I had to search for other options. I went to the seller, the person selling the stations, and pretty much asked that person, will you personally finance my television station for me? Okay. And what made that work was I had a partner in the seller, based on the relationship that I had developed with that seller, to really want to sell me the stations. But to make it work, that seller had to get a good return on his investment. At the time, he understood that nobody was loaning money. So my lender realized that if he could charge me 8 to 12% interest on my loan until the finance coffers opened up again, he can make himself a pretty decent return. So when you do seller financing, my point is your interest rates have to be higher than market rates, okay? They need to be reasonable. They don't need to be 15 to 19%. That would be in the usury category. Reasonable terms are in the 8 to 12% range. And that's what I did in my first transaction, is did a 8.5% loan with my seller for roughly the full amount. When you do a seller financing loan, you want to have a mutually agreeable maturity date. when that loan becomes due. In my case, we had no idea that when the financial crisis would be over. So my mutually agreeable maturity date was 3 years, but there was no prepayment penalty if I chose to pay off my loan early. So it was a 3-year deal, which gave me a runway to get a loan from a conventional lender. When you create a loan, okay, and when you buy a station, you're buying that television or radio station based on the fact that you can run that station from an operational standpoint better than the owner. That's why you buy, okay? So when you do your loan, you want to try to ensure that you can make your loan payments based on the way you are operating the station and based on your operating cash flows. I'll repeat that. You want to try to borrow money based on your operating skills, what you plan to cut, what revenue you plan to increase, okay? You want to be able to make those loan payments based on the operating cash flows. If you don't, you can get yourself into a world of hurt, and you could be paying money out of your pocket and perhaps lose the stations. D, you want to also ensure that you have a cash down payment. Your seller is going to want some type of down payment. Some people say, oh, you got to have 10%. Some people say you got to have 15%. I don't think that's true. What my seller got from me, he said, Dwan, I want to see your personal financial statement. I want to see how much cash you have in the bank. I want to see what mortgage you have. I want to see what type of equity that you have in your home. I want to see your assets, okay? Because I want to ensure that you have enough skin in the game that if you walk away, you're going to be hurt. Because nobody wants to loan you money unless you have risk. And the risk has to be proportionate to your net worth or your operating personal financial statement so that you don't walk away. And when I showed my seller full disclosure, my personal financial statement, he felt comfortable that I had enough skin in the game and I wouldn't walk away from the transaction. So that's why he was willing to finance me. So seller financing is an important option in today's environment. Next slide, please. In addition to the seller financing, while I did my deal, I didn't stop there, okay? I didn't say, oh, I got my financing from my seller, now it's time for me to stop, okay? I continued to try to take my seller out, meaning I tried to find another source of lending from a traditional source so that I could receive a smaller interest payment and lower my interest payment to a more traditional loan. So what I did while I was operating the stations, I created a relationship with an advertiser, a banking advertiser that was already on our television station. And that bank was First Financial Bank. I called in a small town, most presidents and CEOs of small banks are part of the community. So I developed a relationship with that banking CEO and called him into my office and I asked him the question. I said, what's your average daily deposit for small businesses? And he said, about $50,000. Now, average daily deposit is computed for you on a bank statement. So if you look at at a bank statement, it'll show you exactly what your average daily deposit is. What that means to a regional bank is that's where they have Federal Reserve rights to go borrow money based on their average daily deposits. So when banks have higher average daily deposits, they can get more loans from the Federal Reserve at lower rates. So basically, I kept all of my deposits at a larger bank. At that time, the larger bank had no interest in loaning me money. So when I called the CEO into my office and showed him that my average daily deposits for my broadcast stations were 4 times the amount of his average small business daily deposits, he said, wow, I want to loan you money. He also saw how I was operating the stations. That is an advantage of doing a business transaction and a banking relationship with a small community bank, a bank located where your television stations are and where your radio stations are. The other value that most banks look for is assets. For me, I was fortunate to get real estate, which is an asset, with my transaction. I was also fortunate to get a little land and towers with my transaction. What that allowed the regional bank to do was hard assets became collateral for my loan. And that became a separate loan from the bank. One of the challenges that we ran into was, and most media banks or most banks call this a hindrance to doing business, and this is collateralizing the FCC license as part of your loan. I was fortunate to be associated with Frank Montero, who is again a 30-year veteran that has found end arounds for small banks to assist them in legally collateralizing the FCC license. Once Frank Montero spoke to that community bank and helped with language in a contract, that put the small community bank at ease from a collateralization and of the FCC license standpoint.
Yeah, and Dewan, collateral is so important because it from the bank standpoint, because it can reduce their risk and their exposure. And that's why in an instance when you have collateral, it can be so effective as a new entrant into the broadcast business to help secure a loan.
Garret, you got any comments so far, sir?
Yeah, I would echo Ty's comments that, as a specialized media lender, our primary source of repayment on any loan is, as you mentioned earlier, is the cash flow generated by that broadcasting property. And that's what we look at. That's what we analyze as part of the projections and the historical performance of that station. We look at clearly the value of the FCC license. That's where we take our comfort. That's really the collateral, and that's where all the value is. And then with respect to what I would consider sort of the secondary sources of repayment, the real estate, the studios, the towers, the land, towers are extremely valuable and desirable assets that, we look again as a secondary source of repayment and provides additional comfort to our primary source, which is cash flow generated by the broadcasting property.
Before I move on, Dan, do you have any comments?
Yeah, the only thing I'd say on top of what Garret just indicated, so, in addition to, obviously wanting to get as much collateral as you can, another sort of aspect you need to take into consideration is, if you're in a particular market, it's nice to have collateral, but that implies you're going to sell, you have the ability to sell that asset to someone else. So we obviously in the banking world spend a lot of time understanding, well, who are the other competitors in the market? Do they have the regulatory ability to make these acquisitions in that market? Is it an attractive station? So it's sort of a package. Having the collateral, it's like having a valuable asset, but where is that asset located? And for the most part, most markets are very obviously diverse in terms of number of operators, but that is something that's also key. Just because you have the assets, you have to make sure. An extreme example: if you're in a market where your competitors are already at regulatory caps, they're not going to be likely buyers. So you want to look into, when you're buying an asset, just from your own perspective, your ability to sell out of that asset. Who could the likely buyers be, and the lenders will do the same analysis.
Thank you, fellows. So for the last item on this page for regional banks is what I think for a new entrant is probably the most important aspect of lending, and that's asking for SBA-backed assistance. Okay, next slide, please. So SBA, Small Business Association-backed loans, keep in mind the government traditionally does not loan money. I say traditionally because we just went through a pandemic, and the Paycheck Protection Program, the government sort of kind of did loan money. Okay, so basically banks are really the lenders of the money, and the SBA insures the debt. So first of all, before you get an SBA loan, you need to have a local banking relationship. If you call the SBA and said, hey, I want a loan from you, they're going to say, here's a list of regional banks that are SBA supporters. Please call one of those, develop a relationship with them, and they're going to vet you first. So the banking institutions you'll have to get approved through their loan requirements first before you get to the SBA section, okay? The SBA also has vetting requirements. The most sought after loan for the SBA is called a 7A loan. And that loan is, you can get money up to $500 all the way up to $5.5 million from the SBA as a backed insured loan. One of the things I'll tell you from experience is that the SBA and the government keeps records on you for perpetuity from a lending standpoint. I know a great example of an individual that didn't pay back a student loan, a government-backed student loan over 30 years ago. And when that person tried to apply for an SBA loan, the government came back and said, wait a minute, you still owe X amount of dollars from an SBA loan. And if you don't pay it, you won't be approved for any SBA-backed loans, period. And if you don't repay a loan, the government has a right to charge you interest for that back payment on the loan. And if you do the math on 5% over 30 years, that's a big number, okay? So I'll tell you, you gotta pay back the government if they loan you money, no matter what they loan you the money for, because they keep records for that. Next slide, please. There is an arduous process that I went through because it was a financial crisis that verified all of your assets, all your money, your personal financial statements, but the bank will assist you with that process, okay? The beauty behind an SBA-backed loan is that it's a very low interest loan, okay? It is, in some cases, it can be as low as 3%. The range is usually from 4 to 7%, depending on your timing. If you're looking for an SBA-backed loan today, that loan would probably be in the 3 to 5% range, okay? Loans can be done for equity. It can be done for working capital. They're also going to ask you the same lending questions that bankers do. How much equity do you have in the game? Once you develop a great working relationship with an SBA loan and you borrow money and you pay it back and you create a great relationship with the bank, that opens up a lot of doors for you, particularly during difficult times like we're in today. This is a great segue. I'm gonna pass the baton to my great CFO, Shea, to talk about what a banking relationship from a small business and a SBA loan standpoint looks like. Okay, Ty.
Thank you, Dewan, and thank you, everyone. I'm thrilled to be here this morning. You'll notice a recurring theme throughout our discussion this morning is relationships and how important they are, specifically with your bankers and lenders. So I'm here to talk about the Payroll Protection Program. Next slide, please. Here to talk about the Payroll Protection Program through the SBA. A little background, this was a $349 billion program approved by Congress through the CARES Act in March, in the great turmoil of March that we all went through, in which there was widespread sheltering in place, economic shutdown. And this was designed as a short-term cash flow injection for small businesses, specifically businesses with fewer than 500 employees. And that cash flow infusion was meant for those funds to be used to continue to keep employees employed, avoid layoffs and furloughs in companies around the country. And those funds were to be specifically used for that purpose. Our banking relationship was critical throughout the process of us, Circle City Broadcasting, procuring and securing our loan through the PPP program. We had an existing depository and lending relationship with our banker. This was really important because as this program was being rolled out, some of the details were kind of changing on a day-to-day basis. As you know, Congress kind of cobbled this together really quickly with the end goal of getting money out to the businesses as quickly as possible. So some of the rules as far as from the application process, how the funds were to be used, as well as some of the repayment things were a little murky, and we relied heavily on our relationship with our lender to kind of help us navigate through that process and get an understanding of that. Additionally, $349 billion sounds like a massive number, but we knew that number was finite, that those funds would be spoken for sooner than later. And it was imperative from our perspective to be at the front of the line when those applications were to be submitted. And so our relationship allowed us, with that constant back and forth with our bank, to ensure that we were at the front of the line when it was time to submit those applications to the SBA. From a timing standpoint, basically on April 1st, we requested an application from our bank. It was a relatively simple 2-page application. We filled that out, turned it around with some supplemental information, and had the application back to our bank the same day. The first day that applications could be submitted to the SBA was 2 days later, April 3rd. So in the interim process, we're going back and forth with our bank, making sure we're on top of everything, that we've crossed all our T's, dotted our I's for our application. As we're waiting to hear back from the SBA, whether our loan has been approved, whispers start coming out that basically that entire fund, that $349 billion, was already spoken for. And it was, thankfully, our bank was very forthcoming and said, trust me, you guys are okay. You're going to make it. Your loan will be secure. But if we hadn't been at the front of the line at the time, it's uncertain whether we would have been able to secure our loan. A full 2 weeks after we submit our application on April 17th, our loan was confirmed, our money was deposited in our account, and we were ready to go. And I attribute a very significant portion of that to our relationship with our lender and that constant communication back and forth. As far as the terms of the payback of the loan, basically the loan has a 2-year maturity date. Originally, the payments were deferred for the first 6 months of the term. That has since been extended to 10 months. So basically you have 10 months before you have to start repaying principal on the loan. Interest rate of 1%. So it's basically free money. So it was, a fantastic experience for us. And then there's a loan forgiveness provision there. So as long as you can, in detail, prove that you spent those funds on payroll, employee benefits, expenses, mortgage interest, rents, and utilities, up to the entirety of that loan can be and may be forgiven. And currently our company is just about to engage in that forgiveness application process with our bank. In addition, finally, no collateral. Dewan alluded to his previous experience where collateral was required, as well as personal guarantees. No collateral and no personal guarantees with the PPP loan. So very, very helpful, relatively simple process as long as you knew who to go through. And our bank was critical with that.
Yeah, and this is Garret. I could sort of chime in. I actually literally handheld a couple of my clients through the process, which, as Ty indicated, there was a very short time frame and a limited amount of funds available, and the concern was that the money would be gone. So there was a premium on, one, getting your application in quickly, getting the information correctly so that it could then be submitted to the SBA for processing. And I will tell you that there was a heavy amount of hand-holding that I did with my clients, because I think without that, a lot of these clients would have been lost or the money would have been gone. And I've been literally through the whole cycle. As Ty indicated, this same client that I did the hand-holding with has actually submitted probably 2 weeks ago their documentation for forgiveness under this PPP program. And I will say, speaking for our organization, our bank was definitely prepared, given sort of the challenges that we had on the front end. So this client, we automated the process. We sent them out a notification saying, okay, our portal is open for the forgiveness program. My client submitted their information, and literally within 48 hours, our staff reviewed the documentation, confirmed that it was consistent with the SBA's guidelines, and we've approved it and is now sent to the SBA for their review. And again, it's a very, as Ty said, a handheld process, because without it, it's extremely difficult to sort of navigate, what forms and how to get things through. But anyway, I could speak. That's the situation. Yes, Dewan.
So we're getting questions in now. And friendly reminder, if you have a question, please send it to livequestions@fcc.gov. livequestions@fcc.gov. This question is for Ty and for Garret. First is for Ty. From a CFO standpoint, Ty, what is the single most important element of a banking relationship from a CFO standpoint? Then that same question will be asked of Garret from a banking relationship standpoint.
That's a really good question. I'd say from my perspective, I've found that making sure that we are always systematically buttoned up has been really critical for this process. And not just for this specific example, but from a long-term banking relationship.
Wonderful. Garret, same question for you. From a banking relationship, the other side, what's the most important thing?
I would say over communication. I think that with any of these government-backed programs, you're not really dealing with a individual on the other side. You're dealing with a portal / website, and a lot of times you feel like you're in the dark. So the way our process was set up at US Bank, we over communicated. Yes, we confirm receipt of your documentation. We've confirmed that we've approved it. The just over communicating, I mean, it's a two-way street, so that both parties are aware of where everything is, because again, people don't want to operate in a vacuum, and again, you're never going to be faulted for just walking along with folks. And as Ty can attest, during the initial process of the PPP program, the goalposts were changing because of political events and also bad PR when they rolled out the program. So it was an evolving process. You had to be nimble, and you also had just to be aware of what was going on in terms of they were changing what % of the program could be towards salaries, rent, and other items. Again, over communication and just being informed.
Garret, that's a great segue into yours and Damon's or Dan's presentation. So you can keep talking about, if you don't mind, financing during normal times.
Yeah, and one last point before we actually get into our segment of the program. There's another program that has gotten some press. It's called the Main Street Lending Program. It's about a $600 billion program that is really geared to help folks sort of transition during COVID-19. The one challenge or the major challenge of that program is just the number of qualifications that you have to check to be able to get access to it, are pretty daunting. And I saw a statistic that of the $600 billion program, less than 1/3% of the program has actually been used, which is indicative of the challenges that that program, how it was set up. That being said, one of my broadcasting clients was able to access that program, and the program is pretty good in the sense that if your leverage profile was below 4 times heading into 2019, basically the way that their deal was structured, no interest payments in year 1, no interest only in year 2, 15% amortization into years 3, 4, and 5, and then you have a complete refinancing thereafter. But given that sort of runway, and it's my understanding that there aren't any financial covenants that I'm aware of, so that it gives the broadcaster an opportunity to sort of navigate the business, as opposed to quarter, a little bit more runway and flexibility to navigate things. So again, I throw that out there. It's it's another government program, but the requirements are pretty specific.
Garret, let me understand. Before you start, I just want to make a sort of high-level comment. So as we get into our presentation, we're kind of distinguished between financing during normal times and obviously the current situation. And I just want to sort of reiterate to people, I think the issue we're having right now during COVID, at least on the banking side, is obviously given where we are in COVID and now we're heading into the winter and things could get materially worse, as they seem to unfortunately be doing in the country from a virus perspective. It's very difficult to project, where people's cash flow is going to be going over the next 6 to 12 months. And I think because of that, that's probably the reason why, traditional financing out of the banking market is almost, unattainable because you have no ability to project. And, while we could all argue during this situation, should we be more flexible? Well, the regulations that we are under in the banking community by our regulators have not changed at all. What the rating agencies require us to do hasn't changed. So I think, the success of the PPP program was actually, it's rare, but it was a great example of if the government, the Congress and the executive put something together with the banking community, that program worked great, but it required essentially the assistance of the government because the government guaranteed all those PPP loans. But for the government guarantee, that program would not have been successful. So the only comment I'm trying to make is until we get out of the COVID situation, I do think unless there is essentially government assistance, backing, getting financing, particularly for new or small operators, will be very difficult because of the inability to understand where the cash flows will be going over the next few months.
Yeah, Dan, that's a great point. You reminded me of a couple things. One, as Dewan said at the outset, Dan and I have been involved in the broadcast space for an extended period of time, and we've been through a number of cycles. We went through the financial crisis that Dewan, lived, and we're now in this COVID cycle. And I will tell you that this is vastly different, and the speed and the depth of how bad things got so quickly is unlike anything we've ever experienced in our careers. As Dan said, this is a difficult time. It's very challenged to try and get financing in this market. We're in a unique position as a lender to the broadcast space and other media businesses. We can see how the other, generally speaking, it's been very, very challenged for radio broadcasters. I think the TV and out-of-home companies have recovered quicker. It's a challenged environment that we're in. And again, just sort of wanted to at least give folks an appreciation of what the market's like today. So I just want to sort of jump into, under normal times, as a lender in this space, I guess our guidance to potential owners, my advice would be, look, as Dewan indicated, this is a very specialized area of lending. And if you're looking to buy, a radio station or a group of radio stations or a group of TV stations, my advice is you want to go with someone who's done this before, because again, you want someone who's been through cycles, that if there's a hiccup, you don't want your lender panicking or things change. And if you've dealt with an experienced lender, I think it will make a better experience for all parties. That being said, it's a tough market that we're in today, and trying to be a first-time owner operator and getting financing, as Dewan indicated, you go where you can get the money to at least get your foot in the door. But to the extent that you've got an opportunity to borrow from an experienced lender, that would be my advice. An equity provider, any bank is going to want to see, as Dewan indicated, skin in the game, and that there's a cushion below their debt in the capital structure. And as a lender, we want to make sure that who's providing that equity, have they done broadcast deals before? What is their track record? What is their, how have these guys performed in their other investments? Do you take comfort from them? Do they have the financial wherewithal to support this investment if things go sideways? And then in any loan that we look at, proven and relevant management experience is critical. coming in without a track record, it makes it, again, it's another challenge as lenders, whether the person has the financial and management skills to run a broadcast company. Next slide, please.
Hey,
Yes,
we have one other question that just came in, and the question is, if I'm a new entrant, how do I know who has experience in lending to broadcasters? How do I know that?
Yeah, a couple things. You attend conventions, you network with other operators, you speak to brokers, you read the industry rags, who's financing what deals, and Dan, any other comments?
Yeah, no, I would also say, if you speak with your local banks, in whatever area you live, while they may not be in the business, they are likely to do business with larger institutions that might have dedicated, expertise. So, and as well as, obviously, if you're working for a company, I mean, someone will know someone who will know. I think if you ask enough, eventually someone will know. If you could talk to a local lawyer, I mean, there's enough people to talk to who would know someone to get that information. It just takes a little bit of time.
So one of the things, so that everybody knows, one of the things that came out of this diversity committee is having a location on websites that identify banks and lending institutions that participate in broadcast lending. So it's not finalized yet, but we're working with advocacy groups like MMTC, NAB, NABOB, and using their websites and portals to identify lenders like US Bank and other finance lenders, so that women and minorities and diverse individuals will have a place and a know-how on who's lending money.
Yeah, if I could just continue on. So what are the other things that we look at when we're evaluating a prospective transaction? And at the top of the list here, we've got multiple markets, and that's, as a lender, we want to make sure that we've got diversity in markets and also by geography. If you're lending to a single market, all your eggs are in one basket. You're relying on that single station, single market. And as a general rule, we and most banks have not done single market, single station deals because of the lack of economic, geographic, and market diversity for obvious reasons. You could have a competitor come in and go head to head with you, or the major employer and advertiser in the town pulls out. So it's obvious that, generally speaking, again, there are exceptions to all these rules, that you want to have multiple markets, and either in different formats, different size markets, different geographies, just for diversification of risk. We also, for any lender, they're going to ask for financial projections, typically 5 years with detailed assumptions. And as experienced media lenders, we have a general sense for, how markets generally are performing. If someone's forecasting 20% growth, that's probably unrealistic. So again, you want to be realistic and somewhat conservative, but at the same time, you don't want to, be too conservative, because that will reduce the amount of the loan. With respect to the actual acquisition or target, we want to know, what is the condition of the assets that you're buying? What price did you buy? Does it, as we discussed previously, does it include real estate, the towers, land, other assets? And again, to sort of put all this data or statements that we put together, we'll use a case study of DeJuan McCoy. Probably 5 or 6 years ago, I got a call out of the blue from a private equity investor that I've done business with for an extended period of time, highly regarded, great track record in the space, highly knowledgeable. We have financed other deals with this private equity investor, all of which have performed phenomenally. Gives me a heads up saying, hey, there's a entrepreneur that we're backing. Guy's only in one market, it's got 2 stations, but he's a great operator. And being a banker, typically when you hear one market, the initial reaction is, that's probably not something we can do. And again, very skeptical just because of the lack of market diversity. So then I actually get a call from Dewan McCoy, who I had never met, had a very long conversation with him, I asked him a number of pointed questions. His responses all came back. And as I started to peel back the skin of the onion, I'm like, wait a minute, there may be an opportunity here. And as opposed to just saying, no, we're not going to do this, I asked Dewan for more information, and Dewan gave me some color about the price that he paid for the assets that he was looking to acquire. And as I began to dig more and more in, I'm like, okay, there may be something here. And then as Dewan referenced, he ended up acquiring those stations in 2007 at the height of the financial crisis. And we looked at what Dewan had done with those stations during, at that point, one of the most challenging times in the industry that we had experienced pre-COVID. And his performance of those stations was phenomenal. These stations weren't cash flowing. He was able to turn them around and made them cash flowing properties during one of the most challenging times, in recent history. And that spoke to relevant management experience and track record. And you're like, that's one of the questions a credit guy will ask us first. Well, how did this person do during the economic downturn? And truth be told, Dewan killed it. And he ended up selling those stations, did phenomenal for his investors. So again, that checks the box of relevant management experience and track record. Then the question is, well, Dewan, who's your equity? And he explained who his equity source was, well-known, highly regarded, gave us tons of comfort that one, they had the financial wherewithal to support Dewan. Dewan also had skin in the game, and these guys have done this before. So again, this thing's starting to look like, hey, we may be able to do something here. And, sort of cutting to the chase, ended up going to our credit guy, and lo and behold, we got the deal done. And Dewan performed phenomenally. And through Dan, Damon, myself, and we were able to put Dewan in touch with a potential buyer. And Dewan sort of ran with it from there, and boom, great outcome for Dewan McCoy. And it's an example of typically someone that would have struggled to have gotten financing, but checked all of the things that we highlighted with a couple of exceptions. And, it's a case study of one, Dewan not accepting no, and two, the fact that his actions, spoke for themselves. And Dewan and Dan, I don't know if you want to add anything to that.
Yeah, no, just a little, so keep the process moving. I mean, look, Garret outlined a number of things that a bank would look for. Obviously, every situation is unique, and certain situations you're not going to have every item on the list that Garret went through. So it's not necessarily, obviously they're all good to have. I would also say, while for example, our bank is a relatively large organization, and so we have certain criteria in terms of minimum size, minimum markets that work for us, but that's our strategy. So just because something in our strategy might not match your loan, every bank has different strategies and different ideas of things to do. So don't assume just as, we would prefer, multiple markets and a minimum size for the company might not work for us, but other banks could do that. And I guess the last thing I would say to add to Garrett's points, when we talk about relevant experience, obviously there are a lot of people who are trying to get into the business who are not owners today. They might work for a large organization as, a market manager or program director or a sales manager, et cetera. But that is relevant experience. And so I think the last thing I'd say in terms of the broadcasting business, I think as compared to a lot of businesses that we lend to, it's probably the most management intensive. So not to say other industries are not, but look, other industries, if you're making widgets, widgets are widgets, right? It is what it is. Broadcasting is heavily dependent on the quality of the people who work in that business. And therefore, backing the right people is critical. And so, look, if you're the manager of a particular market, that's fine. You obviously have experience in that market. You have in that market. You have other operators. So maybe you've competed against companies A, B, and C, and you can use them as, a reference to your bank. Hey, my competitor works for, XYZ large, TV radio company, they'll know the banker. So there's a lot of angles you can go about in terms of establishing track record. And then in terms of the equity source, the last thing I'd say on that is I know, in Dewan's case, on the deal that he worked with Garret originally, he had a very large organization that was well known. Look, a lot of small initial transactions, you're really dealing with friends and family. So I think as Dewan started out, in his original presentation, the seller in that case wanted to see his bank account. It's at the end of the day, it's the cash. How much cash is there? So you might not have, KKR sitting behind you, but if you have enough liquidity and you cobble together from your friends and family that you have cushion, at the end of the day, that's what we care about. I mean, it's nice to have, Warren Buffett as your partner, but, if you have X dollars in the bank, nothing beats cash in the bank. So moving on, some of this is a little repetitive, some of the stuff that Garret said, but I would say in terms of, and I mentioned this before, you should have a strategy. A lot of the issues that I think people have in terms of obtaining financing is they take the perspective, a broadcast asset, whether it's a TV or radio station in a market, it's similar to other stations. Well, that's not a strategy. I might be correct at the end of the day, but you need to think through, particularly now as the world changes and there's a lot more focus on online and digital, et cetera. Your bank is going to ask, well, what is your digital strategy? What is your online strategy? So you need to think through, where do you want to bring your company? If it's a TV business, some small markets don't have a news segment. They, get the news from someone else. Do you want to be in the news business? So having an idea of what you want to do, I think, is critical because it shows your potential lenders that you're thinking through these things. The second item on this list in terms of audits and stuff like that, I guess the point there is, when you're buying the station, just from your own due diligence, we need to see how the station is operated prior to you buying it. Obviously, the best thing is an audited statement, but many times you're buying a small station or a small group of stations, there is no audit. So you might have to, hire an accounting firm to do some high-level quality of, earnings, we call it, but you need some sort of data, historical, that we could look at. The last thing I say on this page in terms of projections, look, projections, they're very difficult to do. Sometimes people look at them as sort of a difficult exercise. If you project something that's too positive, then you're going to get a set of terms from the bank that will tie you to something that's too positive. If you get a set of projections that's too negative, then the lender's going to say, wow, that looks pretty bad. So the only thing I would say in projections is you should really put down what you think. Particularly, look, you're going to be in a market. It's unlikely the assets you're buying in market A are going to be 50% better than your competitors or 50% worse, unless there's something going on. So particularly now in COVID, we expect the numbers to be bad, but if they're realistic and there's a turnaround at some point. So I think when you come up with projections, like anything in life, the best policy is to say what you think. The next page, please.
Dan, one quick thing to jump in on. I've always found it, at least from my perspective, with projections, it's important to be able to explain the assumptions that underlie those projections. So when you're putting together that business plan, bankers are going to ask, okay, so what makes you think these projections are realistic? You better be able to rattle off why you think that those will be in the ballpark and what you can do to hit those numbers.
Fair point, exactly. I mean, I think, again, when you come up with these assumptions, it gives the lenders a lot of comfort that you thought through why And look, you might be right. It's like you're predicting the future. You might be right, you might be wrong, but the basis of those projections will go a long way to you getting your lenders comfortable. In the interest of time, I mean, Section G here, you could see kind of the typical terms that most banks ask for. And I would say, the only thing I'd say there is, look, lenders don't want to put together a transaction that blows up quickly for whatever reason. We want these things to work because obviously we want to get paid back too. So it really is a partnership. I know sometimes people hear horror stories about lenders, and some of them I'm sure are true. But I think for the most part, we make money by doing transactions. If we're not professional, if we're not reasonable in a deal we do with Dewan today, then we're not going to do Dewan's deal tomorrow. And if we're not, negotiating it with integrity with Ty, he's not going to want to negotiate with us. So it is a two-way street. And obviously, the main purpose of this panel is to discuss access to capital, particularly for women and minority groups. And I would say, like most things in life, it really is, day by day, individual by individual, deal by deal. And so, the hard work that goes in. I mean, Garret and I, we speak at the broadcast leadership training event every year. We participate in these events. Obviously, there's professional benefits for us to do this. There's personal benefits, but I think, if we want to have change and create access to capital for as many people as possible, because that's obviously the right thing to do, and it's also the most economically profitable thing to do, it's events like this. And the last thing I would say is the power of networking. So we've gone to some of the BLT events at the FCC, and then people who have attended those events have followed up. We've had, pre-pandemic, lunches and dinners with prospective people who are looking to get into the business. So I think the power of networking with people like this is key. And, even if you don't know a banker, if you have a relationship with Dewan, if you met him on this panel, Dewan will call us or a bank and say, hey, I'd like you to talk to so-and-so. So I think ultimately for everyone to be successful in this effort, obviously there are other discussions today regarding things that the United States government can do, which is important and that's separate. It really is individuals making the effort to do it. And I think day by day, I think we'll create more of these situations, and we'll be successful in having the capital available for as many people as possible.
As we wrap this up, fellas, we have one last question that came in. Is now a good time to buy from the standpoint of you want to buy low and sell high?
I'll jump in first. I would say, again, the answer is yeah. It's always good to buy low. The challenge you have, again, depending on which sector, is it radio or TV? With respect to COVID, we're in an uncharted territory, and the impact that COVID has had on historical financial performance, and then trying to forecast what future performance is going to be in a, we all hope, post-COVID world is tough. My sense is there hasn't been a lot of deal activity yet, because I think that people, they're just, for lack of a better word, there's discovery or unknown about where values are today. And yeah, will stuff start moving? I think eventually it will, but trying to figure out, what a TV station or a radio station, a radio or TV station is based on the uncertainty from COVID makes it a challenge. I throw that out to Dan or Ty. What are your thoughts?
Yeah, look, I'd say at a high level, it's a brilliant strategy. I would say the only thing you need to be prepared for is, we could be in, for another rough 6 to 12 months. So you got to have a lot of comfort that, a year from now, the cash flows of whatever entity you're buying are going to be where you think they're going to be, so that you are in reality buying low. But all things being equal, if we view this situation as turning the corner, hopefully within the next 12 months, which is a reasonable assumption, it's a great idea. And the last thing in terms of the financing, look, you might have to pay a lot and might have to go to some non-traditional lenders or use government lenders, but you can find people. It's just the terms might be very onerous, but if you're comfortable with your business plan and you're able to risk all the equity capital you put in, it might be a good time to do it, but it's a very risky thing, but it's doable.
Right, and to dovetail off of that, I think it's also important if you go into that transaction, you better have a longer runway of working capital available to you in case, typically they say between 3 and 6 months at the outset. May want to extend that a little bit, make sure you can navigate a potential blip that comes up in that first period of ownership.
Well, guys, we're going to wrap up. Any final words or parting shots from you guys before we send it back to Caroline?
Now, on behalf of U.S. Bank, I'd like to thank you, Dewan and Caroline, for letting us participate in this panel. As Dewan mentioned, Dan and I participate in the broadcast lending training program, and we view our participation in this panel consistent with that. We're trying to increase the number of voices and representation of both minorities and women in the broadcast space.
Yeah, and from my perspective, I really appreciate being here. It's been a real pleasure.
Yeah, likewise. I add to the comments that Garret, Dewan, and Ty made that we appreciate being here, and obviously like to thank the FCC. The FCC does a fantastic job trying to bring together all the relevant parties to get to the right solution. So we appreciate all their efforts and look forward to continuing whatever we can do for the industry.
Yeah, this has been a fun 10 months. Most of you people don't know that this has been in the works for quite some time. And we do weekly conference calls and weekly video sessions to try to inform folks on things that we know. So my appreciation goes out to the FCC for giving us this platform to do this. This has been a great administration for diversity. And we only hope this type of dialogue can continue because I think it does have a long-term impact on the way broadcasting stations look in America. So thank you so much, and I'll kick it back to Caroline.
Next, we are heading over to Nahuja, who will be talking about tax certificate policies. And Nahuja, let me hand it over to you. But again, thank you, Dewan and Dan. Presentation. It was very informative.
Okay, thank you, Caroline. Good morning, everyone. That was a fantastic session by our Lending Finance subgroup. Kudos to the subgroup lead, Dewan McCoy, and his team for affording us such a fine range of panelists to share this important information. We learned indeed that even when banks are not anxious to lend money, that there are some very real priming the pump strategies that station owners or aspirants can use to position themselves to maximize opportunities that may arise. And yes, this applies even in times of an economic downturn or, like now, a health pandemic or even political uncertainty. As a subgroup of the Access to Capital Working Group, under the leadership of Caroline Beasley, we, like the other working groups, have a general mission to develop and highlight recommendations that we feel will support the FCC's mission. In our case, diversifying management and ownership of broadcast properties that are part of the publicly owned airways. Our political subgroup's focus this year, as a result, has been on legislative proposals for policies that support diversity of management and ownership of stations. There are any number of such legislative offerings in Congress, 2 of which will be addressed in our section of the symposium. The political subgroup section of the Access to Capital Working Group Symposium will be in 2 parts. Part A is the tax certificate policies and ownership diversity will feature presentations, and Part B, the impact of tax certificate policies, will feature a co-moderated panel discussion. In Part A, today we are featuring Representative G.K. Butterfield's Democratic North Carolina Expanding Broadcast Ownership Opportunities Act 2020, which is the tax certificate bill number 3957 to reestablish the FCC's minority tax program that ended in 1995. Also, we will call attention to Representative Greg Walden's Oregon Broadcast Diversity and Leadership Act bill, number HR 3154, to enact a federal incubator program led by the FCC for established broadcasters and emerging broadcasters to enter into a qualifying incubation relationship. Presenters will provide information on this legislation. You can find in-depth biographies for all presenters, moderators, and panelists in the symposium program. However, let's begin Part A with a brief introduction. Our first presenter, David Honig, is President Emeritus and Special Advisor to the Multicultural Media, Telecom, and Internet Council, and a member of the political subgroup. He will provide a contextual elucidation of the tax certificate discount, including why it came into existence, what it accomplished from 1972 to 1995, and he will touch on why, despite being successful, it expired. I will follow up David's presentation with a quick update on the status of HR 3957, briefly where it is in the markup process and how it has been amended. After my update, our final presenter in Part A will be Kate O'Connor, who is Chief Counsel for the Subcommittee on Communications and Technology on Energy and Commerce in the U.S. House of Representatives, and who will present on the Broadcast Diversity and Leadership Act. I will introduce her again before her presentation. Now, back to you, David, for your presentation on the tax certificate discount, the tax certificate bill that was in existence from 1972 to 1995. David?
Yes, thank you, Nahuja, very much. I apologize that my video isn't working this morning, but I hope you have audio. Can you hear me okay?
Yes.
That's great. So go ahead and put the slide deck up, and let's look at the first slide. I have the privilege of providing the history, the historical context, and which will help us understand how we went from zero minority ownership to what we have now, which is still very small, but it's a few hundred stations. This month actually is the 100th birthday of the commercial broadcasting industry. 4 generations we've had. And for the first 2 generations, there was no significant minority ownership, no more than 2 or 3 stations at all. If you consider the fact that this is using public spectrum, where everyone has an ownership at stake, it's often been suggested maybe if the commission just raffled off the licenses or picked them out of a hat, you'd have more diversity. But in this case, there is a long history of why it was that there was no minority ownership for months and months and years and decades and decades. In 1932, the FCC didn't exist. Its predecessor was the Federal Radio Commission, which issued a ruling to the effect that an applicant, even if otherwise perfectly qualified and unopposed, sought a broadcast license for what was then being an AM station. It will be rejected if the applicant proposes to serve so-called niche audiences. In that case, if they were going to serve African Americans, they weren't serving the entire community and their application would not be considered. Needless to say, there was no commensurate requirement that broadcast stations owned by others had to serve the entire community, which included African Americans. So it was just one way that went. If there was any doubt about what this precedent really meant, there were 3 cases from 1936 to 1940 relying on this as precedent in which the commission held that it would not grant applications of perfectly qualified Jewish broadcasters because they proposed to put some of their programming in Yiddish. Let that sink in for just a minute. So here we are, while all of the best frequencies were being made available for free, but not to minorities. And you ask, well, this ended in 1940 or 41, of course, after World War II started. But the 1940s is within the living memory of a lot of us. I was born in the 1940s. This is very recent. We've had a sea change of which the tax certificate policy was this culmination. So what happened? Well, it wasn't, this deficiency in minority ownership wasn't because there was a lack of training, ability, interest, entrepreneurial zeal. Since the early 19th century, there have been over 3,000 newspapers and several magazines that were owned by people of color. There was no federal newspaper commission that holding back their ability to get in or serving as a gatekeeper. In the 1970s, there were two DC Circuit decisions which greatly influenced what later became the tax certificate policy. One of those was called TV9 versus FCC, which involved what was then called a comparative hearing to see who would win a broadcast license where there were mutually exclusive applicants, where the court said that the primary objective of maximum diversification, and you can show the next slide because it's up here, the slide that says before the adoption of the tax certificate policy, maximum diversification of ownership of mass communications in a comparative license proceeding would afford favorable consideration. The commission should afford favorable consideration to an applicant, which gives a local minority group media entrepreneurship. We hold only that when minority ownership is likely to increase the diversity of content, especially of opinion and viewpoint, merit should be awarded. So it had to be a factor in the granting of licenses. There was that, for those who want to look it up, it's 495 F. 2nd 929, 1973. Another DC Circuit decision, 2 years later, Garret versus FCC, 513 F. 2nd 1056, extended this to whenever the commission does a engineering tweak to its rules, what's going to be the impact on minorities and women, that had to be taken into account. And it was interesting that this happened at a time when the commission actually had begun in slow, halting, and not always completely understood ways to try to do something about the exclusion of minorities from the airwaves. The FCC in 1969, at the urging of the United Church of Christ Office of Communication, and internally its general counsel, Henry Geller, who just passed away at 96 this year, made the FCC the first federal agency to adopt rules requiring equal employment opportunity, non-discrimination in employment, by its licensees. So you had almost an explosion of opportunity at the employment level, and by the late 70s, many managers who had gotten in because of their ability to break through the discrimination barriers had the skills to become owners, wanted to be owners, but there was little opportunity for them to become owners. So go to the next slide, which says origins of the tax certificate policy. The advisory group that we're all on this call is actually the 5th federal advisory committee focused on minority ownership policy that the FCC has had. The first one, and my friend Jim Winston and I either served on or staffed all 5 of these. This was the first one in 1977, convened by Chairman Ford's FCC chair, who was held over in the next administration, chairman in the Carter administration. That was Dick Wiley. The Minority Ownership Advisory Committee task force was charged with arriving at new proactive policies to advance minority broadcast ownership. Chairman Wiley's successor, Charlie Ferris, then led the commission in a unanimous vote in 1978 to adopt 3 minority ownership policies, by far the most consequential of which was the tax certificate policy. That site is 68 FCC 2nd 979. The commission made it very clear that adequate representation of minority viewpoints in programming served the needs and interests of the minority community, and also enriched and educated the entire audience. Now, how did this work? Go to the next slide, the one that says tax code element of the tax certificate policy. The tax certificate policy, which we refer to loosely in those words, actually was derivative of an earlier policy, also called the tax certificate policy, that applied initially to what would happen if the commission required involuntarily a divestiture of a station because of it bumped up against the ownership rules, and they wanted to have more voices. So one way that the commission found after and ultimately Congress approved was to have tax certificates to alleviate the hardship of these involuntary transfers. And then in 1970, authorizing them for voluntary sales, such as breaking up a TV and a radio combination in the same city, or TV and a newspaper combination in the same city. In those transactions, and this is the critical element, is how did this work? The seller was permitted to defer payment of the tax on capital gains, provided that the seller reinvested in comparable property, for example, the stock of another broadcast company. So that was to minimize the impact on the Treasury from this transaction, from these transactions. And of course, it's always better to pay taxes on income tomorrow than income today because of inflation. So it provided enough of an incentive such that if you were the seller and you were going to have a capital gain at the end of the sale process, you didn't have to pay the tax right away. So you can go to the next slide. In 1978, what the commission did was it took this policy that had been used to promote structural diversity and included in it promoting racial diversity, where the buyer's majority equity interest was held by minorities, and there was a substantial likelihood of increasing diversity of programming. Now, the commission had this policy in effect through 1995. And since then, in what are called the Section 257 reports every 3 years to Congress on diversity, the commission has always asked for it to come back. Why would that be? Well, it quintupled minority ownership. At the instant when the commission adopted the tax certificate policy in 1978, there were 60 minority-owned radio stations, one television station in the whole country. It quintupled minority station ownership until Congress terminated the policy in must-sign legislation, a tax bill dated April 13th with the tax filing deadline due April 15th. And since then, MMTC, NABOB, other organizations, and the NAB have been trying to get it to come back. It has been an uphill slog because it's a tax bill. There have been several introduced previously by Congressman Rangel, Congressman Rush, Senator McCain. They had the first one, actually, and Senator Menendez, but they didn't go anywhere. We'll get to that in a bit. One question that has often arisen is, well, was the program taken advantage of by bad actors? I had the opportunity to review over 200 tax certificate transactions several years ago and was only able to identify a single one that ever was found to involve fraud. That's a pretty good record when there were over 200 tax certificates given. So why should this policy be reinstated? You can go to the slide that says, why should the policy be reinstated? And first is, of course, to help minorities with this dreaded issue of access to capital by having an opportunity to do deals and to have multiple stations in the deals and bid with some advantage, even if it was slight, against other owners, other potential bidders. So it was a way to help minorities grow their companies, use their skills and backgrounds to compete in the marketplace, and help advertisers reach the entire public. Why is that so important? Well, you'll be hearing from Sherman Kizart and his clients, his co-panelists later in the program today, why that's so important. Look at the next slide, where additionally the policy would identify ratings measurement metrics by attracting sustainable advertising revenue from local and regional advertisers, help the broadcasters attract the patronage of major advertising agencies, and of course, provide information that's critical, such as government advertising campaigns. Now, why is this so important? What's this interest with the advertisers over the years that if you read the various Section 257 reports and so forth that keeps coming out? Well, because every asset promotes economic well-being of the nation if it can be put to its higher and better use. May not be ever possible to have the highest and best use, but the higher and better uses may be, and often were in the case of these tax certificate transactions, the buyers who were hungry to serve new markets that had not been served previously by other broadcasters who didn't have the cultural competency, the knowledge, the staff to serve these new markets, such as those consisting of African Americans, Latinx communities, and so forth, and also to serve audiences speaking different languages than English. By opening up a direct means to reach those audiences, advertisers benefited because they could better have an ad buy reaching everybody, and thus their clients generate more revenue and become higher taxpayers. Minority-owned broadcasters, of course, by being able to get in with a bit of a head start, were able to have successful companies and thereby become better advertisers. So I've always believed, there's not been a detailed study, that any slight impact on the Treasury from the program is probably vastly balanced against the very great impact of this policy on the media marketplace, thus advertising, and on the ultimately building businesses that then pay more taxes at the end of the day. So our working group, of course, recommended that because this has been a profoundly successful program, Congress and the FCC should consider reestablishing it. We have to recognize a couple of caveats. It is not a cure-all. If the station does not have a capital gain that's being sold, it's not going to be eligible for this policy anyway. It only works where where you're capturing higher value that you built as a seller, and thus the buyer helps gain. That's when it applies. Often these days, there will be many transactions where there is no capital gain, there's a loss, and someone's just getting out. So it doesn't work for every deal, but it works for a lot of deals. The perfect shouldn't be the enemy of the good. The Butterfield bill, you're about to hear a discussion of it, but just to highlight a few critical provisions within that legislation that Congressman Butterfield is the lead on. There is a $50 million limit on the size of a deal that would be eligible, so as it wouldn't be regarded as a rate on the Treasury. It shouldn't be anyway, because the alternative is just a tax-free exchange. But in fact, that was in response to those who felt that a very, very large deal would be detrimental to the Treasury. The commission is supposed to have a rulemaking after adoption of the legislation on how long the holding period has to be. If you're the minority broadcaster, can you flip it right away to somebody else and just pocket the difference in value? Or do you have to hold it, and the Congress would be saying either 2 years or 3 years or somewhere in between, but let the FCC as the expert agency figure it out. It also does not specifically apply to minority, that is racial minorities. The classification in the legislation, and I'll just read this, is socially disadvantaged individuals, which means a woman or an individual who has been subjected to racial or ethnic prejudice or cultural bias because of the identity of the individual as a member of a group without regard to the individual qualities of the individual. And the commission, of course, following federal law, in order to have this classification approved, would be required within 60 days after the enactment of the statute of the bill, that the commission shall institute an examination, I'm reading from the legislation, of whether there is a nexus between diversity of ownership or control of broadcast stations, including ownership or control by members of minority groups or women, or by both members of minority groups and women, and diversity of viewpoints expressed in the matter broadcast by broadcast stations. So that's where it sits, that's its history, and Hooja, I'll turn it back over to you.
Thank you, David, for that excellent and contextual presentation on the original tax certificate program that was a gateway to increasing broadcast station ownership diversity. Now I'm going to give you a brief update of the tax certificate bill to reauthorize the same kind of tax certificate as David discussed. The current proposed bill is HR 3957. It was first introduced in the House on July 25th, 2019, as the Expanding Broadcast Ownership Opportunities Act of 2019. That bill required the FCC to increase diversity of ownership in the broadcasting industry. Specifically, the bill allows companies engaged in the qualifying sale of a broadcast station to receive favorable tax treatment by electing non-recognition of the gain or loss resulting from the sale. This is pretty much what David was going through in the last part of his presentation. To qualify for this treatment, the sale must result in or preserve ownership of a broadcast station by a socially disadvantaged individual. The bill also requires the FCC to foster investment in broadcast stations owned by socially disadvantaged individuals. So this 2019 bill was amended in March of 2020. And in that, it was renamed the Expanding Broadcast Ownership Opportunities Act of 2020. And in September 9th specifically, the House accepted the amendment by voice vote and reported it out. Then there was an action by the Committee on Energy and Commerce. So it went out of that committee, and that's pretty much where it is now. But what were the amendments accepted? Were there any major differences, and what is the progress included in that amendment? The Butterfield amendment that was accepted was in the nature of substitution of wording in specific sections. The main takeaway was that there was no discount for cable in the bill. And as David mentioned earlier, the definition of socially disadvantaged individuals now included women and minorities. It also included in the enhanced ownership report. It also kept the enhanced ownership reporting. So as I said earlier, it was reviewed and later passed out of conference from the Committee on Energy and Commerce, and it was referred to the Committee on Ways and Means. The specific language that I referenced was in Section 344 and also in Part 5, Sections 5 and 6. David has indicated some of those, but for Section B, the changes added a control requirement. So the sale should be one resulting in or preserving ownership and control by socially disadvantaged individuals, regardless of whether the station was owned by socially disadvantaged individuals before the sale. And where the sale described investor, sale by an investor that is owned and controlled by a socially disadvantaged individual. So the control element was an important addition to that. For subsection C, David also mentioned most of those. The price limit changed from no lower than 10 million to no higher than 50 million. And that, of course, reflects recognition of the changes in costs associated with purchasing stations. And the second rule was the minimum holding period changed, which was originally 2 years, it was originally 2 years, and it changed from no longer than 3 years, but no shorter than 3 years. So the substituted language required purchasers to at least hold the station for 2 years. And in the final subsection, there was some discussion about definitions, including the 51 ownership requirement, and in which case, except in the case of a publicly broadcast station, in which it became 51% of the voting stock rather than just the ownership. And in all these cases, it did refer to socially disadvantaged individuals. There was a few other changes in the former bill. They basically took the incubator program out and also did some other cleanup in terms of the definitions to make sure that the bill was accessible by women and minorities, and therefore would withstand some of the strict scrutiny that the previous tax bill did not withstand. So that really is just the update to HR 3957. And now we're going to turn to another tax certificate legislation designed to promote broadcast ownership diversity. And that's the Broadcast Diversity and Leadership Act bill, which is HR 8154. Here to provide us with that information is Kate O'Connor. You, as I said before, can find a more in-depth biography for her in the Symposium program. Kate O'Connor is the Chief Counsel for the Subcommittee on Communications and Technologies with the U.S. House of Representatives on Energy and Commerce. She has also served with the National Telecommunications and Information Administration. She will introduce to us the Broadcast Diversity and Leadership Act. That's HR 8154, sponsored by Representative Greg Walden and introduced in September 2020. Kate?
Thank you so much, and thanks for having me here today. I think you gave a very in-depth and good overview of the Minority Tax Certificate Bill. So I'll talk a little bit about the Broadcast Incubator Bill, but just generally planned on giving a little bit of an overview of where we see some of these issues as they stand right now. So thanks again for having me here today. I currently work as the Chief Counsel for the House Energy and Commerce Committee Republican leader, Greg Walden, on the Subcommittee on Communications and Technology. Leader Walden, as many of you know, is a former broadcaster, having owned and operated his own radio station in Oregon for many years with his wife. He's always very quick to point out that they were 50-50 partners. So addressing the policy issues that the broadcast industry faces are near and dear to his heart. And unlike many in Congress, he actually has the unique ability to empathize with many of the challenges that the industry has faced and is in a unique position to help identify potential solutions. Enhancing diversity in the media industry without imposing new burdensome requirements is a challenge that he's committed to working with all stakeholders to achieve. So I want to thank everyone on the FCC Advisory Committee dedicated to this issue for your leadership on this committee and for addressing these important issues at such an important time. As broadcasters continue to compete in the 21st century media marketplace, it's important that we don't lose sight of what's special about broadcasters, their local content. Broadcasters really are the backbone of how citizens consume local news, and they provide a trusted news source, which in today's world is invaluable. We also know that greater diversity in station ownership will help the news reflect the communities that broadcasters serve. So it goes without saying that consumers today have unprecedented access to high quality media content. I mean, we can stream millions of songs and podcasts and view endless hours of programming on YouTube and other platforms. But these new forms of media and technology have caused a massive shift in the way that we consume content. 10 years ago, smartphones were new to the market and Americans basically used them just for texting and calling. But now Americans spend almost 3 hours a day on their mobile devices, and nearly every network, newspaper, major radio station, everybody has an app. So consumers really can get content anywhere at any time. But broadcasters have done a great job in rising to the challenge of this evolving media marketplace by responding with their own apps, streaming platforms, and investments in local content tailored to their listeners and viewers. And local content during these times is really critical, as our communities continue to have an open dialogue about racial injustice in our country. Empowering diversity of viewpoints in our newsrooms through expanded access for minorities to own broadcast properties is something that could meaningfully move the ball forward. And that's the reason that Representative Walden introduced the incubator bill. Diversity at the highest levels of a broadcast station has a tangible impact on the programming and news coverage of local events. Networks and affiliates have made great strides to focus attention on having a newsroom that brings various viewpoints into their reporting. So that work is really encouraging. But it doesn't stop at the content. Local stations are also community leaders that harness their engagement with viewers and listeners and translate that into volunteerism and public service for worthy local causes. Whether it's about organizing food drives or helping people and businesses recover after major disasters, this type of engagement benefits from diversity in all levels of broadcast station. So broadcast stations really must continue to innovate and invest in the local content that serves our communities, and Congress can definitely play a role and help by removing outdated regulations and improving access to capital. So I know that we just heard a lot about the tax certificate bill, and we've also learned that this program does work, and it has effectively improved diversity in the ownership business when it was in place. So the Energy and Commerce Committee did recently vote out this bill that would reinstate this program, and we're hopeful that it will be taken up by the full House of Representatives later this year, but we will see how that goes. And now on to our incubator proposal. You know, the minority tax certificate only does go so far, and we believe, especially Mr. Walden, believes that we can and should do more to enable more minority ownership in the broadcast industry. So earlier this year, the Energy and Commerce Committee held a hearing to examine these issues, and there seemed to be a solid consensus, as has been the case for nearly 3 decades by this committee, that a broadcast incubator program could meaningfully promote competition, viewpoint diversity, and new entrants into the marketplace. So we believe that Congress has the ability and should act to permanently enact our incubator proposal so that, you know, we can avoid the judicial scrutiny that has kind of plagued the issue for a while. So at our markup, Republican leader Walden offered this legislative proposal, and it would codify the broadcast incubator program for both television and radio stations, reflecting this committee's longstanding recommendations. In fact, we've worked with many of you here today, so thank you for your help. And we remain open to continue to work together to find a practical way forward. We all share a common goal to promote diversity in the broadcast industry. Enacting legislation that lays out long-term requirements of a successful incubation relationship and maintains flexibility in the relationships to ensure the unique needs of new minority-owned broadcast stations are accounted for will help emerging broadcasters unlock access to capital and develop the operational expertise on how to manage a broadcast station for the first time. I'm hopeful that, like my boss, others view this as an issue of promoting diversity and distinctly separate from the disappointing failure to update media ownership regulations and the unfortunate cloud that hangs above that discussion. So while the program that this committee and its predecessor helped Chairman Pai develop couldn't withstand the judicial scrutiny, our goal is to improve and permanently codify this program so it has the stability and long-term success to increase the number of minority-owned stations. So as I said at the outset, it's important not to lose sight of what makes broadcasters so special, their local content. So thanks to all of you for leading the charge on bringing these important issues of promoting diversity to the forefront. We look forward to working with all of you, and thanks again for inviting me to be here today, and hope you enjoy the rest of your conference.
Thank you, Kate O'Connor. That was excellent. We appreciate your presentation and the pertinent information that you provided to our audience. I also want to thank David Honig for his presentations. These presentations inform us that the FCC mission to increase broadcast ownership diversity is supported by legislative initiatives in Congress. That really concludes this section, Part A of the tax certificate policies to increase ownership diversity, past, present, and future. We're kind of a little bit ahead of schedule, but at any rate, I will turn the program back over to Caroline Beasley, our working chair, and she can help direct us how we're going to manage our time issues. Thanks.
Thank you, Nahuja, and thank you to David and Kate. Your discussion was very, very interesting. We are actually going to break for lunch because it's important to keep the schedule, the agenda. So what we will do is ask you all to be back here and ready to start at 12:45. So we're going to give you some time back, and we'll see you at 12:45.
Great, thanks.
Good afternoon. We are now going to begin our afternoon session. We will start with our next panel moderated by Henry Rivera. But first, I'm going to turn it over to Nahuja, who will give you an introduction of the next panel. Nahuja?
Thank you, Caroline. Well, welcome back to Path to Media Ownership and Sustainability Symposium. Our Part A, Tax Certificate Policies to Increase Diversity Ownership, Past, Present, and Future, acquainted us with successful tax policies that furthered the FCC goal of increased minority ownership. We also heard about two proposed policies, Representative Butterfield's HR 3957 Tax Certificate Bill and Representative Walden's HR 8154 Incubator Bill that have made some progress in moving through the legislative process this year. In our Part B, Potential Impact of a Tax Certificate on the Marketplace, we will hear from station owners in the radio industry recounting their experiences and interest in using the tax certificate policy. However, in order to provide authentic voices and insight to how the tax certificates work, we are going to change our format from direct presentations to a lively question and answer panel discussion. Welcome to our co-moderated tax certificate policy panel. You can find a comprehensive biography of the co-moderators and the panelists in the symposium program. However, I'd like to briefly introduce the phenomenal co-moderators who will be shepherding you through the panel discussion. First, Henry Rivera, who is a member of our political subgroup under the Access to Capital Working Group. He is a partner at Wiley Ryan and also represents the Emma Bowen Foundation. Marita Cooley will also serve as moderator for this panel. She is a member of the Diversity in the Tech Sector Working Group and is the president and CEO of Multicultural Media, Telecom, and Internet Council. I will turn the program over to Henry Rivera to introduce panel members and get the discussion going.
Thank you, Nahuja. Much appreciated, and welcome back, everyone. I hope you had a good lunch. Our panel is entitled, as Nahuja said, Potential Impact of a Tax Certificate on the Marketplace. We've got an all-star panel to visit with us today to explore such things as how the tax certificate was actually used prior to its repeal, the impact of the tax certificate on station values, whether because of the pandemic station values have fallen to such an extent that there are no capital gains to defer, an exciting new program called the New Media Sustainability Accelerator, and the impact of consolidation on minority broadcasters who might rely on the tax certificate should it be reinstated. As Nahuja mentioned, our panel is going to be conducted entirely in a question and answer format. And toward the end of the panel, you too will have an opportunity to ask questions of our distinguished panelists. I'm now going to introduce them. However, I will do so only very briefly, and I invite your attention to the program for the symposium, which contains their much more comprehensive biographies. With us today are Mr. Russell Perry, who's the CEO of Perry Broadcasting, Mr. Tomas Martinez, who is the co-owner of Soulmart Media, Mr. Jeff Smullyan, Chairman and CEO of MS Communications, and Ms. Sarah Lomax-Reese, President and CEO of WURD Radio in Philadelphia. And of course, my co-moderator, longtime friend and colleague, Ms. Marita Coley-Flippen. So, Marita, let me at this point bring you in to pose the first question to our panelists. Go ahead.
Thank you so much, Henry. It's such a pleasure to work with you and with the Access to Capital Working Group, particularly on the tax certificate, something near and dear to my heart, because I did have a very cottage industry practice on tax certificates as a young lawyer many years ago. And with that in mind, Mr. Perry, Russell Perry, CEO of Russell Broadcasting, you are one of the groups of people who have successfully been able to use the tax certificate in its heyday. And so can you describe that to the audience and help us to understand, which transaction you used the tax certificate for and how you used it to get into the broadcast business as a new entrant?
Quite interesting. Thank you very, very much. You're right. That's been 27 years ago. So most of you weren't born during that time. I had an interesting experience. First of all, in my first acquisition, I knew nothing about tax certificates. And I knew I didn't realize it was in place to acquire anything. I'm an old newspaper publisher and somewhat of a banker, and this industry is just was so new to me. It was always my competitor. But I said all that to say this. The owner of this radio station, my first acquisition, was also owner of Devon Energy, an oil company. And it was dark, meaning this was not on the air. The station was not on the air. I was not aware of anything, but what brought about this change was the youngsters in my community came to me and told me that they needed a radio station. After I did my due diligence and looked into it, I thought that this was one that possibly I could afford, or I would try to afford by it. And then secondly, I thought that the community really needed a voice other than print. So in my pursuit of this effort, it was after the fact that I realized that, in fact, it was an AM daytimer off the air, no numbers, no nothing. And my experience was that as a banker, during that period of time, 27 years ago, it was required of asset purchasing. And saying all of that, it had some land and it had a tower and it had somewhat of a building, and I used that for leverage. After the fact, I realized that the purchase of that was an incentive for him to sell. He had a $550,000 tax certificate there. And so in my acquiring that was beneficial to him and gave him reason to sell. Two things happened to that. The community benefited out of it. And then secondly, he benefited out of the tax structure. And I'll end by saying this. To show you the need and the diversity that existed at that time, that was not a radio station geared to or formatted for African Americans in Oklahoma City, top 50 market. We came out and turned the darn thing up, and within the first book, we had a 4-3 share in a top 50 market. So the incentive was there, and that was in 1997, 93. And in 96, you had the changes that occurred. And I think that was the beginning of my career in broadcasting.
Well, thank you very much, Mr. Perry. Can I ask you, continuing with the description of the transaction, did the benefit received from the tax certificate policy express itself in the opportunity to do the deal at a market price, or did it express itself in a reduction in the price at closing?
No, I don't think you've ever dealt with oil companies.
Right.
They yield nothing.
I haven't, no.
They want everything. So I don't think it was beneficial at all. I think that it would have been beneficial to them for 100% whatever the value of that was. But for me, I knew nothing about it. Does that answer?
Okay. Yeah, thank you.
Thank you.
Maria? Maria?
I apologize. I'm just talking. And that was my experience as well, that the tax certificate was helpful in getting you to the table and helping you to compete in terms of helping a seller to recognize you, but it was not generally helpful in terms of getting any kind of break on the purchase price, is
Right.
what I understood. Okay,
Yep.
so we're going to come back to you, Mr. Perry, but right now we're going to go to Mr. Smulyan of MS Broadcasting. Earlier today, we heard David Honig talk about the impact of the tax certificate on station values. Would it have had an impact on station values in your experience?
Yes, I think because it's an extra benefit, if you're a station seller and somebody can come to it for tax certificate, you merely find the economic benefit. And I think I've always said that it provides real tangible benefits for a buyer because it makes the deal more attractive to the seller. Because the seller says, with a tax certificate, my minority buyer might be paying me a little less, but with the attendant tax benefits, he or she all really now is a buyer that's paying a little bit more. So it makes it more attractive. It gets minority buyers more into the game because most sellers are economic creatures and they want to get the most dollars they can. And obviously, if there's a different degree of risk, that changes the equation a bit. But I think the most important thing is that this is an inducement for minority buyers to have an opportunity to sit at the table and be attractive to sellers.
Great. Is Tomas Martinez with us?
Yes, I'm here.
Oh, hey, terrific, because I have a question for you, Tomas.
Okay.
And that is with the overall decline in station values, particularly due to the pandemic, is a tax certificate still useful? I guess what I'm asking is, are there any capital gains to defer? Is there now a wide gap between the seller's valuation of assets and a buyer's valuation?
Well, let me just give you a brief background on where we are. We started our company in 2013, so we did not really benefit from the tax certificate. I found out about it while I was taking the BLT course at NAB, and I realized that in those 17 years, minority stations grew from 40 to 362. That's a huge jump. That convinced me that I should become an advocate for this kind of a bill or this kind of a law to be in the books. Here in Southwest Florida, we haven't really seen the decline of value of radio stations. This is a very crowded market. Tampa is absolutely crowded, Fort Myers, Sarasota, and so forth. And what we're seeing is AMs as the starting point of minority broadcasters in many places. And now with AM digital and FM translators, all of a sudden we become a little bit more competitive in this environment. When you asked about the whole broadcast capital gains shelter, I don't think there's as much money as there was in the 1990s. I think right now, and I think Mr. Perry brought this up in his introduction, I found that a certificate would put me in a better position with a reluctant buyer who did not want to sell his property to a minority. I think that in that sense, it's a terrific tool to have in our arsenal.
we bought our first 2 stations with SBA loans. We've been we've been hustling. We've been trying to grow the business, and now we're trying to expand. This I still think would be great to have it, and for us to prosper in more ways than one.
Great, thank you. Jeff Smillian, do you have a view on this issue of capital gains in the markets that you operate in?
I mean, Henry, again, you're right. If people, and if you look at the history of assets that have been bought and sold in this sector in the last decade, you're right. There hasn't been a lot of gain. But I think, in some instances where people have bought the station a long time ago, there is a gain, and it's important. I think the tax certificate is one tool in the toolkit. I think the overall concern I have is there's an appalling lack of capital in this whole space. I spoke at one of these conferences a couple of years ago, kind of kiddingly saying, minority broadcasters have wanted parity with majority broadcasters for a long time. They've gotten it, unfortunately, is because nobody has capital. I think that's a challenge for this entire space. Anything that can provide capital incentives to increase minority holdings is, I think, important and should be a goal. But I think you have to look at the overall landscape, and I think anybody would tell you that there's been an appalling lack of capital in the American broadcast business, especially the radio business, for a number of years now.
Right. Thank you for that perspective. Marita, over to you.
Okay, thank you for that. And I want to thank Tomas for raising the very real issue about how the tax certificate had other intangible benefits in terms of helping a seller to convincing a seller to sell to a minority, because there were other intangible reasons why some sellers didn't want to sell to a minority owner. So thanks for bringing that up. Yeah.
That's a very good point. Absolutely good point.
Yeah. So Ms. Sarah Lomax-Reese, President and CEO of Word Radio. I am excited to meet you in person. As I mentioned that I work with Charles Ellison, one of your on-air personalities. And I understand that you didn't actually use the tax certificate before it was repealed, but you were successful in financing the acquisition of Word, WRDAM. How difficult was it to obtain financing for that acquisition? And can you just walk us through that process?
Well, thank you. I'm really happy to be here. We are probably very, very, very unique because we were in the position to acquire our station in a cash deal. So we did not finance it. We did not have to use any financial instruments to underwrite it. And so that is very, I think, unusual. But I know from our experience, it's been a real lifeline and a lifesaver for us, because what I do know is that the economics for a Black-owned talk radio station, we know that there are only about a handful of Black-owned talk radio stations in the country that still exist. The economics for stations like ours are very, very difficult to manage. And if we had debt service on top of just the operational costs, it would be really, really difficult for us to sustain ourselves. And I just want to kind of speak to the tax credit and some of the things that were spoken about earlier in terms of, it really is, the tax credit would be great, but I think that lack of access to capital, not just in this space, but for Black and brown business owners in the broadcast space, in really any space, has been, woefully inadequate. And so I think that if we're really going to look at a way to increase ownership for Black and brown owners in the broadcast space, we have to look at how you create more access to investment capital and other instruments that will allow owners to have the resources to participate in this industry.
Great. Absolutely.
Yeah, that's a very good point. Sarah, when I was at the commission back in the early 80s, I chaired a a diversity committee, and we basically concluded the same thing back in the early 80s, that access to capital was a huge problem for minority broadcasters or would-be broadcasters. And we recommended several changes to the commission that would attempt to remedy that. Unfortunately, some of those recommendations were not adopted, and some of them, even though they were adopted, did not remedy the problem. But you're absolutely correct. I agree with you 100% on that. Now, Tomas, back to you. Sometimes broadcasters acquire station assets with intrinsic value, for example, real estate. But the stations have been underperforming because they, for example, offered the wrong programming for the particular market. However, such stations might seldom yield a capital gain that either the seller would want to offset. Are you aware of this type of scenario? And if so, how can a small broadcaster still benefit from the tax certificate?
I think that number one, there are many cases. You know, when we talked about radio, I don't think you could make a generalized assumption that every station is without cash or anything like that. I run into a lot of small operators, private operators, who own their own family business, and they have zero debt, and they're very happy, and they don't want to sell, because I've been knocking on some of those doors to buy a station. And they tell me these stories. From a minority perspective, when you go into a market, we came into a market and we became the first Spanish radio stations in Sarasota that were 24/7. And when we did that, it was based on a market study. It was based on census information, census tracking, and so forth. And that's how we made our decision to dive in headfirst into Southwest Florida. There are always opportunities as long as you walk the streets of the market, as long as you know the business, and most importantly, as long as you adapt your model to today's economy. The radio business today is not the radio business that I started in the 80s. This is a different business. I have changed my model 2 or 3 times throughout my career. And here we started an operation that it's a lot smaller. I'm hiring people that can do 2 and 3 jobs. So you have to be innovative and you have to adapt to the times. I think if you do that, you survive and you prosper. If you don't, you're basically walking against the wind, and you're going to have a tough time. So I still believe in radio. I think the companionship that we offer our audience is unequal. I think we've all seen all the negatives that social media can cause. This is a business that I think has years to go and years to prosper. At the same time, we have to live in 2020 and beyond.
I'd like to make a comment on that.
Yes, please do. Please do.
You know, I started when I started this in the broadcasting business. It was quite interesting to me. Like I said earlier, we had no representation in the community here, but my banking experience led me in a different direction. For instance, the philosophy seemingly at the time that I purchased my first station was that it frightened the local bankers that the license weren't for sale. And secondly, they did not include all the assets in acquisitions. It was a gold mine for me because I went to the bankers and everything that I saw available as an asset deal, I leveraged it towards towards the loan. And that's just now in the last 10 years I started hearing this, and I have grown my company by leveraging, developing the equity in those companies and leveraging them. And another thing I found out, that commercial lending is almost a monster to broadcasting industry, period. They don't understand it. And I don't know if they'll ever understand it. But saying that, based on our successes, uh, we have been able to diversify, and which enhanced us in a position of enhancing our broadcasting company. So in the meantime, we have, for example, and I'll be quiet, we have 6 local commercial banks that participate with us on our acquisitions. And let me tell you where that has to be. The reason for it. Say Oklahoma City. When I bought my first station, the FM station alone was selling for 18 to 21 million, with a population of 10,000 African Americans in that city. It just won't work that way. The numbers won't work that way. So you have to find out another way to do it. And I think that yes, tax certificates are one thing, but it's a whole different thing in acquiring and maintaining the radio station.
Sure. No, I appreciate that. Thanks for that comment. Jeff, do you have anything to add here?
Tom?
No, I just wanted to add, Henry, to your question about assets. We had 2 towers at the beginning. We sold one, and that gave us a lot of money to pay off some of our debt. And at the same time, right now, we have a couple of buildings. We're about to divest one. We believe that the value of our company will be in our licenses and our area of coverages. Though that's where we're at. Now, with the pandemic, you know, the whole home office thing where we have DJs doing their shows from home and traffic doing their traffic work from home. I think that's going to have another impact on our industry, and especially in small operations. That's all I wanted to add.
Okay, thank you. Jeff, do you have anything to add to this conversation? Or Sarah?
Yeah, well, one of the things that I was going to add is I think that with the advent of COVID-19, I know for us, we definitely, and I think it was Tomas who was saying that you have to adapt your operations to meet the moment and meet the time. And we know that right now everything is multimedia. It's digital transformation is at the core of most businesses. But we found that radio, the value of radio actually increased during COVID-19 because our listeners tend to skew older, and they really are loyal listeners of our radio station because they trust our hosts, they trust our organization to provide accurate, consistent information. And so we doubled down on radio in a way that previously we were doing a lot of events, we were doing a lot of things that had us diversifying, which is important. But in the coronavirus moment, we realized that the radio asset was actually even more valuable because we were able to amplify video and Zoom and all of those things. That was our differentiator, was the fact that we had this on-air capacity to reach audiences that oftentimes were unreachable in other ways. And so I agree with Tomas and probably everyone on this panel that radio is still incredibly valuable and viable. And we see that even more with the podcast universe. If we as radio operators can capitalize on this kind of podcast, platform, we will be able to really lead that as opposed to kind of trail it.
Good. Well, I agree with you 100%. There's no question that the pandemic has certainly changed all of our lives, including the radio business. Jeff, I wanted to give you an opportunity to comment on this if you wanted to.
Sure. Yeah. Again, I think the challenge has been, and the pandemic has exacerbated it, is that you're dealing in an industry with declining revenues, and the problem is that we all know. I think Russell talked about the challenges of banks. I've lived through all cycles of this. When I started in this business 40 years ago, banks wouldn't touch broadcasting because it wasn't tangible. They said if they lent you money and you owned a factory, if the business went under, they could repossess the factory, but we were just merely sending signals in the air. And then as time went by and people saw that this was a very good cash flow business, they lent to it. There was a time in the mid 90s when it was sort of like every bank in America opened up a radio branch and a TV branch. And you saw stations trading at 20 times cash flow and bankers, senior lenders lending, up to 10 to 12 times senior. Those days have certainly declined. And I think Russell alluded to it. Today's senior lenders, if you can find them, are maybe lending this business at 2 or 3 times cash flow. It's a dramatic change.
Absolutely.
And again, it gets back to my overall comment that we suffer from a staggering loss of capital throughout this sector, whether it's equity capital, debt capital, mezzanine capital. All of it has sort of fled the sector. And I think to really increase diversity, I think things like the tax certificate are very helpful. But I also think there's going to have to be an infusion of access to capital to really make a difference here.
Yeah, I agree.
Yeah, I'll say
Marita, over to you.
I'll say another thing too that
Yeah, go ahead. Go ahead.
I caught drift of based on the multiplier. Your dollars, as far as your multiplier is concerned, is in tower companies. Has been rather steady with some steady growth. I built a 2,000 footer in a small town in Oklahoma, and we're just now reaping the benefits of it. Now, the irony of that is technology has changed, that these telephone companies, all that, they don't need necessarily the height anymore. So as you move one direct, and I did this to offset, I built that tower to offset paying 18 to 21 million in larger markets for one signal. That tower company cost me less, and I was able to fire a 16 bay antenna for 60 miles into a full 100 watt FM in this market, which made me money. So I mean, I think we have to get smart in this industry and diversify ourselves more than just the tax, and we still need that those who need it, but we just have to get smart with this game.
Yeah, no question about that. All right, thank you very much for that, Mr. Perry. Go ahead, Marita.
And I just wanted to comment on the COVID thing. I can imagine for all of you that the morning and evening drives have totally changed, and I'd be interested in hearing a little bit later about how that might have affected you. I know working from home, my husband and I both work here, and I hear the radio on all day. So hopefully you're experiencing some of that bump. So the next question is for Jeff Smullian at Emmis.
Okay.
What would be the impact of additional local market consolidation on minority broadcasters that might rely on the tax certificate? Can you give us some insights in the impact of local market consolidation?
Well, again, if you have buyers, if minority broadcasters end up selling into that, and by the way, I saw this the last time, at the turn of the century, where there was a lot of capital. We had some minority broadcasters who had strong positions in the market, and they chose to take the cash. So I think in terms of number of broadcasters, I think it probably would diminish, but I think it would probably provide access to capital for people who would like to be sellers. I think, for buyers, I think, again, there will be opportunities if you have a minority broadcaster has a sizable stake in a market. For example, my friend Alfred Liggins, who is constrained because he owns a number of stations and markets, and he may be constrained. He would probably have the access to the capital, although he might disagree with that lately. But Alfred would have the ability to, use that capital to strengthen his position in certain markets. But it is all a question. I think the unintended consequence of deregulation was it eliminated a lot of minority broadcasters who were, bought up, who sold out during the last, glory days of radio. I'm speaking mostly of radio, although I obviously did TV too. But a lot of them left. Now, I think if you'd say to them, well, you abandon the space, and they would say yes, because I paid X for the station, and 5 years later I got 3 times X, and I just thought for my family, my employees, that was the best thing. I don't know if that answers the question, but those are sort of the observations. It depends. And consolidation depends on where you're coming from. Do you want to sell into it? Do you want to be a buyer? But generally, and I'm very, very mixed on the last consolidation. I'm not sure it did our industries any good. I can go both ways on that. But generally speaking, consolidation brings more capital into a space. And that's certainly what happened the last time. Wall Street discovered the broadcasting business after the deregulation of 1996.
Right.
But
Anybody else want to comment on that?
yeah, I just want to throw something out there because I think you can't divorce consumer consumption patterns from this conversation. Because people, I know I have kids who are in their, early 20s, they don't listen to the radio. They just don't. They are listening to their phones or social media and so I think that this industry has to also meet the consumer habits and how people are interfacing with the broadcast medium overall, and we have to figure out how we adjust and adapt and stay relevant within this very, very dramatically changing universe that is all about technology and digital and all of that. And so I think obviously I'm a radio owner, so I am deeply invested in radio, but I think that we can't talk about how we increase minority ownership in this space without figuring out how we also are continuing to make radio relevant to new audiences and younger demographics.
Sarah, can I jump in on that? Andrew, is it okay to, or Marita, can I jump?
Yes, please.
I could not agree with Sarah more. One of the kind of dirty little secrets of the American radio industry is that in our zeal to deal with increasing debt levels and being public companies and quarterly reports, we've seen a tremendous addition of number of spots. And if you look at the number of commercials that a lot of major companies are running, you can understand why people like Sarah's kids have said, what do I need radio for? Do I really need to listen to something that runs 16 minutes an hour of commercials when I can listen to Spotify or Pandora or other things? And I think it's hurt us a lot. And I think that it's a necessary evil because you got companies that say, look, I agree with you, but if I don't run 16 minutes an hour, I can't keep the doors open. But it has been a significant challenge. And I've seen it in some of the data we've seen that when people listen to a radio station for 7, 8 hours, and they have 7 or 8 minutes of commercials an hour, they'll tolerate it. But when you get up, and we've seen competitors, run 23 minutes an hour of commercials. That's just not a product that any demographic wants to consume, especially young people who are used to, short bits of information and entertainment.
Wait, did someone else want to jump in on that one?
I'd say something here, and once you get to know me, that I have different sides of my opinion. I guess that's based on my age, but broadcasting, when I got into it, has never been favorable to African Americans or people of color. The reason for me saying that, before deregulation, Africans really didn't. The majority of African Americans didn't own those stations. They were up front for those stations. When the dollar surfaced, then they had to go. Now, that's never said, but that's a fact. When I got into the radio station, I could tell you it was at least 8 or 10 black broadcasters in this country that I knew of. And within the next 3 years, they were all gone. And everybody knows that. It's been unfair. And then secondly, second thing I would say about technology, it's here to stay. So we have to find a way to accomplish and move forward and collect, join with them. We got to make this thing happen. We've spent too much money, both publicly and private owners spent too much money. I told my young son, and when we got into it, and all these stations started going going public, I said they never will regain the capital that's costing to buy these things. That made a difference in broadcasting, in my opinion. proud of that. That was not the case.
I could not, again, I could not agree with you more. The influx of public capital changed the business. The only thing I disagree with you, Russell, is I have friends, you know, who were Black owners and Hispanic owners and Anglo owners, and a lot of them saw, you know, the money with consolidation and deregulation, and they just said, you know what, I'm out. And I know we all have, you know, we'd like to think we serve our communities, but people said, you know what, it's better for my family to take the money and run. It's hard for me to argue with somebody else's motivation.
100% on that. But our true entrepreneurs, they don't give up. They fight like hell.
I couldn't agree with you more there too. I think and Russell, I have a feeling you and I are like that. We've been doing it for a long time because we love it, and you know, you're right. An entrepreneur who has a success and takes the money quickly and retires is probably not a true entrepreneur. Most entrepreneurs like to do what they do, win or lose or draw, and they keep doing it.
I have an entrepreneur that comes to my office every day and sit down. I said, "Get out of my way! You have retired."
An entrepreneur is retired is just another guy who plays golf, right?
Right, you're absolutely.
I would just like to add something. I really, first of all, I enjoy this conversation tremendously. It's really up my alley, and this is what I love. I've only done radio all my life, and I can tell you one thing that we're obsessed with in our little market, which is mostly Mexican regional based, is finding out what the people like. During the pandemic, we heard that the churches were closed. We decided to broadcast the Mass live every Sunday from the largest parish here, and that was a tremendous hit. A local organization decided to do clinics to offer free COVID-19 tests to the migrant workers. We were there promoting that and helping the community. I think that if we keep our feet in the ground and we keep our ears close to our audience, we'll continue to have success. And the big companies will always be around, but the passion that the small business, the small minority individual brings to this business is unequal, in my opinion.
I couldn't agree with you more. We are, you know, when Mr. Perry and Mr. Smullian were talking about the kind of public dollars, we kind of we got into the business when a lot of people were getting out, you know, because we recognized that in Philadelphia, which is almost 45% Black, there was about to be a void in that market to serve this massive community. And so we had an opportunity to acquire a station to continue to serve that community that had a long history of Black talk radio in the city of Philadelphia. And so we are we bought WURD in 2002. So we're kind of the new kids on the block compared to you folks, but we got in when it was probably not particularly favorable because we knew that we wanted to serve an audience that needed to be served, wanted to be served. And so I think, to Tomas's point, to the extent that these tax credits or whatever is being done to incentivize ownership, it really needs to be targeting independent, smaller owners, I think, because those are the ones that are really invested in serving the people and serving communities in a way that you don't necessarily always get when you have to satisfy shareholders as a priority, as opposed to satisfying your community as a priority. So I just want to throw that in there.
In regards to that, I need to address this too, if I may. I've been a blessed man in being able to acquire capital. But my philosophy on broadcasting, I have country and western. I have news talk. I have Black news talk. I have Rush Limbaugh. For all those markets that that deserve hearing and serving that. And I think diversification is more than just black and white. I think if you really want to get into this business, if capital exists, spread it out, compete. I didn't think I liked country and western music, but I didn't think I liked hip hop until those dollars started moving, and then I knew what I liked. For instance, I didn't like hip hop. I now have 6 hip hop stations. So but you understand exactly what I'm saying?
I understand what you're saying. I think it goes to motivation, you know? I mean, and each of us have different motivations for why we're in this business. I know, you know, I know what my motivation is because I wouldn't be, I have a different motivation. And I think that everybody's motivation is valid, but you just have to know what it is. And, you know, hopefully it motivates you enough to stay with it.
I would agree.
And you can survive from a business standpoint and make money. That's central.
Sarah, you're saying something that that I have kind of, been depressed about over the years. And that is, and hearing from somebody who I know you're younger than me, I don't know how much younger, but hearing younger broadcasters talk about their passion for the community. When I started this business, it was around a lot of people who were the pioneers of this business. And yes, they were in business and they had to keep the doors home and they all want to make a profit, but they really cared deeply about serving their communities. To me, that's what always set broadcasters aside. I was in the baseball business, and I'll tell you a story about Bud Selig. His idol in baseball was a guy named John Fetzer. Now, there's probably nobody on this call who remembers John Fetzer. John Fetzer was a broadcaster in Michigan. And Bud always said he was the best baseball owner because he cared about the good of the game. And I used to say to Bud, it's because broadcasters care about the good of the community. And to their core, it matters to them a lot that they serve the community. And by the way, Russell, I have had right-wing talk, and people have teased me about people who know my politics wonder how I go to bed at night knowing that we've had people like Rush Limbaugh. I've also had country, and we have the 2 largest hip hop stations in the world. If you serve your community, you provide something that makes sense for your audience, and you do it with a passion. It doesn't always match your political beliefs, but what it does do is evidence your desire to make the lives of your audiences and your communities better. And in many ways, that's serving, playing country music or talk radio or hip hop or, rock and roll. Absolutely. But broadcasters who love what they do want to serve the audiences that they reach.
Absolutely.
And there is somebody on here who's heard of John Fetzer, because I'm from Detroit, so I definitely remember John Fetzer and Tiger Radio.
Yeah, and he was one of the, and I knew a lot of people like that who started this business so long ago. And yeah, they were, listen, nobody's in business doesn't want to make a profit, but they also, it was in their DNA, the DNA of and so that's why I love younger people like Sarah, and I can see it's in her DNA. To really care about, making a difference to the people that you serve. And I've always thought that's what set broadcasters apart from a lot of other industries.
Okay, great. Henry, you want to take the next one?
Yeah, sure. Let's try to bring this back to tax certificates a little bit. And this is going to be for Sarah. And that is the question is, in many smaller, sparsely populated states, there are relatively few opportunities for minorities to enter the business, the broadcasting business. And I wondered how you feel about how the tax certificate might help minority new entrants in such places, and what additional policies or programs could supplement the tax certificate's impact.
So I think that, again, I mean, I'm going to speak more globally because I don't have direct experience with the tax certificates.
Sure.
But clearly, I think that creating a lower bar or a lower bar to entrance or more access is going to, whatever the geography is, is going to create more more diversity in ownership, and that's going to benefit those communities. It's going to benefit the industry. There's a program that I am involved with right now that is very much about helping BIPOC is the new term, Black, Indigenous, people of color, owned and led media organizations to really learn additional skills in the media industry. It's a program that is funded by Facebook. It's called the Facebook Sustainability Accelerator, and it matches skills and resources with minority-owned media organizations, and it's really designed to help invigorate local journalism and local media owners to serve their communities more effectively. And it's also matched with a 6-figure grant from Facebook. So it's a skills building program matched with a grant that allows these media organizations to implement and grow, really to expand and grow. And so that's a new program. I think that one of the things that we're seeing is that different industries are starting to get interested in diversity and in diverse ownership. And so we're seeing that with the platforms like the Googles, the Facebooks, and the platforms that are recognizing that this lack of access to capital, lack of access to opportunity and resources has really stifled the ability for different voices to be heard in the media space. And so I'm the program leader for this particular sustainability accelerator, and we're working with 20 different media organizations that are owned or led by Black and Brown people of color. And it's a really exciting opportunity. It's the first time that it's been done like this, and really excited to figure out how we can not just create training programs, but also match that with funding. Because as we've all said previously, lack of access to capital is a major stumbling block for the ability to really advance in these media spaces.
Well, it sounds very, very exciting, that new program. Has it actually started, or and if not, when do you anticipate getting it off the ground?
Yeah, it actually started in October. It started towards the end of October, so we're right at the beginning of it. It's from October to March. It's kind of like an intensive boot camp, and then from March to September, they get a grant and can begin to implement the different learnings that they've gotten from the program using the grant dollars.
And did you conceive of this? Is this your baby?
No, I work very closely with the person who has conceived the structure of these accelerator programs. Facebook has done a number of these programs that they call accelerator programs around different aspects of media growth. And but this is the first time, and I've been very involved in terms of conceptualizing this one that's specifically for BIPOC media organizations, Black and Indigenous people of color owned and led media organizations. So this is the first time that particular focus on minority owned media organizations that it's been done, and it just started in October, and it'll go for about a year.
Well, congratulations to you. I think that it sounds very exciting, as I said, and I think combined with, if we could get the tax certificates back, it might be a big help toward increasing diversity in the broadcast space.
Absolutely.
All right. Anybody else wants to get in on this or ask Sarah about this program?
Yeah, Henry, I will put in a couple words here. I think the original question was a sparsely populated market. So how would the tax certificate work? I think that's right. This instrument in particular would be key for any minority broadcasters to get into one of these sparsely populated areas. As a matter of fact, when you take the BOT course at NAB, they advise you as a new broadcaster to start in the small markets, because you just can't go and buy an $11 million FM station in Oklahoma City or wherever you like to go. So, I think that would be extremely beneficial, especially for new minority broadcasters.
Okay, thanks very much. Okay, Marita, over to you.
Okay, so we've talked a little bit about the prior iterations of the FCC tax certificate, which was somewhat different and applied to broadcast, but also applied to cable. And I think we had some telecom transactions as well. I wanted to ask what would be the greatest benefit of restoring the tax certificate. And we also, and I'll tie it in a little bit later to a question that we have. What do you think would be the greatest benefit, or should we have a different iteration? Sarah mentioned that a tax credit for independent smaller networks might actually be more beneficial. So just this question that was for Mr. Perry, but anybody else can weigh in on it after. What do you think is the greatest benefit of restoring the tax certificate, either in its original version or some kind of updated version?
Well, it was good at the beginning, and I think it was purposely done. And I think politically it was done purposely, and I think it ran its course politically. I think that we have not addressed that. This tax certificate, in my opinion, is going to be done only if we have the political influence to do it. It just gets to that, and I think that's the reason for it being removed.
Yeah.
I just don't know the answer, Jeff. I don't know. I don't know the answer there.
Well, I agree with you. It was removed because of politics. In fairness to the people who criticized it, there were abuses, and I remember some of them where there was a minority who was given de facto control, but in reality, the minority broadcaster really did not control the business. It sort of had phantom 51%, but the real economics he made. I could think of one who was somebody I knew, and he really had, maybe 2 or 3% of real economics, got the tax certificate, and a lot of people looked at that as a sham. And I can understand that, because in many senses it was. Also, I knew the guy, and he did very well with that. But that was not the original purpose. And
But
I think
it hurt the good people who really needed it.
that's right. And it was seized upon by people in politics who said, okay, we got to get rid of this. As far as wanting a tax certificate back, I've been consistent for 20 years saying we need to do this, but I've also said it's only one tool. We have to provide access to capital, because without access to capital, while it gives you a little bit of a benefit in convincing a seller to sell to you, if you don't have the access to capital, it really doesn't matter.
Doesn't matter. And I'll say this too. I've seen in the banking industry, when I first got into making reference to the broadcasting, to get them financed, they started off with the bank started off with, although you had the certificate, they started off with assets, and then you looked up, it was cash flow. Now it's global cash flow. And they changed too. And if you don't have it, and you have to address that certificate means nothing.
Yeah, and having and while I probably don't have a long history of speaking favorably about bankers, I've had wonderful relationship with over the years. They're economic creatures too, and when you look at the two largest companies in the industry that have gone through bankruptcy, and maybe headed there again, they look at the industry and say too many bankruptcies. And that's why the industry's lending, it is very, very difficult to get senior lenders to even look at this space anymore. And if they do, they're not lending at 7 or 8 or 10 or 12 times cash flow. They're lending at 3 times. So in fairness to them, they've looked at our industry's history and the bankruptcies and the defaults, and they've said, it does have to be gold cash flow to lend against because they've been burned. And I can't say I blame them. All of us would do the same thing.
And this needs to be heard and said too. A young African American, a young person of color going into a major bank and asking him for $1 million, he thinks you're crazy. I mean, really, he thinks you're crazy. So you have to try to find a way to get over that hoop. And I think one of the other things is, and I'm talking from experience. I'm talking from experience. And can you imagine, say, 30 years ago, what it was like? Oklahoma was the first state in the union this last election to go red.
No, you're wrong. Absolutely wrong. Nope. I disagree. I finally disagree with you. I live in the first state to go red in this election. Indiana was
second.
Oh, well, maybe second, but I tell you, Indiana was off the board early, and it's a matter of great pain to me, but we won't get into that.
It's pain. but all I'm saying, and I think you're saying the thing, we have to be real, but this is a good start if we can get it back, this tax.
Yeah, absolutely.
I would support it 100%.
Great. Henry, you want to take the next one? I think I stepped on the questions.
No, that's okay. I think it's time to see if there are any questions from the audience out there of our great panelists here. Anybody got any questions?
Yes, we have a couple of questions, and one of them is tied to what Sarah brought up earlier about the structure of the tax certificate. And I think the theme, the refrain that we're hearing from all of you is great. The tax certificate is great, but the most important thing is access to capital. And the tax certificate is just a tool that may help you to get into the game, but it doesn't solve the issue of access to capital. So this question has from Condista Networks, a Kid Central Network, which is a cable network. And the question is, the prior iteration of the tax certificate also applied to cable as well as broadcast networks. The Butterfield bill is great, but it only applies to broadcasting. In this digital world, is there support for a different kind of initiative that might, for example, apply to independent networks and provide a tax credit for agreeing to carry a independent network, whether it's broadcast or cable or whatever, but to provide a tax credit to this distributor in exchange for distribution? Is that something that would help the broadcasters on this panel if it were structured differently, or if there were a new initiative? Would it help you in a digital world? So that's the question. I'm kind of reframing it.
I don't know. I don't know, but what I do like about that question a lot, and what I'm hearing from the other panelists, is that I would love to see a kind of a brainstorming of like the full range of potential tools and legislation and reforms that could really address this issue holistically. Because the tax credit, which, Mr. Smelling, everybody has said, is one piece, but we've got, that might be like a 10th or a 5th or whatever, a tiny piece. But how do we find a way to fill the rest of those gaps that exist? And because this is such a deep and profound problem that is not going to be fixed by one kind of piece of legislation. It's got to be a holistic kind of multi-pronged approach to addressing all of these things. And it's, we know it's systemic. And so I think that it requires like a brain dump in terms of like what the questioner put on the table. That's interesting. I don't know if it would work or not, but all of these ideas that could really look at the full, the gamut of gaps that need to be filled for our industry to be fixed from a minority participation standpoint.
Can I broaden this a little bit?
Sure.
I think, and we've started to have the national dialogue. I think we're moving in this direction. There really needs to be a recognition that we are going to have to find a way to allocate capital, provide incentives for basically economic displaced people, minorities and non-minorities. If you look at the gap between rich and poor in this country, it is shocking. We're now beyond where we were at the Gilded Age 100 years ago. And there is a recognition that we have got to do certain things. Yes, it would be minority broadcasters, but it would be a lot broader than that, to provide opportunities to bring the American dream back to a lot of Americans who feel dispossessed because they've been dispossessed. So I think that is a national dialogue. That's a lot broader than an FCC minority tax panel, but the point is, if you really want to solve the problem, this is a lot deeper problem than whether we enact a tax certificate.
I just want to add something. As I've been doing research on this, on the history of this certificate, I read about all the problems that the previous certificate had with IRS and all other issues. And one of the things that worries me is if we do manage to pass this, will it be permanent? Whatever solution we can find, I think one of the key criteria that we have to focus on is on making it a permanent solution or as permanent as we can. That's all.
Okay. And we actually had that question about the prior version of the tax certificate that required that the buyer have 20% of the equity and operating control. And then the Butterfield bill contains a provision that the socially and economically disadvantaged principal must own at least 51%, even if the entity is publicly held, and must also serve in management. Does anyone have an opinion about whether this particular provision of the Butterfield bill could have the unintended effect of making it difficult to use the tax certificate for a large transaction? Any thoughts about that?
Rita, because I think that 51% goes to even it would really, I think, hamper the acquisition of a very large purchase if you've got to own 51%. But Jeff, or anybody got any thoughts on that?
Well, then the minority would not have control of his company or her company.
Well, but that would be a requirement that's a requirement in the Butterfield bill that the person, that the minority own at least 51% of the equity.
Yeah, and I think the thought was, does that hurt if you're trying to make a large transaction? But I see what you're saying, Russell. If you don't, there has to be a way for the minority to be in control. Otherwise, it wouldn't fit. So let me move on to a question from the press. It's from Ani Taylor at Com Daily. Even with more access to capital and a tax certificate, do you think there's still room in the business for small startup broadcasters operating as new diverse broadcasters? He says all the broadcasters are yelling about how having scale is essential, and we've seen minority broadcasters have trouble getting carriage. Can a small independent broadcaster remain viable and competitive anymore?
I'll take that one. It's a very challenging problem. If you know Dewan here in Indianapolis, who just bought Channel 8, and he's having the exact problem with AT&T, DirecTV getting similar terms because he's not a large entity. I don't think it's a racial issue as much as he's a standalone operator, and the cable industry and the satellite industry have been used to, paying for companies that have a lot of leverage. In the radio business, the same way. If you're a single standalone operator and your two largest competitors have 5 stations and 7 stations, it is a challenge. And that's why getting your foot in the door, you hope that once you get your foot in the door and you buy something, that it's economically viable to survive. And make no mistake, when you're up against people with gigantic market power, it is challenging. Look at the problems of the entire broadcasting industry against the market power of Google and Facebook in the erosion of dollars. So whenever you're dealing with and that's another big national issue. What are we going to do with mass concentration? So.
Yeah, I would just I would say I think we are an independent single station in a big market. We're a Black Talk station in Philadelphia, and it's very hard to compete with the iHearts and the Radio Ones and all of them who really dominate that our market. But if you can find your niche, if you can super serve your audience, if you can do something that nobody else is really doing in that market, and you really cultivate, your brand in a way that that again differentiates you from others, you can be viable. I mean, we are viable. We are growing. We are profitable. And you have to be extremely nimble, and you have to be extremely creative to recognize where there are opportunities that exist outside of the standard kind of the standard models. And so, we have been looking at, we have diversified our revenues in ways that for-profit commercial radio stations have not done before, and we've had success with that. And so I would say to that person's question that absolutely it can be done. It's not easy at all, but it can be done, and you just have to be really, really scrappy.
Okay, I have a interesting story, and I'll make it as brief as I can. Sarah, this will be good for you. When I bought my first AM daytimer, there was no hip hop music in Oklahoma City, Oklahoma. None. No one was playing it. You had iHeart, Q, you had all the big boys in here. We turned it on, and like I said, on the first book, we came out with a 4-3 share, and I didn't know what that was. I didn't know how good we were doing. And next thing I knew, Jeff, all 3 of the major corporate radio stations started playing hip hop.
Well,
Well, let me tell you my story.
Go ahead.
I said, okay, is that what you're going to do? I'm going to go across the state of Oklahoma and create a mechanism that every Black Oklahoman would have a hip hop station in their market. So now I developed that and created market share statewide. Right. And that's what I sold. And that's to compete. And I didn't have to pay that large amount of money for a radio station. Right. Now I have the resources to do that. But I think we have to be more creative if we want to stay in this market, because they'll eat you up.
Yeah.
Listen, I think we're going to have to, Jeff, I hate to interrupt you, but we're going to have to leave it there. We've got to keep the trains running on time here. And we've got another panel following us. So I want to thank each of you for your splendid contributions this morning. You guys just really did a wonderful job. And I thank you from the bottom of my heart, and I know Marita does too.
Absolutely.
So with that, we're going to sign off and turn it over to the next group. But thanks again, and have a wonderful rest of your day.
Thank you very much.
Signing off.
Thank you so much.
Thank you.
Bye-bye.
Thank you, Henry.
Thank
You
you.
bet. Thank you. Bye-bye.
Bye-bye.
I think we could turn it back over to Caroline. She's going to shepherd us to the next part of the schedule.
Yes, I am. But first, I would like to give my thanks to Henry, Marita, Sarah, Jeff, Russell, and Thomas. You guys were very, very, very interesting and insightful today. We're going to break for 10 minutes. So if you will meet us back here at 2:10, that would be great. And we'll start up on the next panel. So welcome back. I just wanted to recap today, so far the day. This morning we started with our finance subgroup. And then earlier this afternoon, we talked about tax certificates. So you find a radio station or TV station. It helps to acquire that station with a tax certificate, and then you must find financing. Once you close on these stations, then you have to keep the lights on. And that's what this next subgroup is about. The broadcast subgroup are going to be presenting 2 panels this afternoon. And I am going to actually hand it over to broadcast subgroup chair, Skip Dillard, to give an outline of what we're going to be expecting.
Well, great. Thank you so much, Caroline. And we'll get right into our first panel. I'm so happy to have our Nielsen guest with us today. And throughout my career, ratings and revenue, I think I've heard that phrase uttered more than anything else I have throughout my years in the business. And as we start thinking about 2021, a few questions are on the top of industry minds. First off, how do we maximize our relationship with Nielsen and use its tools to help us rebound after this incredibly hard year, a year that we could not have anticipated in all of our budget meetings and plannings and what ifs and all the SWOT meetings would never have gotten us ready. And, you know, we also want to know what Nielsen sees ahead. For a broadcaster who survived 2020, we need all of the crystal ball advice we possibly can get. Mr. James Winston, attorney and president of the National Association of Black-Owned Broadcasters and an ACDDE member. We also have Dr. Nimisha Shukla, pediatrician and owner of South Asian Broadcasting LLC. They will be our moderators for what I know will be a most informative discussion. Ladies and gentlemen, take it away.
Okay. Thank you. It's obviously a great pleasure to be him. What's happening with broadcasting and what we can do to increase access to capital and opportunities for ownership is all a part of what NABOB works on there all day, every day. And we're delighted to be part of the symposium here to address these issues.
Please connect.
Co-moderating with us. And we will have the pleasure of introducing our 2 and work with, if you're in the broadcasting industry, you're working with Nielsen very regularly, and we've had very good relationship with the individuals, well, with Nielsen as a company. John Miller. John is vice president of Nielsen and oversees the entirety of Nielsen's interactions and creators. He's been with Nielsen for nearly 20 years, working with both radio and local TV clients, and previously worked for both iHeartMedia and Westwood One, both on and off the air. My pleasure. Introduce John Miller, and I'll turn to other Nielsen guests.
Hello, everyone.
Could you hear me?
Yes, I could hear.
We're turning it over to you to introduce Stacey. Oh, okay. I think there may be a lag here.
Yes, so it's with great pleasure that I'm introducing Stacey Diarmas. She is a Senior Vice President, Inclusive Insights and Initiatives and a leader within Nielsen's diversity, equity, and inclusion practice. She is a researcher, consumer behaviorist, thought leader, and subject matter expert on diverse communities. Stacy is responsible for producing inclusive thought leadership and new research initiatives on diverse consumers and audiences. Now the floor is yours to start the presentation.
Great, thank you so much. And thank you all for the opportunity to be here and share Nielsen's work in this space. We're honored to be here. I can't see the slides, so if the slide presenter can put us on the slide that says highlights, I'll quickly go over the few things that we're going to address today. So first, we're going to talk a little bit about Nielsen's DE&I initiatives. This is a higher level view of all of the work that we're doing throughout the organization that touches some areas of broadcast, but certainly is our commitment to the industry. We'll talk specifically about some updates we have to our broadcaster reporting policy that are, perhaps one, among others, one of the most important things that advances we've made for equity for minority-owned broadcasters. We're really proud to share this with you. John, my colleague, will talk about measuring diverse communities and some of the method enhancements. We'll talk about what's happening with radio listening, some COVID insights, and then we'll end with Q&A from our moderators who will take us through any specific questions or any notes from the audience. So next slide. And next slide. Let's take you quickly through some of these. I've listed them all here so you can do a screenshot, but I'm going to walk you through some of them. First of all, high level at Nielsen, we stand for counting everyone, and counting everyone is incredibly important. We want to ensure that all voices are not only counted, but also heard. And that's not only within our organization, but of course with our clients as well, subscribing and non-subscribing clients. It's very important to us to understand the industry and how perhaps we can help support the industry from all angles. And because we measure everything, we have a very unique perspective, and we can also see the richness that diverse communities offer and the organizations that serve them, right? What they bring to our culture and our economy. So we are doubling our efforts to make sure that we are as vocal as we can be, vocal advocates and allies for both the communities and the businesses that serve them. So I'll speak to a couple of those as we move through this deck, but just to put a pin in these quickly, a few of them will be our census and voting outreach, the minority broadcast policy enhancement that we'll talk about in the next few slides. Trust and accountability. We think it's important to share with you all that we're making strides internally as well as externally to ensure that our people know where we stand on diversity throughout the company, our people, all the way through our products. So I'm not here to talk with you about what we're doing internally as much as to say that as we promote diversity within our home, that means that our businesses and our business gets better. The unique lens that we have, that we look through for all of our businesses, get better. When we view our data and our products and our offerings through a diverse lens, this provides more opportunity. And we'll talk more again specifically about one of those wonderful enhancements shortly. Safety is one of the things we're focusing on at Nielsen as well. And when I say safety, I mean the commitment that we've made to our people within Nielsen, that there is space and room for difficult conversations about race, about personal experiences, etc. Because we know that those conversations, whether they're about their personal experiences at Nielsen or about product enhancements, suggestions, business decisions that support diverse communities, are places where we want to have conversations. And then, of course, we're doubling our efforts and our external influence. So where we can, we will continue to look, to press forward for representation and inclusion through flexing our muscle with elected officials at any level on the importance of representation, our influence within the industry and clients for the value of inclusive content, diverse audiences, and diverse owners. Or through our community outreach and participating in a bunch of civic activities like census outreach and promoting the importance of voting and being represented. Of course, that's core to our business. And so we think it makes sense that we extend ourselves in communities this way. One of the other wonderful things that we're doing, and we know will be a benefit to many of you listening, and then of course to more of you as we extend the program, is we are making a lot of our resources available for small business support. So as one example, we're contributing to Black community organizations, small businesses, and we're working with partners like National Urban League and others to develop programs that help Black-owned small businesses that have suffered, along with other minority businesses, not only from discrimination, but from the impacts of the global pandemic and the current situation. So as an example of that type of support, we have soft launched, but I think today is the hard launch day. Either way, it's available for you to look at a new website for Black-owned small business owners to find opportunity, support, and community. And it's all powered with Nielsen data and expertise. So we think as broadcasters, you will find this very valuable. It will serve as a one-stop shop to connect you to Nielsen's resources with other Black-owned businesses, and for us to share our insights directly so we can help fuel growth for these businesses. There's pro bono consulting opportunities, supporting supplier diversity and beyond. And we know that those of you that are outside of the Black small business community are asking how and when will we evolve this over time? The answer is shortly. We have plans to expand it to include resources for all minority-owned small businesses in the coming year. And then lastly, on our small business support, we're really redoubling our efforts to provide the press and the business community with information on the economic power and impact of diverse communities. Certainly, you've seen a lot from us in that space this year, and we're hoping that over the next coming year, you'll continue to see us support the value of diverse communities, of diverse broadcasters, of diverse media, and you'll see it in, in all the places that we have access to to influence. So in media, sports, and culture. And we will make all of this available, this data available via the public channels that you're probably familiar with or through other resources. So we're really happy for this new effort that we have through DE&I to ensure that we support small businesses and they receive the same sort of support and access to resources that we know larger businesses do. And we know this is important to the council folks here. And the last note on this slide is our community engagement and grassroots and industry partners. This is incredibly important to us, and we know to you, because Nielsen has long recognized that we have a responsibility not just in counting and accuracy, but also in ensuring that communities know the importance of them being counted. So we've partnered with a bunch of different organizations. I'll give you a few examples. The Ad Council, both monetary and in-kind donations to the public service announcements that they have done to debunk stereotypes, to eradicate hate. We work specifically with census. And I'll give you one example. Everyone did their own sort of census outreach and census campaign. Obviously, for Nielsen, we use census as the basis for the foundation for our research. So it's very important to us. We have a business interest in the count being right, but we also recognize our community responsibility. So as a note, we partnered with Altamed, who some of you may be familiar with. They're one of the largest healthcare providers in California for diverse and minority communities. And we, at a value of a little more than $300,000, we provided some of our calling representatives to do phone banking for Altamed to remind people the value of being counted in the census and why it was very important for them. A little more on census, some things that we did in our own house. We developed a Nielsen website, Project True Count. We taped influencer vignettes with people who are high profile within our diverse communities to help encourage people to be counted. Many of you remember at the beginning of the process, Nielsen filed an amicus brief to ensure that that the citizen question wasn't included. We also engaged in MRC approved communications that we sent to TV and audio panelists, encouraging them to complete the census. And we had several outreaches. If there's any questions on that later, I can let you know the number of people we reached out to and what those response rates were. And then the last thing on this list, which I think is important to this group as well, we've made a commitment to expand our diverse thought leadership, and we're going to be expanding that messaging beyond what you have typically seen from Nielsen, which has focused on perhaps 2 or 3 ethnic groups. We've recognized for quite some time that it's been important for us to provide more detailed data on subgroups. And so we know that those types of insights that we put into the marketplace and those types of storylines are valuable not only for members of the community to know their power, but also for brands and advertisers to understand why investments in these communities are important. And certainly for those of you that are specifically working in those communities or serving them with your stations, this is important information that you can use as you're having conversations with Madison Avenue or whomever you're looking to receive some investment from. So next slide. One of the really important things, and I think the reason hopefully why we're here, or one of the big takeaways, if you take anything away from this conversation, my opinion is this is one of the most important things, and I hope it is yours too, that we've offered for minority-owned broadcasters for quite some time. So to high level it, we have updated our broadcaster reporting policy. Some of you have seen some of the communications that have come through. The title of those communications, I think, are called Subscriber First. Essentially, it's an updated broadcaster reporting policy. So let's go through what is really important and perhaps a legacy stamp on Nielsen's commitment to inclusion and equity initiatives in audio. We're always evaluating new ways to enhance quality and equity through the implementation of new initiatives throughout our services. It's one of the key responsibilities of my role. And we are proud to announce our latest audio inclusion and equity initiative, starting with the January 2021 PPM monthly report. Minority-owned broadcasters, Black, Hispanic, Asian, female, and nonprofits, regardless of their subscriber status, will be reported in the summary data set if they have more than one mention in the metro. And I'll break this down a little bit and we'll answer some questions on it, but that's the big news. And it's a really exciting change to our broadcaster reporting policy. And I want to make sure everyone read that correctly. I think everyone's on mute, but hopefully there's some cheering. Minority-owned broadcasters and nonprofits who meet the criteria will be reported in the summary data set. That criteria, again, there's a few caveats. The most important ones are there is an annual revenue of less than 7 million per market at the cluster level. Also, nonprofits will also be listed as long as they are publicly owned or they hold a 501c3 tax status. And so again, broadcasters who meet this threshold, they need to have at least one mention in the metro, will be reported in the summary data set, which you all know is the data that is used by software solution providers that process data. So the media planners and buyers that evaluate what's happening in the marketplace will be able to see your station as long as it meets the thresholds and the criteria that I have mentioned. This makes minority broadcaster data available to agencies and planners who have summary data set subscriptions from Nielsen to evaluate. So we're really excited about this. The change only affects the summary data set. Subscribers are still able to see and use audience data for non-subscribing stations. But we think that this is a really great move toward equity and inclusion. And we're really proud to bring it forward. So we hope you think so too. And we look forward to hearing some questions about it. One of the other really important initiatives, equity and inclusion initiatives that we're going to bring forward in first quarter, and this is really important. It's a nuance, and in particular in Hispanic and Black broadcasting. We've heard this for some of the challenges in this space for quite some time. And so let's talk you through some of the expanding choice for self ID. So as you know, certain stations have have certain options to choose from when they self-report their station information to us. You have format names, and then you can choose what those are. And it is much more complex than that, right? We know that this information is used by planners, buyers, brands, marketers to help determine where they want their brand to be, the type of audience they're trying to reach. And so to respond to marketplace requests to build some equity in that space, we're offering a choice of new format names when a station self-reports their information to us. And you can see a few of those listed there. If you are an urban contemporary station, you can choose to use that as your format identifier, or you may use the option of hip hop. and R&B. So what's wonderful here is we're not taking any options away from anybody. We're adding additional ways for you to self-identify. We think that's the right direction. We think that for some broadcasters, that's a choice they may choose to make for business reasons. And for others, they may choose to stay with the formats that their clients and their brands, the brands they work with, have come to love them as. So we think this is a great, another important equity initiative. We hope you do too. And these, again, are the two big takeaways that we hope you have from this session, along with some of the content that my colleague John is going to share with you. So John, I'll turn it over to you.
All right. Thank you, Stacy. So I'm going to walk you through on the next slide how we're doing right now from a Nielsen audio perspective. That's, of course, our radio segment. How we're doing with measuring diverse communities. And then I'll talk about another big methodology enhancement that we just rolled out. So right here in front of you is a bunch of numbers, which is detailing for you what does our sample look like? The technical term is INTAB, but what does our sample look like across the nation in terms of these various ethnic groups? So on the left side, you've got our PPM markets. Those are the biggest radio markets, the top 50. So New York all the way down to Hartford and Memphis. On the right are our continuous diary measurement markets, which are the next 40 or so markets, places like New Orleans and Oklahoma City and Honolulu. So we've got a good chunk of the US represented here. And we're giving this to you in this form because this is our most current data. We have numbers in the PPM markets up through the October survey, and in our continuous diary markets, we run through September. There's a little bit more of a delay there, but these are our most current numbers. And what we're showing you are indexes. So quick math lesson, a 100 index means we're exactly at target. It means you're hitting exactly the number that you want to hit. Above or below, that's how much over indexed you are or under indexed. So what you can see, and we've given you some comparisons year over year, is that in the PPM markets, we're above target across the board. So we've got 9% more sample than we need overall. Remember, more sample is good for everybody. And when you look at Black and Hispanic parts of our panel, they're 15 to 20% above target. So pretty consistent year to year. I know you've met with Nielsen many times before. Many of you on the call, we've been in the trenches together, hashing this out. Over time, Nielsen is really spent a lot of time and money on perfecting, not perfecting, but increasing our representation. It's not perfect, right? It's not a perfect science. You're never going to hit exactly every target, but you always want to be improving. And that's the point I'm trying to make, is that we've been doing this for years and years and decades, and we continue to evolve as well, because just because we have something good today doesn't mean that's going to work down the road, right? The challenges we face of getting people to respond continue to change every year. And Nielsen, I think, is the best positioned company to make sure that we are representing everybody equally in a good way across all of our panels. So PPM looks great. Our continuous diary measurement markets also look solid. Overall, we're about 6% over our sample. Our Black sample is right there at target. Hispanic is something we are continuing to work on. We're at an 84 index currently in the September book, and that hasn't really changed since last year. So we're working on it. It's something we are aiming to increase. Remember, response rates differ in terms of different markets. So we're talking about some smaller markets with smaller populations. That's a small reason why the numbers look a little bit different. When you have smaller sample targets and smaller Hispanic pops in places like I mentioned, a couple of diaries here or there can make a difference. But again, something we're working on, because our goal is to deliver every single cell at 100 or above. When we don't, that's where weighting kicks in. I'm not going to drag us off into a discussion of methodology, but that's kind of how we do what we do. And as Stacy said earlier, that's why everything from the census on down matters deeply to us, because the census gives us an accurate count of what America looks like. Our job is to make our panels match that composition. So that's a quick update on how we look right now in our largest markets with our samples. The next slide will take you through our biggest methodology enhancement that we've rolled out in several years. And this is now in play in the PPM markets. It's something called a headphone adjustment. Why are we doing this? Well, we need to account for the variety of ways that panelists use audio, and in specific, they listen to radio station streams. So our meter, as it stands today, the portable people meter, is not able to capture Bluetooth. It's not able to adequately capture wireless headphone usage, which is exploding. Skip, you live in New York. We talk about this a lot. You walk around outside, everybody you see is wearing a Bluetooth headphone. So it's important for us to be able to capture all of that usage. And we've rolled this out by diving into the science, doing follow-up surveys with former panelists to ask them about their headphone usage. And we're using those to guide us, those survey results to guide us in calculating this lift for our encoded radio station streams. We've quantified the relationship. We've done it by demographic, by day part. In the end, it's live right now. It is in the numbers in the October 2020 PPM monthly data. And in a few minutes, I'm going to give you a little bit more on this. So it seems a little bit dry right now, but this is a big deal. Our goal is to measure all audio everywhere through any device. And this headphone adjustment was the best way that we could find to account for, as I said, the fact that consumers always stay ahead of you, right? Consumers are always using the next device, the next technology, the next platform. And it's important for measurement companies to adjust to that. And this is our way of doing that. So it makes our ratings more equitable for everyone. Now, the next page, I'm going to dive in now to what we're seeing with radio listening. So Skip set it up at the beginning of the call. It's been a crazy year, right, for all of us. Let's start by talking about what's happening with reach. That's one of the calling cards of radio. It's the #1 reach medium as measured by Nielsen. And what's happening to that as we've gone through the months of this year with COVID. So what you see on the screen right now is a bunch of bar charts showing you the total weekly radio usage audience, the total what we call weekly cum in those PPM markets, starting all the way back in the March survey and running up through the October survey at Nielsen. And as you can see, COVID came about in March. We went into the lockdown period of April and May where radio listening was definitely impacted. And then as things began to reopen and began to change in the summer, we saw that audience slowly begin to grow. And we saw a lot of stability in the summertime as well. Now that we look at October, we're seeing even more growth. Now, I do want to point out at the bottom, we've actually got the date ranges laid out for you here of what these surveys actually account for. In the Nielsen world, the October survey is not really October 1st to October 30th. Our surveys are all 4 weeks long. There's actually 13 of them each year, if you do the math, 54 weeks a year. So they actually bridge a lot of months. So we put the dates there at the bottom to kind of give you a sense of what you're looking at. The October survey really ran through most of September and into early October. Now, the next slide is going to show you the same comparison, but for our average quarter-hour audience. That's where the ratings come from. That's where this all sort of the rubber meets the road. From a buying perspective, ratings are what everyone transacts upon. So average quarter-hour is an extrapolation of our cum and our time spent. When you look at the average quarter-hour audience, we are definitely seeing significant growth in October. And if you compare it back to where we were in the March book, we're at about 95%. So doing a little bit more of that index comparison, the October number across the PPM markets for average quarter hour was 95% of what the number was in March. Now, part of the reason behind that growth is organic, people's behavior. We're moving out of summer, right? We're post Labor Day in our October survey. People that are able to go back to school are doing so. People that are able to go back into a workplace are doing so. Traffic may be getting worse. We've all been following all the stories about what's happening in America right now with coronavirus and with the way people are acting. And the point is, in October, we're seeing that behaviors and habits are beginning to shift. They're not normal again, but they're beginning to shift back towards a more normal point of view. And because of that, radio listening is rising. Now, the next slide is going to quantify this for you. Let's go back here for a minute to that headphone adjustment. So I told you earlier, it was going in with the October survey. It adjusts radio average quarter hour audience upward to account for those headphone usage cases. And interestingly, when we previewed this, when we talked through this with the industry, we said we think it's going to add somewhere between 2 and 5% to total radio average quarter hour. And wouldn't you know it, in September, 4% came from headphone. The additional 2% there was organic. So what this means in front of you is that the October numbers across the PPM markets were 6% higher than the September numbers. And of that growth, about 2/3 of it came from that new headphone adjustment. The additional 2% came from that organic behavioral growth. This is a one-time trend break. Headphone adjustment goes in with October, and it's now always in there. It's just automatically baked into the numbers. So going forward, whatever growth we expect to see is going to be purely behavioral. But in this particular month, in October, it made up about 2/3 of the jump that we saw between September and October. Now, the next slide is going to walk you through what's happening with our day parts. So people that buy radio specifically and they look at certain times of the day to buy, this is a very important slide. So what we're seeing is that recovery story that we've mapped out for you, that's continuing. The drive time in particular, that's morning drive, or the columns on the left there, Monday to Friday, 6 to 10 in the morning. That number actually jumped 11% between September and October. That's a big jump, and obviously a very important time of day for radio. The middle of the day, that's the middle section there, is at a 96 index compared back to March. Evening drive at a 94, and weekends all the way over there on the right, they have actually surpassed where we were in March. You know, a lot of this kind of makes sense. You know, think about your experience. Think about the way it's been in your hometown since COVID came about. You know, what does the Lowe's parking lot look like on Saturdays? It's been pretty busy where I live, and probably where a lot of people live. You know, weekends, the behavior didn't really change all that much, but where things really did change when COVID came about was lockdown, staying home, not commuting, shifting into a work from home model. So as a result, those drive times, right? The morning drive, the PM drive, those were pretty heavily impacted. But as we've moved forward, as we moved into the summer, and now as we move into the fall, we are watching that recovery continue. As I said earlier, the more people leave their home, the worse traffic is, the more you have to drive your kids to school. Honestly, the better that is for radio use. That's when radio is primarily consumed, is when you're out of the home, and particularly when you're in the car. The next slide kind of nails that down for you. So this has been a big question a lot of our clients have been asking us. You know, when COVID came about, a lot of people assumed radio listening just disappeared and went away and nobody was using it and it was no longer an out-of-home medium. And that's simply not the case. You know, what we found by quantifying this, as you see here, even as we go through into our growth period here in the fall, we're still at, you know, 70%, nearly 70% of the average quarter hour listening that's taking place around the PPM markets is happening out of home. As I said earlier, radio is an out of home medium. And even during those lockdown periods, April and May, it was still well more than half. So things did change. As I said, those factors really impacted people's behavior, but radio continued to serve those who were out of home, right? Essential workers, people that couldn't work from home, people that had to keep going into a job. All of those audiences, all of those consumers, that's who radio was reaching even during the lockdown period. Now, as we head into the fall, it's reaching everybody who's out of their home on a regular basis. And then my last slide of this section, I just want to walk you through what's happening to the different types of radio that we have. These are these formats that Stacy walked you through a little bit earlier. What are we seeing? Well, overall, things have been pretty consistent. So these are share numbers. And in the radio world, a share number is, of all the people using radio, how many are using my station, or in this case, my format. And we've rolled this up for you across all of those 50 markets. And what you see is, first and foremost, news talk. That's the #1 format of radio overall. It has been strong and it's getting stronger. Can't wait to see the November numbers. There's certainly a lot to talk about right now, but people have been very engaged in news and information from the beginning of this pandemic and now as we go into our election. But music-wise, take a look at those next few formats down, right? A lot of those music formats have been very consistent and in a lot of cases stronger in the summer. And that's something that we expected. So pandemic or no pandemic, generally what happens in the summer is formats like country and classic rock and classic hits and top 40 and urban contemporary or hip hop and R&B. Those formats generally improve a bit in the warm weather months. That's just kind of a behavioral thing that we've noticed. And those things all happened here too. So I know this is a bit detailed for you, but I wanted to give you a look at, what we're seeing, and it's just interesting how it matches up to what you would expect. The last thing I'll point out here is take a look at sports. So sports jumped about 20% in October because, remember I told you the October survey was most of September. NFL was back, right? People are longing to talk about and debate who to start at quarterback and what plays to run and all that kind of stuff. And remember, sports was kind of a wasteland there for a few months without live sports here. So just again, very interesting how you see kind of like real world experiences. They show up in our data, which we find very gratifying. All right, I also want to take you through a couple other reasons why we think things are in the right direction, why that recovery is happening for radio. So the next slides will take us through some highlights from some consumer studies that we've been doing. So I just showed you what's happening in the data. Here's why it's happening. So we've done a series of consumer studies around the US where we've gone in and asked people all kinds of questions about how is your life affected by COVID? What are your sentiments? What's changing? So the first one is here. Among those that are employed, more are now working outside the home. We did this consumer survey 4 different times, back in May, end of June, and about a month ago in the beginning of October. And as you can see, right, the amount of respondents who told us they're now beginning to work again outside the home, that number is rising. The next slide also conveys this in terms of time spent in your vehicle. So there's animation here. So the first animation is just amount of time spent in your vehicle in total. So go ahead and click through that, please. Thank you. The question is, how much time did you spend in your car or truck yesterday? So that number is on the rise, right? It's basically doubled since early May, which makes sense. Lockdowns have been eased, mobility has increased, traffic has gotten worse. But if you animate it one more time, you're going to see in purple the heavy radio listener group. That is way up. These two things are tied together. You can't, there's no chicken or the egg here. They both work together, right? People who are heavy radio listeners, they're that way because they tend to listen more in the car, right? Those things all flow together. And that number has also doubled. So that's very encouraging. Now, another factor to consider is schooling. And the next slide will take us through that. So in addition to working and working outside the home, school is back in America. And what we have found is this varies greatly across the country. But amongst the people that we surveyed in our national panel, we found that about half have some in-person classes. So about half the people that we asked said that in some way, shape, or form, their kids are attending some sort of in-person classes, whether that's fully in person, that's the blue group, or the mixture group, which is the 26% doing a mixture of the two. So that means you're having to leave the house to do that. What does it look like when you leave the house? That's the next slide. How do you get to school? Well, of those that are attending classes, about half of those are doing so in a vehicle. For those of you that have kids that are in like sort of school bus age, it's amazing how fewer people are on the bus now. I have 3 kids. They ride the bus to school, and there's like 4 people on the bus. A lot of people are driving. Different change, right? Different behavior pattern because of COVID. And so the last slide here is going to be, what are you doing while you're on the way to school? We found that, not surprisingly, as we said, when you're in the car, radio is your dominant audio choice. That's happening here too, right? So 62% of the folks that are driving their kids to school, the radio is, quote, always on, and another third of them have it on sometimes. So we wanted to layer in these consumer data points here to kind of back up what we're seeing in the actual hard ratings data. Why are things on the rise? Why is listening increasing? Why are drive time numbers going up? People are going back to work. People are more mobile. People who have school-aged kids have the opportunity now to potentially drive them. So there's a lot of things at play here. That's something we've learned, I think, over the last 9 months. There's no like one smoking gun factor here. There's no one thing you can point to in a market that says, oh, this market's going to be up or down or increase or decrease. There's about 10 of them or maybe more. And understanding how these all work together, I think, is really key to understanding what is happening to radio use. So the recovery continues. As I said, we're excited to see what the November data looks like as we see more of these trends taking place, and also larger societal trends going on too. all of the coverage going on this week, sports, music cycles, Christmas music is starting. So there's a lot of things changing, and we're excited to see how that looks on the radio dial. So that wraps up my section of the slides. Thanks for the opportunity. Stacy, I know we want to probably address some questions, so I'll bring you back in to guide us through that, please.
Great, thank you so much. Well, and actually, before we do, I wanted to mention one last thing that I forgot. I forgot to mention during my presentation when we were talking about Nielsen's initiatives. One other initiative that you may have heard a little bit about. This is actually for television streaming and SVOD, but I still want to mention it here because I think we're probably going to have a robust conversation about all of it. We're introducing a new view through which you can look at television data, and by television, again, I'm talking about streaming, cable, and traditional TV and broadcast. And that's called inclusion analytics. The reason I bring this up is because I think it underscores Nielsen's commitment to ensure that we are building and supporting diverse stories, and not just stories, but supporting also diverse content. So what are we doing? Nielsen's inclusion analytics is a data product we're going to introduce on an annual report basis to the industry, community groups, advocacy groups, all of our partners. And essentially the goal is to be able to take a look at the program level, network, or genre level benchmarks against what the visibility on screen, so share of screen for diverse communities, against what the television universe estimates are. So we are hoping that inclusion analytics will help drive accountability for diversity and diverse content among broadcasters and others. We will be looking at on-screen representation of talent by gender, race, ethnicity, sexual orientation, and many, many subgroups within all of that. So that's, as I mentioned earlier, we know that these very high-level groups and sort of a myopic view at ethnic groups is not the way that the industry wants to see the data anymore, and not the way that we perhaps want to proceed. So we'll be bringing that to you in just about 3 weeks, our first industry report for television, for broadcast, cable, and streaming on what on-screen representation looks like by many, many different cuts of ethnic, gender, and sexual orientation data. So that was the one thing I wanted to point out, and then I think we should open it up for questions. I think Jim's having
Well, thank you. This has been can you hear me?
We can. There's a little delay, but we'll pause and let you speak.
Now? Thank you. Prepared in advance. I think some of them have already been answered, but I did want to, Stacy, very early in your presentation, you mentioned a new website for small businesses, Black small businesses, et cetera. And I was just wondering, you said you thought it was.
I do have one for you. It's a little complex. I'll put it in the chat for everyone as well. But it seems it's a little bit long. It's you could probably Google Nielsen small business support, but I'll go ahead and put it in the chat as well.
Great. I guess our first services are to ask.
So we're having difficulty hearing you, Jim.
I'll turn over to.
We're having difficulty hearing Jim, but I think we know what that question is. I think he's asking about new tools and services. So do you want to go ahead and address that, John?
Right.
Sure. Hopefully I gave you a good flyby on what we're seeing in the ratings, but in terms of what broadcasters can use, in addition to the core Nielsen ratings, which are the backbone, they're the currency of advertising and radio, the two biggest advancements we've made in the last couple years. The first is something called Nielsen Media Impact, or NMI. It's a program that brings together all the pipes within Nielsen. So all the data pipes, TV, radio, Scarborough, outdoor, everything, and puts it into one place and lets you do really advanced analytics and planning. And I can tell you that one program in particular has directly caused different advertisers to consider radio now. So, for example, Procter & Gamble, the world's largest advertiser, is now sort of part of the radio buy because of that particular piece of software, because we could show them, because radio clients could show them, here's what happens if you go into a market and you cap out on TV reach. You max out on where you are with TV. What happens if you bring radio in? Because remember, radio reaches different consumers than TV does. So that's one of them is Nielsen Media Impact. The second one, in terms of the broad audio landscape, is something called the Nielsen Podcast Listener Buying Power Service. That's a Scarborough report. Scarborough is a qualitative service, and that has also gained a ton of traction in the industry. In fact, recently NPR signed on for that service. They're one of the biggest podcasters out there. It lets people get away from just downloads and how many people clicked on my podcast and into things like, what kind of car brands are you going to reach when you advertise on these podcasts? And what kind of consumers are you reaching? So just a quick flyby on a couple of things. We know that the ratings make up the basis of the currency, and it's now our job to help bring in all the other color commentary. Who are these consumers? What happens if you reach them? And how are they going to build your business? I think that's where Nielsen is really uniquely positioned to offer solutions that nobody else in the industry can.
I want to first thank both Stacy and John.
Excellent. Are you hearing me now? Can you hear?
Should I speak now, James? So first, I want to thank Stacy and John for an excellent presentation. And I wanted to ask on this presentation about during this COVID-19 pandemic, you have been measuring, have you found that streaming consumption of audio content was way more than terrestrial? Do you have that breakup on that? How much was the terrestrial radio consumption and how much was the digital streaming consumption of radio?
Right. So as it applies specifically to the radio content, that's obviously our main purview. So that's radio stations taking their content, making it available through a digital stream. Yes, as you would expect, particularly during those lockdown months, the streaming side increased, right? As over the air decreased, particularly with car listening falling. Yes, the digital footprint did increase, but it was still a majority of it being done through that AM/FM, that over the air, kind of like that out of home chart that I showed you. Even though things really changed in March and April and May, you still had the majority of use being done out of the home, and still the majority of radio use was being done through over the air signals. So it has increased. Again, digital has gone up, but it's still outpaced, if you will, by traditional what we call over the air consumption. Go ahead.
And
Stacey.
if you're speaking specifically or separately about sort of other services, things like perhaps podcast listening or other types of streaming like Spotify, other services, I can tell you one way we took a look at that. We have a lot of different types of data to look at, as you can imagine, but one way we took a look at it was comparing what reach. And we did this as a proxy sort of for downloads of apps, but we took a look at what the reach was of a bunch of apps in different spaces. One of the spaces was audio in February. And then we took a same look at that in August to be able to say what were the top apps that had reach as a result of the difference in those times as a proxy for, like I said, sort of downloads. And we did see that there was a number of apps that spiked, app categories specifically, a lot of them in audio, mostly toward the later part of that time period that we looked at. And I think largely, and John sort of alluded to it, I think, as people began to fatigue some of the content that was available on television. We saw this actually happen in broadcast and cable as well. As people started to fatigue with some of that COVID-focused content, they really turned to, back to their original content or to new content to distract and entertain.
For a small station like mine, WWRL, we saw a very big spike in digital consumption after April. And I just wanted to see if you saw that also everywhere. And I
Sure, and I can actually speak to that at least anecdotally. So while we were on this call, I was looking back to some data on for African American, Asian American, and Hispanics, and just some of the other shifts that we saw in content consumption. And based on, we don't have that specific answer, but based on the data that I am looking at while we're having this conversation, one of the unique things that minority broadcasters and broadcasters that focus on in-language content for groups is they offer news, information, and resources in language to communities with whom they have trust, right? I mean, this is the same thing we see certainly in Spanish language radio. We can talk about urban radio. There are resources and a level of trust that minority communities have with their broadcasters of choice, their broadcasters in language. So perhaps, and again, this is just perhaps based on the way that what I see and I interpret in the data, the resources that you provided to the community that listens to you in April, news, information, relevance, not polarizing content, perhaps content that was very directed to the community, was in fact one of the reasons you saw such a strong increase in that digital content consumption. People came to that station. We certainly saw that for the Hispanic community, and we certainly saw it for Asian American community. Well, as John suggested, as time went on, people started to level back out. So some of the things, the drops or the declines we saw early on, as everyone shifted their focus to television, definitely leveled out. But at that same time, I imagine, as you're reporting in your experience, that there were many stations who served smaller communities in language that did a remarkable job of keeping the stations informed, educated, and entertained.
Do you have any measurement of Alexa and Google Home? Because that's the other way we are finding everybody wants to consume that, and now they are requesting more and more to have that because most of them are planning to work from home now.
Absolutely. I'll let John address that. But I will leave you with a hashtag, which is metadata matters, right? So that you can be found on those algorithms. But John, you can address the work that we're doing in smart speaker space. And if I can add if needed.
Yeah, it's a good question because that first and foremost is one of the things that all radio content providers need to think about now, despite the fact that we know people are, working again and commuting again. There's going to be a segment that doesn't go back to work, and they're going to work from home, permanently or for the foreseeable future. And how do you make radio listening part of that in-home habit? And smart speakers are certainly a big part of that. So here's the good news. The way the PPM system works, it's through something called encoding. We put a watermark on the audio that the PPM registers. So it actually doesn't matter how it gets to the meter, as long as it's encoded properly. It's going to get picked up. So in terms of, is the meter able to hear stations streamed through Alexa or Google Dot? The answer is yes. And that's great. That's why we designed it the way we did. It's like you put the tag on the content and let the content flow freely into the ecosystem. And it doesn't matter how it reaches the PPM, as long as it does, it'll get its credit. But
if
again,
the question is about behavior, and I'm sorry, John, this might be where you're going.
Okay. No, go ahead. That's fine.
But if the question is about consumer behaviors, so are people increasingly using, smart speakers to access content? The answer to that is yes. We've been tracking that through Media Tech Trender, and I'm not sure actually, but through several products within Nielsen. We've been looking at these behaviors for quite some time. Certainly Scarborough is one of them. And we know that increasingly consumers are turning to their smart speakers for more than just recipes and the time, but to consume content. So as John suggested, as long as that content is encoded, we certainly will capture it, which brings us to an important point before this session ends. I hope, John, we have the opportunity to talk about I'm just going to pin it here that, all the small broadcaster exceptions, exclusions I talked about today in the reporting and the broadcaster reporting policy updates. I'm sorry, not small, minority owned. That of course includes women. It's not just ethnic minority, but that the most important thing we can do here is ensure that these stations have encoders. Encoding is incredibly important, and that's perhaps one of the charges that we have at Nielsen over the next several months as we work to implement this, is to ensure that broadcasters have an encoder, because once you have a mention, obviously, as we discussed today, that brings you into that SDS. So next question.
The point you just made, so if I'm not a subscriber, if I'm currently not a subscriber, I don't have an encoder now, so there's got to be an outreach to those stations.
To be clear, encoding and subscribing are two different things. Encoding is just lighting up your station so it can be captured. That is free. It does not require a subscription. It's just, do you want to be? This is the technology. Do you want to be part of the universe? If you do, you want to make sure you're encoded. Subscribing is obviously subscribing to the service, but I just want to point out they are separated.
Yeah,
you can encode but not subscribe.
So to your point, James, yes, we do need to do some outreach work there, but this is this is a partnership. So we want to ensure that our smaller broadcasters who are, perhaps not subscribing today, but also don't have an encoder. Some may, but that don't have a need. That's a conversation we need to have, because we want to ensure that those opportunities are available. There are some caveats about receiving the encoder, sort of, how that works. And we can certainly go through those at another time. But yes, it is a partnership. So we are hoping that stations in the market will reach out to their Nielsen person, will reach out to us, and then we, of course, will do our due diligence. And as we're having conversations, ensure that that we get people encoded who meet the criteria to be encoded. But we're excited about that. We really think, again, that our new broadcaster reporting policy is a really important inclusion and equity initiative. One of the most important we've done in audio in a long time. Very proud of that.
So for this smaller broadcasters.
Now you've talked about a number of.
So for smaller
Do we have technical glitch again?
Yeah, Jim, your audio is delayed, I think. And so that's the challenge I think we're having.
Yeah. Go ahead, Dr. Shukla.
So I wanted to ask you, on the smaller broadcasters, how can they reach out to you so that their programming is encoded? Because there's no information on your website. And most of the smaller minority women-owned stations, the problem is in reaching out to you.
Mm-hmm. So John, do you want to address that, or would you like me to take it?
Yes, I will address it. And I'm also going to put into the chat box of the meeting the webpage for Nielsen Audio, which has a way to contact and who to reach out to. So I think that's a great place to start. And as Stacy said, it's a two-way street. So it's on us to also, we see all the lists. We know every station in the market. We know what it looks like. So I said it's a collaborative thing, but let me put this into the chat box, because there is a contact option at the bottom, and that's a great place to start. Because depending on where you are, we've got, like every sales organization, we have different folks who handle different markets. Stacy, go ahead.
That actually, John, that you said what I just said, and I want to emphasize, we will do, as I said, our due diligence, but of course, we also need stations to reach out to us, right? And we've done a lot of releases, press releases, and some notices about this policy. Perhaps what we can do, and I'll talk to the team at Nielsen, is do another one that really highlights this specific component, or at least a little social outreach. So it's not, too difficult to find within the subscriber first policy. But we are going to need broadcasters, of course, to reach out to us and ask us this question, ask us about encoding. They might feel perhaps that by asking us if they think that they qualify, if they're a small woman-owned station, that they may qualify. But if they reach out to us, we might start, a sales process that they're perhaps not ready for. We are in the interest of partnering with the industry. We are not going to, march down any road we're not ready for. As our CEO has stated, and I can assure you the leaders on the audio and the television side of our business agree, we are making these inclusion and equity initiative steps because we know it's the right thing to do for the industry. So there should be no fear to reach out to us that you might get stuck in a sales cycle or something. Please reach out. We want to have these conversations. And of course, our teams know who some of these stations are. So we'll do our due diligence as well. It's a partnership.
Okay, I will take the next one then. Acting on promoting measurement of Black and Hispanic audiences. What are improving measurement of Asian audiences, Indian audiences, those what steps are you taking to get better measurement of those groups?
Sure, I'll start this one. I think the question was, what efforts are we making to improve measurement of other underrepresented audiences, such as Asian groups? As you can see, we have Black and Hispanic accounted for in our measurement, weighted for, sampled against, targeted against. How about Asians? So that's a work in progress. It's an ongoing initiative that Nielsen has. We've been having these discussions with you for several years now. What I can tell you today is that we now ask each PPM home about their race and ethnic origins, and that includes Asians. So we have the ability now to cut that data set and provide insight into how much of our panel is Asian and what does that look like by market. We're able to provide those insights to subscribers on a requested basis, and we're continuing to evaluate further enhancements. But there's a famous saying by the founder of Nielsen that was it the price of light is less than the cost of darkness. So just being able to sort of light that up, and you have to understand what you're dealing with first before you can make policies and make other steps. So that's a great first step. And from a insights perspective, even though we don't have broken out specifically inside our panel Asian, we have insights that we use via our panel, via our Scarborough panel, and via some of the stuff that Stacey, you do with our diverse intelligence series.
Yeah, and to piggyback what John said, I think perhaps we also recognize that for a lot of these smaller communities, the trade areas or the areas where the influence is perhaps smaller. So some of the most important things we can do is partner with you to have custom research and custom study that specifically address the community you want to address within the boundaries you want to address them in. And so we do have opportunities and solutions. We're not at all overlooking this component. It is important to us. Part of the reason we are here today, John and I, and we have some of our other Nielsen team joining as well. We are here because we want to listen, we want to learn. And as I said earlier, I don't know if it was either online, but I know I said it to you privately, Jim, we're committed to walking alongside, our broadcasters, large and small, subscribing and non, to ensure that we create an ecosystem that is inclusive for all. And that allows us to take steps forward on this journey of improvement if we think that's appropriate. So I hope that's helpful.
And the custom studies generally are cost prohibitive for minority and women-owned broadcasters.
Well, I think that's relative though, right? I mean, it sort of depends. We're actually doing, and I don't know how much of the specifics you want to get into here, but we're actually working on a project with a broadcaster, an Asian broadcaster in a large market that is not, we for his certain circumstances, we were able to work something out. So what I can tell you is we are endeavoring to work with the industry and provide the right types of resources. If subscribing is something that perhaps is cost prohibitive, then what we've done is made it available so that the you'll be listed now as per the new broadcaster reporting policy update. Your station can be listed. That still gives you some content to be able to work with and start conversations then perhaps around something custom or unique for your marketplace. We do want to work with the industry. We want to support minority-owned broadcasters and nonprofit broadcasters. And we think this step that we presented today on the update of allowing, of providing broadcasters the opportunity to be listed without having to subscribe, we think is a huge step and a testament to our commitment.
So do you have any success stories how this products, like custom study and all, have benefited small or minority broadcasters?
We do. And some of this alludes back to what I mentioned earlier, in a way that Arbitron was never able to do. So Arbitron was the radio company before Nielsen purchased us and we became Nielsen Audio. We got joined into the mothership that is Nielsen. And there's a lot of benefits that come from that. We're now able to be that connective tissue between the advertisers that we weren't able to do as a standalone company. So I mentioned Procter & Gamble before, and some of those big advertisers. Having the radio data in the pipe, in the system, able to be put up on a screen alongside TV, that was a huge advancement for radio. I know it may not seem like it. There wasn't a lot of noise made about it, but it was a huge advancement because, again, light costs less than darkness. Being able to see what radio delivers, that is bringing new advertisers to the space, and that trickles all the way down. So I know that you may think, well, Procter & Gamble, that's just big markets, big stations. There's some national buys going on, and that stuff goes all the way down to our smaller markets. And we've heard from our small market minority broadcasters about how important it is for Nielsen to have the data, to partner with them. We're unique inside Nielsen. We work with our clients like consultants, and that's pretty unique. Other parts of Nielsen don't quite do it that way, but that's sort of the Arbitron radio way at Nielsen. We're there to help our clients maximize the value out of our services. So we do everything from hosting clinics, both virtually and in person, to talk about the power of Black consumers, for example, or how to best reach Hispanics on the radio. We put out thought leadership pieces. We train our clients to literally help them take the data out into the marketplace. So I think that begins to speak for itself. But just to get back to your specific question, we have made an effort over the last 2 years to put out insights specifically about minority audiences and even more specifically about small market radio, because we know that PPM gets all the headlines, the big markets get all the headlines, but there's 250 markets in the US that we survey in. So the person selling radio in Billings, Montana is just as important to us as the person selling radio in New York. And so our job is to give insights and thought leadership and help them maximize their value.
And I have two things I want to add. We just learned that the public can't actually see the chat, and there are 2 links here. They are just too long for us to read out. So I am going to go ahead and tweet them on my personal Twitter handle with a link to the FCC's. My Twitter is @StaceyTheOptimist, just like it's spelled. And I will have both links, both the small business support one and the one that John Miller shared, which was the ability to learn who your Nielsen rep is so that you can learn a little bit more. I'm sorry, there's no way for us to share that otherwise, but I'll go ahead and put them on Twitter. And my handle is @Stacey, STACIE, Theoptimist, which is DEARMAS. You don't have to follow me, not looking for followers, just we'll put the info out there. And one other thing I wanted to add, Dr. Shukla, if I may, which I think is really perhaps another in one of the great stories coming out of this conversation today, is that we also did just a quick review of all of the stations that perhaps would fall under minority-owned broadcasters and meet the threshold, as I suggested, of less than 7 million per market at the cluster level, be either publicly owned or having a 501c3 status. And we learned that there are about 113 stations in PPM markets that will qualify to be listed now under this plan. And that's based on the June book, by the way. So we think, there are 107 new ones, 6 are already subscribers, but of those, these are all stations that will benefit. So we know right away that this will have a large scale impact and a positive impact for minority broadcasters. So there's just some high level, more good news. Are there any hashtags or anything that we should use, Dr. Shukla or
I hope so.
so that we can ensure people get this content?
The reference to will be appreciated. Oh, certainly not. If he, but may not be heard. But I did want to thank John for mentioning Procter & Gamble because a great deal of advertising with us from Procter & Gamble, and obviously your efforts in that regard to help educate them about the value of radio has been greatly appreciated. And so, Dr. Shukla, if you have any, I think we're at the end of our time. So, Dr. Shukla, comments you want to make? I think this is probably an appropriate time for it. You're on mute.
Sorry. So I want to thank both of you for an excellent presentation. You gave us a lot of insights into how you measure and how we can reach out to you and how we can get better rating for minority and women-owned broadcasters. And I want to thank you especially for both those URLs, because one of the roadblock is always how to find you guys. And I also want to, stress this today, that unless Nielsen steps up and gives good rating, it sets a vicious circle for minority and women-owned broadcasters, because unless we have rating, we cannot get any revenue. And if we don't get revenue, our broadcasting, our quality of programming goes down. And then again, our rating further drops and we go into this vicious circle. And it starts all with the rating, and that's the reason now the next panel that's going to be there is so well linked to Nielsen's rating, because every time you go asking for business, the first question is, what's your rating?
We hear you. We appreciate everything you've shared. We hope that our broadcaster reporting policy update, which is very inclusive, will be great news to many of the folks on your coming panels. And you have our commitment to continue this conversation and walk along this journey with you. Thank you so much for the opportunity. John, thank you for joining me here today. And please do reach out if there are any additional questions.
Thank you both again. We really appreciate it. Thank you.
Thank you, John. Thank you, Cincy.
Take care.
So that concludes the first broadcast panel. And let's take a 10-minute break, rejoin at 3:35, and we will conclude the presentation or the symposium. Welcome back, everyone. We are in the home stretch. The final panel today will be hosted by Sherman Kazard, and he will be discussing how diverse media owners can increase their access to advertising. But first, I'm going to hand it over to Skip Diller to make the appropriate introduction. Skip.
All right. Good afternoon, everyone. It's been an exciting day, and we're going to wrap it up with some more excitement. With advertising revenues over the past months in many markets bottoming out as much as 60 to 70% over the summer, broadcasters are looking forward to a big bounce back as we head into the end of the year in 2021. Our agency partners have been with us through consolidation, electronic measurement, smartphones, and now work with us in times of uncertainty, including efforts for diversity and inclusion and the health crisis caused by COVID-19. We have an experienced and distinguished group of professionals assembled with us today, and I'm so happy to sit back, listen, and learn. Media sales veteran Sherman Kizart, founder and managing director of Kizart Media Partners, Inc., and Spanish Broadcasting CEO and chairman Raul Alarcon will lead our session. So gentlemen, take it away. Thank you.
Great. Hey, thank you, Skip. We appreciate that introduction. And you're absolutely right. It's a privilege to lead this discussion with people who are actually leaders and doers in the ad space, both nationally and globally. It's a privilege to have them, but it's even more of a privilege to have to be a co-moderator with Mr. Raul Alarcon, the chairman and CEO of Spanish Broadcast Systems, who is a pioneer, and it's just a real privilege to have Chairman Alarcon be a part of leading these discussions with these agency leaders. So welcome, Chairman Alarcon.
Thank you, Sherman. Thank you very much for your kind words. And thank you, the gentlemen here today, for all of their efforts. We're all very greatly appreciative of everything they've done for minority broadcasters and minority advertising.
Thank you. It's so appropriate that in a access to capital symposium from the FCC to have an opportunity to talk about the importance of access to advertising capital, because that's where the rubber meets the road in the broadcast industry, and especially now. So I want to thank the person whose idea that was Dr. Nimisha Shukla, who's one of our fellow committee members. She thought it was important as she led the discussion in the previous panel about currency, which is Nielsen. But so to go from the talking about currency, which Nielsen is the currency of our industry, to having a discussion with the CEOs of both African American and global media agencies about how important it is, relationships with their respective companies and industries around driving revenue to minority-owned, Hispanic, African American, Asian, and all the other minority groups out there. And what I would like to certainly convey to all of our committee members and everyone that's listening is that the timing of bringing these leaders together couldn't have been better, because certainly there's been a lot of discussion about what's been happening in our world with the Black Lives Matters movement, and how that has impacted corporate America, because it has. I can think about conversations I've had with leaders like Doug Ray, Bob Wingo, and Steve Williams, and to a fault, every single one of them said that this issue about how their clients, global marketers like the Procter & Gamble's, the General Motors, the T-Mobiles, the McDonald's, and others, are all pivoted around how are they doing business with minority-owned media companies. And the thing I'm most excited about is that everyone on this panel today will be talking not individually about major initiatives that they are going to be sharing with our committee today, but as well as significant initiatives that the industry is launching, and they're important. So how we're going to do this is we will introduce each panelist individually, and they will go into their statement and their overview about exactly what they're doing and what the industry is doing. And I'm going to start with Chairman Alarcon, who will introduce our good friend Steve Williams, the COO and the global COO of of Essence Communications. And also, Steve also serves as the chairman of the Media Leadership Committee of the 4As. So Chairman Alarcon.
Thank you, Chairman. Again, it's an honor to have these gentlemen here with us today. And Steve has played such an important role as far as this segment of the industry is concerned. And it's important. I think it's quite proper that this symposium ends with this panel today, because everything we've heard today regarding funding for minority broadcasting, the tax certificate program, all of the initiatives and issues that we've heard about the Nielsen, measuring the audiences and so on, it all ends at this doorstep here. It all ends right here, because as we all know, without sales, without revenues, without the money to back up all of this, we really don't have an industry to speak of. And so I'm very appreciative to Steve and the other panelists for all that they've done. We're certainly going to hear more about that in the next few moments. I had an overall question for Steve, if I may, Sherman, and for the others also. I'd like to set kind of a backdrop. A lot of progress has been made by you gentlemen, Steve, by yourself and the others. And it's been a long time coming. And where we are now is such an important moment in time because of everything that's swirling around us. And I just wanted to ask you an overall question. And that is, despite the progress have made, do you think that the problems that the industry has had, are they due to ignorance on the part of, or lack of knowledge, let's say, on the part of the clients and the advertisers with respect to the enormous potential that, let's just say, minority audiences have in this country? Is it, in your opinion, throughout the years, you've made tremendous inroads. Throughout the years, is it your opinion that it's been ignorance, or do you think that it's been biased? I just wanted to set this up, and before you relate all of the great things that you've done, I was just wondering, because the answer to that question today, in the past, and going forward, is so critically important as to how we address this situation. I was just wondering if you had some, if you, Steve or anyone, had any thoughts on the question.
Well, and that's an excellent question, and thank you for it, Chairman Alarcon. And Steve, we certainly want you to address it. And if you could address it in the context, Steve, as you know, you've worked closely with Chairman Alarcon's president and COO, Albert Rodriguez, along with others of the Hispanic Audio Coalition, on how we can improve the playing field. And you personally wrote the Fair Play Charter and had a major part of the 5-point plan. So if you could answer Chairman Alarcon's question in the context of also sharing with this entire audience and your colleagues about what you've done around Fair Play Charter and the 5-point plan.
Right. Well, first of all, thank you for the generous introduction, Raul and Sherman. To give a little bit of context for everybody on the call, it may seem a bit weird with a quaintly British accent jumping on talking about such a subject in the USA. I'm a proud resident of your fine country, residing in New York for the last 8 years now. So I'm doing my best to get assimilated. But I think one thing that I noticed when I came into the market was there's a whole different level of unintended consequence and bias in the US versus other global markets that I'd worked in previously. So I think I would say, Raul, the quick answer to your big question would be, I think there's been absolutely a whole level of unintended ignorance, because I do believe people have good in their hearts in our industry, but there's been unintended ignorance. And I think the events of the last few months now, which are certainly events in history, right? And sadly ongoing events are as a consequence of it not, frankly, being called out in plain sight. So I'm pleased now that we have an industry, just speaking for the advertising proportion of this, that has the issues, I do believe, in very, very plain sight. And I know Doug's going to come on and talk about that from his point of view. And I'm here largely today representing the view best I can, partnering with Marla Kaplowitz, the CEO of the 4As, the agency body responsible for raising the bar in the industry. So what we recognized, I got into the position of chair of the 4A's Media Leadership Council about 2.5-3 years ago now. What we recognized was, and I'd like to give a shout out to Bill Konigsberg here, because Bill was the very effective originator of the first stage of Fair Play Charter before my time. But what we did was we took a look at that back in January, February 2018, and decided to tune it up and put a wee bit more purpose into that and bring in the language of minority owned and targeted, and just put a bit of a point to things. I want to jump forward from that though, because the events of this year, I think, again, in using the language of in plain sight, we needed to do more. We couldn't just republish the Fair Play Charter. It simply wasn't enough. I think it's fair to say, and I'll leave Sherman and others here to comment on success. I would call it relative success in the Fair Play Charter. Did it take us leaps and bounds forward? No, I don't think it did. Hence, we wanted to build on the Fair Play Charter and put into place what we're going to be calling, and is now published on the 4A's website, as the five-point commitment from the industry to Black, Indigenous, people of color, media owned and targeted media platforms and vendors. So what we've done effectively is we've created real purpose, because at no time like now, it just occurred to us that now is the time for driving true equity. And I think that's the piece, if I may speak on behalf of the industry, that is the piece that we've left out of the conversation for so long now. There's a lot of talk about equality and everybody thinks they're being fair. And I've no doubt about the intention there, by the way. But I think we've really, we've come to the realization now, not before time. So I want to spend the rest of this couple of minutes I'll spend with you now looking forward as opposed to representing the past. It's our clear intention to rally around the BIPOC media owner community in solidarity and to secure their commercial futures. It's really important that those voices aren't lost, and to do so through a sustained program of education, equity-based business protocol and measurement. So hence our industry's commitment through the 4As of driving a clear intention behind equity into business across media planning, buying and research. And there are 5 commitments, and I'll happily take further questions on it, but so not to monopolize too much at the start of this important conversation. The first one is about driving an anti-racism agenda and narrative. And we've got task forces behind this. So we're committing to working with agencies against racism, a really plain statement right up front, and how we'll use our influence and our resources to eradicate bias of all kinds. And again, I'm going to be generous here and say largely unintended bias, right? But we can stripe the unintended thing now, because we need to take overt action. So there are some task forces behind that, and I'll come back to the task forces. The second important commitment is to eradicate the term general market once and for all. This was one of the really weird things as a Brit coming into the US a few years ago now. When I heard about general or total market, it was an anathema to me. And I say that with no arrogance about coming in from an outside market. I was learning, but frankly, this term is no longer acceptable when it comes to media planning, buying and placement. So we need to educate the very young people that are all continuing to come into our business to remove that from the agenda, to make sure that trading and negotiating protocols don't take that into account. So there's a lot behind that, but there are a bunch of task force actions that we can talk through there as well. The third one is about planning to a standard and how we can create, I had a really good 2-hour session with a bunch of very senior strategists and planners with Marla this week on this to kick this one off, making sure that we put an accreditation program behind how we educate media side practitioners to ensure that there is just a common standard when it comes to the playbook of how we pride ourselves in this industry, as the irony on targeting discrete audiences and segmenting this and this, that, and the other. However, when it jumps into the negotiating field, then it seems to be so far all bets are off. So once and for all, we're going to lay down the playbook on what a good planning standard looks like. And we're going to expect agencies to step up to the plate and put their people through this program. We're also going to expect and hope that the BIPOC, and forgive me for shortening the segmentation behind BIPOC as I have this conversation, but the BIPOC media owner community to step into us with that and help us with content around it. And we're also going to be working closely with the ANA Media Advisory Board to ensure that they are aware of that as well, because this is a pincer movement from all around. It's not just about what the agencies do, it's about how we build better relationships with the media owner community in this regard, and it's about having clients in lockstep with us as well as creatives in lockstep with us as well, I would say. The fourth piece commitment is about making the work count. So this is a little bit more in the order of creating an initiative for senior industry mentors to think about how we create a shift of investment to BIPOC owned media companies, and there are a number of initiatives, and I know Doug's going to come on and talk about it from an Aegis point of view, and I can give a couple of headlines later from a Group M point of view if you like as well. But the goal is to create, if you will, a new business stream and a new business opportunity to make stuff real along the way. Again, we've got another set of task force actions going behind that. And the last one, and I'll stop there, is going to be about how we measure progress, because if I'm honest, I think where Fair Play Charter got to was lots of good intent and lots of reasonable language, and everybody signed up. And then how do we measure it? Yeah, again, we pride ourselves in an industry on effectiveness and measurement, and so we're committed to bringing this in. And that, by the way, is across a spectrum for what we do to encourage help and equity again around, Nielsen Comscore, for example, getting involved to help with smaller media owners in your communities. Get some support into, because we all know that we as media agencies hide behind you can't measure it, so we're not sure what you got. So again, we want to try and stripe that away, give some support in that area, and also start measuring the dollars. And really, really important that we've got dollars in our eyes when it comes to how we measure success accordingly. Bottom line is we've got these in place. We have every major agency group, independent too, signed up to these commitments in principle. I will tell you that there are over, I was counting them up yesterday, 60 to 70 very like the senior end of the media agency community, and again referencing Doug's community too, we're all in on this, and there's 60 or 70 people that are engaged in this, and it's not just the CEOs, it's the trading leads, it's the planning leads, and people like Doug and I are all in accordingly. So rest assured that there is a commitment here. We've got the measurement progress point coming at the end. So I'll take a pause there because that's a lot of information. So I hope that helps.
Well, thank you, Steve. And I want to reemphasize to the audience what they just heard. What you just heard is the 4A's, the American Association of Advertising Agencies, just shared with the FCC's Diversity Committee how the CEOs and senior executives of the world's leading media agencies have committed to a 5-point plan around diversity, inclusion, and equity as it relates to Hispanic, African-American owned media. That is significant. And Steve, so thank you, Steve, but also thank you for the work you did in development of Fair Play Charter, which is focused on eliminating no urban and no Hispanic dictates. I want to pivot and go to Mr. Farrell, who is, I would say, international in terms of the impact that he's had in our industry from South Africa. And now he's, of course, he's been in New York, and he's done phenomenal work with one of the world's largest QSR companies in McDonald's, and the work that he does with them in the New York, New Jersey area, but also what he does with McDonald's nationally with this faith-based initiative. Mr. Farrell, it's a privilege to have you today, and we would like you open up with some comments. And if you want to weigh in what you heard from Steve, we'd welcome that too. You're on mute, Mr. Farrell.
I'm on mute because my team always wants me to stay on mute. So Hi, everybody. I'm A. Curtis Farrow, and I'm happy and proud to be here today. I'm the owner of a Black agency. Have owned my own agency for the past 30 years. You know, Raul, I was ready and prepared to say something, and you know that question is such a great, loaded question. And a great question to start off with. And I would just say, you know, and even listening to you, Steve, I would just say this is that you know, especially as someone who owns a Black agency, I have to stand forth and stand right on this call and let everyone here know that there is systemic racism, period. And anyone who does not believe that, then my grandmother used to always say to me, you're only ignorant because you want to be. That someone who wants to learn and someone who wants to be about other people, you seek, you find, you search, you get out there and you get in it. And I'm very proud of my agency. I'm very proud of what we do and who we are. And, you know, Steve, I'm listening to you, even the plan, I love it. I love it. But the one thing that we are determined to do, especially with working with Black Lives Matters and working with many organizations, NAN and even the Hispanic agencies, and working with so many folks around the world. One of the things that we have said that we need to start doing, we need to start activating. Because you know, I don't want to be in another club. I don't. I've been in enough clubs. I don't want to be in another club. I want to activate. And if we're not going to activate, guess what? We're going to be right back where we started from. And the truth is, as an owner of a Black agency, and knowing many other Black agencies and many other Hispanic agency owners who are my size, they're the small guys with big hearts and with big work. I have to tell you that this pandemic is hurting. And I say this because the big boys can all come together, and that's great. It really is. It's great. But the truth is, where the systemic racism comes in is this. If anyone feels that you are going to in any way take a piece of their territory, then all of a sudden they become ignorant. That's really the base of it all. And the truth is that we are all so much better together if we come together. We're going to be so much better together, Steve. That's why I love what I heard, because if we come together, but I don't want that number to be 60, Steve, quite frankly. I want that number to be 600. I want the outreach and the inclusiveness to be even bigger, to be broader. And that's really what we need. And if we all come together and we activate together, then we can change this, even the diversity. You know, it drives me crazy because for years I've had so many folks who have worked hard on my behalf with clients, and even going in with clients. You work so hard and you go in and you know you have to, at that time when it comes to media. I know we've had new I'm going to use an example, new radio stations, Black radio stations, or a Hispanic radio station that will open in the market. And I don't have to tell you guys, you know that all of your big boys, especially your big clients, they're very afraid to put any dollars in there because they want to see what it's going to do. I want to see what the ratings is going to do. But I've stood up in front of them before and said, no, this right here is the only Black station, Black owned station in all of the New York market. And you mean to tell me that Blacks are leading in your market? Blacks are bringing in more money. Brown people are bringing in more money, and you're not going to take a chance on them, but they're taking a chance on you. We need to have folks who are going to activate between client, between media. And if we don't do that, and it can't be about saving yourself. I just have come to that point where God's going to look out for me, and my friends are going to look out for me. My mother is going to look out for me. So I'm going to get out there and stand forth and just tell the truth. And in telling the truth, I know that it's going to work out in my favor, but it's not even about me. It's going to work out for all of those other folks out there who need that help. And you're going to help your clients. We're going to help the clients. we're going to help the clients. And lastly, I'll say this. For me, even diversity it's great when I see agencies and when I see media companies, and even when I go to radio stations that are not Black owned, but they're servicing the Black community, or they're not Hispanic owned, but they're servicing the Hispanic community. And then they'll show me that one person, oh yeah, you see that sister right there, it'll be one Black lady. Oh yeah, she represents, you know, the whole Black community, or there's just one Hispanic who represents the whole. I want us to get past that. For me, I'm offended by that. And I'm not saying that I don't want you to hire Blacks, I don't want that, but I'm offended by that because our communities are so much bigger. We're so much better. That's one of the reasons that I have never left the community. I live in Paterson, New Jersey. I can live anywhere I want to in the world, but I live here because I want to know my people. When I go before my clients, I want to go in and say, I know this is what Black people like. I know this is what Black people want. I know that we can sell that, and Black folks are going to love that. I want to know that I know that from my heart. So, Steve, thank you. I'm sorry, Raul, you got me hot.
Let's do something about it. Yes, absolutely.
Yeah, and thank you, Mr. Farrell, for that very, very passionate perspective. And it actually sets a nice transition for the person that we're going to hear from next. And you know, Doug Ray is one of the leaders in the global media agency community. He's currently the CEO of Dentsu Aegis, whose clients reads like a who's who from General Motors, Procter & Gamble, Microsoft, the Home Depot, and I could go on. And my relationship with Doug goes back when he was the CEO of one of their agencies that he oversees, and that's Cara. Doug's commitment in this area isn't new. So when he made the announcement just 2 weeks ago at the National Association of Black-Owned Broadcasters Fall Conference about what he is leading and what Dentsu Aegis is doing around driving more of their clients' advertising dollars to minority-owned media, it met with a resounding support. So when we were putting together this forum here for the FCC, I said, Doug, this is a place where you also have to come, because what the FCC wants to do is to support creating more Hispanic, African-American, Asian owners, and they have to hear what you, as one of the leading global media agency CEOs, are doing to drive that. So, Doug, welcome, and I know you got some big news to share with the entire group here today.
Yeah, thank you, Sherman. I appreciate that. And you know, Curtis, I loved what you said, and to build upon what Steve was talking about as well, I think it's important that we have industry associations establishing frameworks that can help serve as a guide for many agencies and many individuals. But Curtis, what I love that you said is that we need to activate. And that's kind of been my modus operandi my entire career, which is, you know, if we don't see forward progress and movement, and we're not part of that progress, then we're not really accomplishing anything. If it stays on PowerPoint or it stays in a document, then what do we have to show for the efforts that we've put behind it? And you know, as we went through the summer, it was very clear to me that we weren't activating, that we weren't doing enough, and we had to do something different. And so had an idea to do something different. And I think that, you know, overall, you know, we have to ensure that the dollars are flowing to, you know, minority-owned businesses. And there are many barriers, and we can talk about those barriers. And total market planning is a huge barrier. And we've been lazy as an organization, because we've used something like total market planning to justify not having to do the harder work and not having the conversations with the various companies that we need to have. If we can have a conversation with 5 companies, that's a lot easier than having a conversation with 20 different companies. So, you know, a lot of that has to relate to how we think about overcoming some of the measurement barriers, some of the barriers associated with ratings, and most of the dollars are flowing through those types of spots and dots, the types of advertising. But frankly, we were envisioning something different, which was moving from an advertising model or an interruption model to an engagement model. How do you connect with people in a much more engaging way, right? And these minority-owned broadcasters and businesses have deep relationships with their listeners, with their viewers. And oftentimes we overlook that because we're looking at the CPM or we're looking at the ratings. And frankly, I'll set this aside because this is probably a conversation for a different time. If you look what's happened in our industry with the new business pitches, procurement departments, and so on, we've been driving down the price. We've been looking for value by looking for cheaper media. And that doesn't actually necessarily correlate to brand growth and to equity growth, helping really establish brands in the marketplace over time. So how do we change that? We create a program that actually injects revenue into Black-owned and minority-owned businesses by creating new content, new opportunities, and we bring our clients along that journey. And so we set forward to activate, our 5-point plan by saying, what if we could create content that we could then bring brands along to fundamentally sponsor and syndicate that across Black-owned broadcasters. And so we talked earlier this fall and late summer with several of the CEOs from the NABOB organization who were very much behind the concept. I'm very excited to say that just last week we issued an RFP to 4 Black-owned production companies. We will be evaluating the content and the program that will be coming back. And we actually have now at least 5 clients who are signed up to do this. And they're all super excited. And this is not an advertising idea. This is a societal opportunity to create systemic change in our industry. And if we can make this work for Black History Month, which is when we're looking to launch the content series, then there's nothing to say we can't do this for Hispanic History Month in October, and Pride Month in June, and other types of minority-owned businesses to support that. We're looking for a platform and a branded content program that has longevity. And one of the things that stuck with me a number of years ago when I was overseeing the P&G business was when Mark Pritchard said during the 2012 Thank You Mom campaign that he was the brand manager on that campaign. And I've said to my team, I don't know if I'm a producer or a media planner or media buyer, but I'm now the media planner, buyer, and producer, versus being the CEO, because we do have to activate and we have to do things different.
Well, thank you, Doug. And I certainly hope the FCC audience, both the broadcasters, the FCC staffers and commissioners are what that they're getting to hear real commitment from the ad community around investment in African American, Hispanic owned, and Asian owned, because it should provide for them incentive of why getting things like our minority tax certificate, all the things that they're doing from a regulatory standpoint to create more, to know that there are dollars that are going to be flowing to these minority-owned broadcasters. So thank you, Doug, for what you're doing at Dentsu Aegis and what it's going to mean for the growth of more minority-owned media companies. Bob Wingo is the CEO and chairman of Sanders Wingo. I've known Bob for over 20 plus years. His clients read like a who's who. I mean, he's done phenomenal work for AT&T, Burger King, General Motors, State Farm, the U.S. Postal Service, and Shell. I wish I'd gotten some of those dollars, Bob.
I wish I still had some of those clients.
But But Bob, we're happy to have you here and as you know, certainly what you've heard from Doug and Steve and Mr. Farrell, I want to give you the opportunity because of, you've done a lot of phenomenal things with a lot of terrific clients. And I think your insight perspective here today on how we can grow minority ownership is going to be really important. So thank you again, and the floor is yours.
Thank you, Sherman. First of all, I want to thank the FCC for organizing the Access to Capital Symposium. For me, already listening to Steve and Doug and listening to Curtis has given me some key insight and key feelings about where things are. I love the fact that some of the things I was going to talk about today have already been answered. There is a manifesto or a 5-point plan that's in place. I think that's wonderful. I think it's something that's sorely needed. I think how we look at investment opportunities and access to capital for minority-owned media is really a key component. How do we make those things a reality? I sat in a little bit on the last panel discussion, and part of it was some of the media did not have access to certain tools, which now they're looking at ways of making those tools accessible. How do we turn this conversation into an actionable agenda? I think there's a lot of good content that's been shared and it's being shared, and that what we're looking at here is a game changer, a pivot point. How are we collectively going to be in a position to measure success? How are we going to measure year-over-year growth and volume? How do we make sure that from this stage that we're sitting at today, that we have access to the C-suite? Because when you look at holding company level executives and agency level executives and corporate executives, they're collectively making the key decisions that drive where things are going. We talked a little bit about Mark Pritchard and some of the things that Mark is doing, leading this whole chief marketing officer agenda and how we engage and make sure that people aren't left behind. But who is going to inspire the investment in minority-owned media, and what's going to be the return on investment for those that do that? How do we really create the check and balance systems to make sure that these things work? How do we collectively build and have a seat at the table so that we have an opportunity to have those high-level discussions? In retrospect, I can tell you, based on some of the clients that Sherman shared with you, and I can tell you, I had almost a 2-decade-long, wonderful, wonderful relationship with Group M Media. I mean, I started, it's funny, I'm listening to Steve, and I don't know if Steve knows Rupert Day, but I met with Rupert Day in New York and in London way back when we were starting to work on business. And Mike Law and Gonzalo Del Fa and some of the other key leadership people, Renee Miliaresis, who's now at Colgate, but Renee was there. So we had a relationship. We met once a month. We had a check and balance system in place. We were doing enormous amounts of volume. And what was the pivot point where those things changed? One day, it just, not that the relationship changed, but the business model changed and things weren't the way they were. I think it's a combination of not only how do we invest in minority-owned media outlets, how do we ensure that the agency models that were once in place are back in place so that we can really raise the bar. And I'm not casting blame on anyone, but right now I think the key thing is how do we collectively get a seat at the table? How do we really have an opportunity to have those shared values? Because what we're talking about right now is how do we move from this being an obligation to an opportunity? An obligation to an opportunity. We are in the middle of the eye of the hurricane. The big winds have passed. We're in the calm part of the storm now. How are we going to pivot to take advantage and keep this alive and well? I had a great opportunity also. We talk about Marla Kaplowitz. I worked with her when she was heading up part of Group M. This is it's interesting when you start looking back at all the things that have transpired. And I look at Doug at Dentsu and having had an opportunity to work with Wendy Clark, the global CEO, for over a decade. These are things that I think, how do we rebuild and rekindle the relationships where we have the ability to drive the content and the dollars down to the people that need to have access to the capital and access to the budgets. I think if we can do that, we can bend the curve, and maybe it's a combination of all the things that are already happening, many of which I'm sure I'm not aware of that are happening behind the scenes. But who's going to be in charge of the scorecard? who's going to ensure that all the things that we're talking about right now are really going to continue to take place and be an actionable part of what we're doing going forward. Trusted voices are key. We have to reach a point where we trust each other and build the kind of relationships that we once had. I remember when we had the BET conferences, when we had the Black Enterprise conferences and things of that nature, working with agencies like LatinWorks and many others. It's just a changing footprint right now. And I think we're beginning to pivot back in the other direction. I'm excited about it. I hope ultimately all of us will have a bigger voice at the table, and I'm certainly willing to assist in any way I can. And I'll stop for the moment because, again, I don't want to hog the microphone, but thank you for the opportunity to throw a few thoughts out there. I'll share more in a bit.
Thank you, Bob. I appreciate it. I'd like to throw it back to Chairman Alarcon and if Chairman Alarcon, if there are questions that we've heard some major announcements from some very important players in our industry today. So if there are follow-up questions, Chairman Alarcon, that you might have for the panel.
Yeah, thank you, Sherman. Gentlemen, you have done a tremendous job. And you're continuing to do enormously positive initiatives going forward that you've explained today. We have a unique backdrop, a very special backdrop to this symposium today, as a result of the fact that they're still counting votes that are going to determine the future of this company, excuse me, of this country, for the foreseeable future. And I don't think there's anyone amongst us that can say, and I know I can say without fear of contradiction, and I'm sure you all agree, that the minority vote was critical in however this turns out. The minority vote would have been critical in this election that we're still living today, right now. And I wanted to ask you, because there's no doubt of the political strength of minority audiences, whether they be Philadelphia and Miami-Dade, Nevada, Arizona. There can be no doubt as to the impact of the minority citizen. So I wanted to ask you, in light of that, and I don't think anyone will give us an argument on that, I wanted to ask you if these initiatives that you all are employing, and again, I thank you individually and collectively for all that you're doing, if they continue to fall short, and we hope that they don't, in light of the fact of the power which is easily demonstrable in the political world today, you guys, the four of you, I'll never know what you guys have already forgotten about clients and relationships with the clients and what they're really looking for and what they really respect. So my question is, if this all is not enough, I wanted to ask the four of you to comment on this. Would you think that a more in-your-face or forceful attitude with the clients directly would yield that extra benefit that we have not been able to obtain for whatever reason? I asked whether it were ignorance or whether it was bias. I think I heard the answer that it was really both. Do you think that a more in-your-face type of attitude or a more forceful attitude would yield benefits in terms of what we're all seeking to do in this industry and in terms of fostering minority ownership of the media and minority influence via media in the country?
Yeah, maybe I'll take that. I think I'm not sure that I would say that a more forceful approach, because I think in general people don't really respond well to force and an in-your-face. What I do think, though, is, and Curtis talked about this a little bit, which is we need to have more diverse representation within our organizations for sure. And but I think it may not go. We may fall short. But as long as we're making progress, we can measure that progress. I do think, though, it comes down to allyship and advocacy. And I think that where I see the progress that we make is when we have advocates, whether or not they're people of color or not, that they're advocating for the progress of minority individuals. And I think what we need to do is we need to find more and celebrate those advocates at any level within our organizations, because I know that they're there. I've heard them in our organization, and they may not be the most senior individuals, but they are there, and we need to listen to them, and we need to listen to their ideas. So what I would say is, we've seen a tremendous revolution in marketing through the use of social media influencers. And so if we just apply that a little bit to ourselves in the sense of where is the allyship, where are the advocates that can actually help, again, create real change, activate the change that we're looking for, I really do believe we will see systemic change. Whether or not it is far enough, I think that's for us to be able to measure in time and then be able to determine what we do next if it's still not enough progress.
Thank you, Doug.
Can I
Anyone
add
else
some
want to
thoughts
take
on
that?
that? Yes,
Yes.
I would like to add a couple of thoughts. It's Bob Wingo. I think
Yes.
that when we look at what we're speaking to here right now, I think part of it goes back to trusted voices. Part of it goes back to relationships. Trust plus relationship equals opportunity. Trust plus relationship equals opportunity. If we can get into a place where we are trusted, we will have the opportunity to excel. How do we ensure from the top down, from the C-suite, down to the CMOs, to the agency holding companies and the agencies, period, that the message and the architecture of what we're trying to accomplish here today is really resonating? A CEO at a corporation can tell the CMO and their agency, I want to do X, I want to make sure that there's inclusion. How do we ensure that those kinds of conversations are going to take place? And how do we ensure that it, as Doug said, we don't want to do it where you're being hostile. We want to do it where we are doing the things that we always do. How do we go about doing business? Okay, there's rationale, there's strategy, there's engagement, there's understanding. If we put those things in place, how do we go from just a thought process to an end result that we can all be proud of and that we can all benefit from financially?
Steve, would you weigh in on it as well?
Yeah, I'd love to, and really, I mean, obviously, we're all echoing the same thing. But to put my view forth, building on what Doug said, really, I think we've as an industry, as a collective, we've got to be clear that the goal is equity, right? I'm going to keep saying the word equity, and people have really got to understand that that is our goal here. And it's less, and it's almost less rational, right? It's kind of it's just the right thing to do for humanity, and you start there as opposed to starting with any more object. And I also think that our industry hasn't been and has got now again, and we must make this real, the opportunity to figuratively and literally get in the same room together. I've come across some examples, where sometimes when things get escalated, and I'm at point of contact, given the 4As, by the way, and as soon as it gets into agency land, I very quickly pass that off into Marla and her crew in the 4As, because it's not appropriate for me to be taking positions with other agencies in that sense. But it comes down to we haven't got the trust and the connections in our business that could really cut through some of this stuff at a senior level as well. So getting in the same room for me is the rallying cry. And I think, it's said slightly different ways to everybody so far, but I think it's about education. It's about collective advocacy, all points, all quarters of our industry, clients, creative agencies, media, like the whole piece. Nobody should be excluded from that. It's about creating connection in order that influence can be felt. And it's about being jointly accountable. And that's just some of the things that we're trying to handle in the framework for the 4A's 5 commitments. So I think if we can hold those things out there, but what I have been so disappointed in, just to recap on it, is things blow up into issues with people feeling that they've been dealt with unfairly in a minority-owned media station vendor channel. And I find out that actually that vendor, no criticism of the vendor particularly, but they haven't got any connection with the buying point, just to get super tactical about this answer. They've just not got the connections there. So we all need to help with these connections and using our collective influence, and then collectively holding hands and covering off this accountability piece at the end. So again, that's our endeavor. And for the 4As, we are about to make available what I'll call a rotating invitation for all BIPOC media owner targeted and otherwise media owned to come into the 4A's Media Leadership Council to just have a conversation with us in the course of our regular meetings. And we're going to rotate that. Come and meet us, come and talk to us, come and meet everybody, you know, shake hands, as it were. So still figuratively at the moment, obviously, but do that. And then I think we can make progress because we're looking at each other in the eye, and there's a chance that we'll hold ourselves accountable on that basis. So that would be my ad.
Well, Steve, I certainly want Mr. Farrow to weigh in on Chairman Alarcon's question about it. But before you do, Mr. Farrow, again, there are major developments that are being shared in this discussion. And Steve just made another one where he just talked about there would be a rotating opportunity for minority-owned media to be with the CEOs and the senior executives of the world's leading media agencies. That's significant. That's huge. So Steve, thank you. And thank Marla for that. Mr. Farrow, if you could weigh in on Chairman Alarcon's question, please.
Yes, absolutely. Bob and Doug and Steve and Sherman and Raul. I feel like I'm on this panel, but I'm way above my pay grade. But I just want to say, Raul, Doug said something that I thought was just perfect, was that, no, we don't want to be forceful. And I think that anybody who knows me would say, like, what is he talking about? And you don't. But what I am, I'm a passionate expert. And I won't let anybody take that away from me. And that's our problem. That is our problem. We've had the same client, we've had the same three clients, big clients, for 20-something years. Two of them left us for 1 year and they came back and we were like, what happened? And they were like, they wouldn't tell us from the heart what they really believed. And so, Raul, I think that it maybe not forceful, but with passion, yes. And I think that sometimes we get so stuck on the money and we get so stuck on, we got this contract, and then we get the contract and we don't come to the table with no activation, and then you don't come to the table with passion. And so we can't even help our media partners. You know, we look back, we want to help this radio station, we want to do this radio station, and then we don't even know how to sell it because we don't have any passion. And I think, to Steve's point, if we don't come together and get in there, I need to know more about WBLS so that I can sell it, or I need to know more about Hot in Miami so that I can sell it. I just think that it's all about passion and being an expert and letting that passion live within you. I don't think you have to be forceful, but I do think you have to come to the table with passion.
Well said. Thank you, sir.
Well said.
Here's what the ANA just published a report where it talked about what percentage of media dollars are making its way to African American, Hispanic, Asian, or the BIPOC community. That number is 5%. 5% of the dollars that the Association of National Advertising is reporting, only 5% of those dollars are making it to minority-owned media. Whereas when you add up those segments together, they make up over 40% of this country. So there's clearly huge disparity in the dollars that are flowing to minority-owned media. I'm encouraged when I have conversations, not just conversations, but when I see the actions of a Mark Pritchard, because he lives it. He lives it unlike any CMO I've ever seen. And And when I see the actions of CMOs or senior executives like him and some of the others, it gives me reason to be encouraged about what is going to happen. But I wanted our panel of CEOs to certainly weigh in on, when you hear that number, that only 5% of dollars that are making their way to 40% of the country. What are your thoughts, and certainly again, some of the things that you announced today have the potential to move the needle there. But I want you to weigh in on what I just shared with you.
Sherman, can I just start this real quick? And I promise, guys, this will be 2 seconds. The one thing that I will say from a Black agency standpoint, and from a Hispanic agency, and just a minority agency, that total market phrase, that total market killed us.
Okay.
It killed us. It just gave I mean, and when it kills us, I'm saying it kills the media. It kills,
absolutely.
It kills the Hispanic media. It kills the Black media, because it gave the client the ability to say they didn't need us.
Absolutely. Great. Thank you. Doug, Steve, and Bob, you all want to weigh in on this?
What I will say, this is this is the question, right? This is where the sensitivity and the rather opaque nature of how we solve problems going forward sits between owned and targeted. So let's leave aside the total media. That we've already put a line through total media, so I'm going to stick with that. So whilst that's said, I think we need to be clear and careful, sensitive about how we manage the expectations in the wider community about the conjunctive phrase of owned and targeted. So this is a much longer conversation, and it's one that, we had some really good feedback from Sherman and his team on, and how we sort of deal with the sensitivity of both of those things, I don't think helps in this conversation, because there's a lot of targeted media that deal with I'm using your metrics here, Sherman, but the 40%, if you will, and I'm not talking about total media when I say it, but, it's a sensitive one, and I'd love everybody else's views on that.
Yeah, I think that's exactly the right thing. I mean, Sherman, you and I had probably a 2-hour conversation on a Saturday about this, which is, what is the right metric? And I don't think, this is my opinion now, I'm not the opinion of my larger organization, but I don't think that utilizing population numbers are the right metric to define percentage of spend. I do think that as we think about the population of different audiences, we want to ensure that those populations that are driving disproportionate brand growth are represented in those plans. So we know that there are certain products, there are certain services that are disproportionately driven by certain audiences. And we want to make sure that we're representing those audiences in those plans 100%. 100%. How we do that, I think, is the sensitivity that Steve is talking about, right? Because we can reach a lot of Black consumers through BET, through now iHeartMedia's Black Information Network. And in fact, when I talked to iHeart about the launch of that, I sort of went, oh no, I mean, I think they're trying to do the right thing in response to some things, but at the same time, they're actually making it harder for Black-owned small businesses, because they're going to be taking more dollars away from those organizations. And so that was also one of the reasons that we decided to launch this Project Booker, was because I wanted to ensure that we were carving out money for Black-owned small businesses. So I do think it's incredibly sensitive, and I do think that we have to ensure that we're reaching the right audiences that are driving the growth for our client's business. But we have to then understand, how do we do that, and what's the right metric? I haven't landed on what I think the absolute right metric is. I think we still need to do some work in that area.
Here is something, and because I know that maybe Bob wants to weigh in on as well, but Doug and Steve, I understand the sensitivity around it when and you're both right when you talk about minority owned and minority targeted. But let me share something with you that where I got it. And it's something that I think it has to be a part of how you approach this. The word I heard from a minority owner here in Chicago, the word she used, Doug and Steve, was intentionality. Intentionality around, because Project Booker is focused on intent. That's intentional. You're making a clear intention to advocate investment in minority-owned media. So what I would say to you is, as you juggle with the sensitivity of it and the right around targeted own, intentionality, that you're intentionally making investments in an SBS, that you're intentionally making investments in an urban one, that has to be part of how you approach it.
I 100% agree with that. I think and that's the point of, setting a metric or setting a goal, is to set the intention to do that 100%. And we're working with a number of our clients to look at what they're doing now and how do we make progress? How do we improve upon that? How do we double that spend perhaps than what they're doing today? So I couldn't agree with you more, Sherman, in terms of making sure that we're driving and delivering on the intention to do something different and to improve that.
And I will add there, Sherman, that just in the fifth bucket of accountability for the 4As, we're going to be offering up, and we'll come to this forum, we'll happily do that, but we're developing an opinion, as Doug's described there, on those metrics, so how should we do it? So we haven't got the answers yet, but we're working on the mechanic for how we do that, and we all link arms and agree on that. Regardless, we will be measuring both as opposed to in terms of how we get there in terms of the metrics. So we're measuring discreetly what owned delivers in terms of dollars, and we'll also be looking at the fairness behind the targeted media channels as well. So we're comfortable that we can cover both, but I think the metric behind what we invest behind is a really important one that we need to agree on as an industry.
And what about scalability? When we start looking at, there's approximately, and I could be off on this, 200 minority-owned radio stations around the country. How do we make sure that they're on the radar? How do we make sure that they're being included and it's an inclusive process? If they don't have some of the tools that the major agencies have, then how do they really get recognized for the value that they bring to the table? One thing I really enjoyed today is listening to Curtis. He's been around as long as I have.
Longer, Bob. You're younger than I am.
But all kidding aside, guys, I mean, this is a fantastic conversation because we're trying to identify how to be game changers, how to ensure that now at this juncture, at this pivot point, that we can include people that have been left out of the equation. And I think, what are the tools that we need to put in place to ensure that at Doug's level and to make sure that at Steve's level that we have those kind of assets, because at their level, they're not going to be able to see all these things. So we have to make sure from a lower level perspective, this kind of content is being included.
Yeah. Chairman Alarcon, would you like to weigh in?
No, I think this is obviously an important question. I'm biased, obviously, because I've been at this 37 years and I've seen a lot of targeted stations enter and leave the market based on strictly on dollars and cents, and whether what they were doing in the community paid off. And I understand that. I understand that because it's a business. We've been at this 37 years, and I got to tell you, 37 long years, and there's been hard moments in time. And what's driven my company, which was founded by my father, what's driven my company is an undying commitment to the Hispanic-speaking people of the United States. And that's what drove us to make the effort and the investment against all types of obstacles in terms of owning these major market radio stations in in the largest U.S. Hispanic markets. Now, we're not going to give up on that. We simply are not. And we compete in New York. You know, I'm happy to say that in New York, we're the most listened to station in the market, irrespective of language. I'm tremendously proud of that. And I would hope, gentlemen, this is not a question, but I would hope that through your efforts, and I can see that there's a genuine feeling on the part of all of you to do the right thing here. Doug, Steve, I can see that. No, I can feel that. But I would hope that through your good efforts, people like myself and others like me in the minority broadcasting sector will be able to finally reach that plateau, even if it's parity, you know, because we've never even been at parity with respect to the buying power and the GDP of our particular, the per capita income, which is now growing 4 times the general market. We've never been near that. And so I'm very heartened by the fact that you all have taken such an active interest in some of these initiatives that you're putting in place. And I can only say on my behalf, and I believe I speak for a load of people like me that are in this position, that whatever it is that is needed, of course you're putting your efforts, whatever is needed on our part to come to the table with, whatever it is, not the least of which is an enormous community. No, we shouldn't forget that. But whatever it is that you gentlemen need, please feel free to call upon myself and others like us, because this is not only our past, it's our present, and it's our future. And it's a future that is inextricably bound with the future of this country, as we are all seeing now, as a result of what's taking place politically. So, no, I thank you all. And I would hope that we can, in the not too distant future, get together again. And I think this was a wonderful panel, and I think this was a wonderful symposium. I'm very grateful to Sherman, to you, and to the FCC for putting this together. But I think this needs to, we need to, someone went like this, I think it was Steve, and said, we need to continue this dialogue and continue, and I think it was Doug also that mentioned it, and Bob, I think also, and also Curtis, we need to continue this dialogue in whichever way possible to get to a place where we can all be proud, justifiably proud of our individual contributions to the better good with respect to the minority community of this country. No?
I was going. Those will be the last words. So Bob, Doug, Steve, and Mr. Farrell, we appreciate it. I'm going to turn it over to Caroline Beasley, our subcommittee chair, and for your thoughts.
Thank you, guys. Great job.
Thank you. Thank you.
So thank you, Sherman, Raul, Bob, Curtis, and Doug. I mean, that's a very, very interesting and inspiring panel, and we look forward to all the great things and bringing advertising to minorities. I think what you're doing is yeoman's work, so thank you very much. This will conclude our symposium today. We do have just a few remarks. I hope that it has been helpful and informative, and will help you toward your goal of broadcast ownership in the future. I'd like to thank the subgroup chairs, the speakers, panelists for their participation, and of course the FCC staff, the 3Js, Anna and Heather. But before turning it over to Anna, Jamila would like to take a few moments to say some words. Jamila?
Good afternoon, everyone. Well, we've had another very informative and successful program from the ACBDE, and we are greatly, greatly indebted to the chair, Carolyn Beasley, for all of her hard work to pull this program together. We also want to say a huge round of thanks to all of the Access to Capital Working Group members, and I think we would be remiss if we didn't name them. Again, Carolyn Beasley is chair, Beasley Broadcast Group. Raul Alarcon, Spanish Broadcasting System, Inc., Milton Clipper, Clipper and Company, Skip Dillard, MS Communications, WBLS, WLIB, Michelle Duke, National Association of Broadcasters Leadership Foundation, David Honig, Jewel Glow Productions, Sherman Kizart, Kizart Media Partners, Garret Komjathy, U.S. Bank, Dewan McCoy, Circle City Broadcasting, Ama Nahuja, a Wonder Media Company, Henry Rivera, Emma Bowen Foundation, and Wally Ryan, LLP, Stephen Roberts, the Roberts Companies, Dr. Namisha Shukla, New Jersey Broadcasters, LLC, and lastly, James Winston, National Association of Black-Owned Broadcasters. Thanks to each and every one of you for your efforts, supporting this work, and for developing a very timely program for the public. Many thanks also to FCC staff members Brenda Lewis and Kevin Green for their assistance in this project. We especially want to thank Julie Saunier, Deputy Designated Federal Officer, for her tireless efforts organizing this symposium. Well done, Julie. Thanks also to Jamil Kadre, Deputy Designated Federal Officer, for her excellent work on the project as well. Earlier today, FCC Commissioner Jeffrey Starks joined us to help kick off the program, and as always, he is so supportive of the mission of this committee, and we want to thank him again for joining us. Huge thanks also to our Media Bureau leadership, Michelle Carey, Sarah Whitesell, Brendan Holland, and Radhika Carmarker, for their work in developing this symposium and their efforts to support the committee's work. We truly hope everyone learned something from today's stimulating conversation. Thank you to all of our great panelists and moderators. Next up for this advisory committee is the January 15th, 2021 Summit, a roadmap to tech jobs for high school and college students. This summit will include career opportunity information on how to interview and how to land a job. So please visit the advisory committee page at www.fcc.gov. Thank you again and have a good evening, everyone. Anna?
Thank you, Jamila. Wow, what a fabulous day we had today. Just a terrific symposium. I have to agree with Jamila, with Caroline, with Raul Alarcon, all of the wonderful things that they said about today. We learned so much from the experts in the field. We've heard a lot of things, but I have to say them too. Thanks to our working group chair, Caroline Beasley, and to our subgroup leads, Duwan McCoy, Nahuja Ama, and Skip Dillard for your leadership, as well as to Marita Coley, David Honig, Henry Rivera, James Winston, Dr. Shukla, Raul Alarcon, and Sherman Kizart for your outstanding contributions. And of course, we thank our wonderfully informative speakers. I know I learned a great deal today. And I can't leave without thanking the 3 Js, Jamila, Julie, and Jamil, for all they do to keep us moving forward, and all the other FCC folks that have supported us. And finally, I just hope, would like to say, I hope you will join us in January at our next committee event. So thank you again, and I think we can close out a fantastic day. Have a wonderful weekend.